It's like the prices are see if some you get an audio, some are not. And I don't know if that's their connection or what, but I'm gonna try to avoid this.
All right. The next question is: are you a miner or investor? Okay, so this is a really important one. By the end of this year, is the price of Bitcoin going to be $250 or 500 plus?
Any good asset in a fair market is priced. I mean, it's been on its slide. What's that now? Really? Everything got crushed last week.
All right, so if we can have everybody kind of, we're going to kind of mix it up for the next round. Y'all want to get back to your seats? We're going to do a little bit of a round down quality a lot. And I think it's
it's just crappy internet. It says the stream is good, but that doesn't look good. You can see that's pixelated right now. I might talk to see if Marshall has a hotspot. I would use mine, but I only have 16 gig, and I tell you really good hotspot. Data planes.
All right, guys, we got to return to our seats. All right, guys, if you have your attention. Thank you. All right, so what we're going to do is warm up, and we're going to have a round now. So now that you guys are pretty much all in your seats, so you can just talk to each other. So the next thing we're going to do is when you say go. So I think most of you know each other, but introduce yourself. If you work for a company, let people know the name of the company, the position. And the question that each of you need to answer is, what is one thing you own that you wish you didn't? So go ahead, go.
Which one is it? LG. This one? The LG one?
Yes. Okay, so we're going to the next round. Now I have your attention. So what we're going to do this time, everyone, is that now we're going to move. So if you've been kind of sitting in the same spot, you need to get up and move to a different spot. So So when you move to the next spot, do the same thing. You know, your names, and you introduce yourself. And the next question is, have you ever been to a Bitcoin show? If not, why not? And how long have you been involved with Bitcoin? So you can go ahead and stand up and move to a different table. All right.
So it is.
See, I'm getting that. That's the Google Plus community, or the Google thing. And then YouTube is this other Oh, that's a lot.
I just looking for a phone. It's gone missing.
You're in front of it. Well, it don't matter, but what were you saying?
I'm looking for a phone that's gone missing.
A phone? You have a phone here?
Okay, everyone. So we're gonna move to the next round. You can do it again.
I have been ringing it, but it's ringing.
Next question is, what is your favorite sport?
All right, another way. Thanks.
So this video, like,
yeah, I'm running. Kind of, because it allows a pre-buffer. If I try to do real-time, we need a lot more bandwidth, and it allows us to do something like tragic. That's the secret. Yeah. We're the broadcaster. Somebody sees them.
Yeah, and I have that guy.
Oh, it's cooking now.
All right. What's your favorite mining hardware of choice and why? Next question.
I'll tell you one thing that I did. One thing that I did was like 2012 or 2012. Pretty good multiplier. How much I paid for electric? Absolutely. It hasn't really been a consistent development.
And the last question we're going to do here is, what's one thing you wish you knew when you started mining and that you know now? What do you wish you knew now that you knew way back when you started mining?
Number of systems that just the sheer amount I like to go really
All right, guys, so we can start wrapping up the conversation. We did our last round, so we're about to head to the next panel. So you can say your last goodbyes. Give that a hug and sit back in. So raise your hand if you met someone new. All right, good. So everybody follow the instructions. Good. So by a way of show of hands, how many of you are a minor? All right, and keep your hand up. How many of you have been a minor for more than a month? Okay, 6 months. 1 year. Okay, 2 years. All right, smart guys. Cool. And raise your hand if you're a new minor or you're thinking about becoming one. All right, cool. So our job here is, those that raise their hands to make them feel comfortable and teach them everything we know about mining. So that's job number one. And then job number two is, next year when we do this. Okay, so next year when we do this is to have more hands for new miners. So that's what this is all about. So we appreciate you guys coming out, the support you guys have shown, and we're looking forward to a good time.
How's everybody doing this morning? Good. I'm Leo Eric. I'm one of the executive managers at Final Hash, and glad you guys came out to our inaugural Hashers United. Well, today we're about to get started with our panel of sorts. It's going to be a panel that's going to focus predominantly about the in-depth analysis about the future of cryptocurrency here in the United States and abroad. As you guys know, there's lots of rules, regulations that are affecting both miners as well as investors in cryptocurrencies. Even the users of cryptocurrencies have different implications for being involved in this industry. So we've got some of the leading edge minds in cryptocurrency right now that are going to help us go over a little bit of what they feel is going to be basically the future of cryptocurrency here as well as everywhere else to help us as miners make, do what we want to do. We want to basically make money, right? And make it effectively. And is it going to be something that will stay a gray area within the United States, or will there be more clarity? And we'll see. So in the meantime, I'm going to go and start introducing the panel. First, we have Mr. Tim Draper. He's founder of USD. As you guys know, Mr. Draper here, he's an advocate and he's an entrepreneur of the free markets. Tim also, he was ranked number 52 out of 100 for the most influential Harvard alumni, and he was number 7 on the Forbes Midas list. He was named always on number 1 top venture capital deal maker. He was awarded the Commonwealth Club Distinguished Citizen Award for achievements in green sustainable energy. He was also made the headlines recently. You guys have seen that he started something called Draper University for Heroes, which would be the first educational institution that would accept Bitcoin for tuition payments. And in early 2014, Draper also invested in the Bitcoin trading platform Garza. And everyone pretty much knows Tim's leading story, which is the Silk Road situation with the FBI and the acquisition associated with that Silk Road, kind of the Silk Road bounty, if you want to call it, But that was one of the biggest and most, some say the most legitimizing, legitimized the value of Bitcoin, because if the U.S. government applied value to it and then they auctioned it off, they've appended that it is a very, very valuable resource, and as a result, it just provided more legitimacy to what we're doing at every level. All right. Next, we're going to have a round of applause for Josh Garza from Garza Miner. Earlier, Josh was up here early, just letting you guys get a feel for each other and talk to each other about everything associated with mining. Josh has been an amazing addition to the mining industry. As you know, that he started Garza Miner. I want to say what 2000 and about 5 months ago, but before it was called Garza Corporation. Okay, and it was an amazing story. Garza, for the most part, has come into the industry and, for every sake and purposes, has revolutionized the idea of what cloud mining has become. So I don't know how many people are Garza miners here. Yeah, Ashland fan. They don't got a Garza tattoo. Just checking. It's just like, somebody was like taking off his shirt. I was like, great, that's good. But for the most part, Josh Garza has been a serial entrepreneur. He's been effectively leading the industry when it comes to providing cutting-edge mining technology through Garza, and he's been one of the leading principal sponsors here for this particular show, and he's providing amazing insight on some of the different technologies that will be that'll be incorporated into the cloud mining world. And for our next person on our panel is Mr. Michael Turco. Okay, now Mike has been one of the most well-versed, well-spoken, well-connected individuals within the mining space. He was also one of the leading inventors of a little website called MarketWire, if I'm not mistaken. And for the most part, Mike has also been an advocate here in the crypto space, as well as starting a convention that some of you all have attended. It was called Coin Agenda. It ran prior to this convention. It was the last 2 days prior to starting Hashers United. And he also is a leading angel over at BitAngels Co., which is, for the most part, it is an angel investment platform where miners, as well as anybody within the Bitcoin space who has a crypto business, can actually pitch their ideas, pitch their company to angels who are interested in also reinvesting in the angel space. It's been an integral part to increasing a lot of bringing capital into the crypto space, so that way people can actually pursue their dreams and pursue their goals and actually get that funding that's necessary to actually become basically what they want to become for the most part. So without further ado, we're going to go ahead and get started with the first question, and it's not going to be anything too insane, but it's going to be extremely technical, extremely hard to be ready. All right. Okay, so with the most recent news, I assume some people here have gotten word that the Titan came out from KNC. I assume everybody here has a Titan right now. No, I'm just kidding. Look at all the heads that are shaking. So just like you guys, we've also ordered Titans. We've also had some issues. Some of us have not received it. Some of us might have received it, it wasn't working. And some people also have had similar situations with other mining companies. So our first question is, what do you all think will be the future of consumer protection for miners? Because miners have been disproportionately victimized so many times when it comes to expectations from mining companies, as well as the equipment, as well as the performance of the miners that will be that they've said that will be provided. And I just want to hear everyone's take on what we think the consumer protection rules will be.
Can I take that first? There's two things you didn't mention in my background. One is, in addition to starting BitAngels, which is now over 600 angel investors, we do demo days monthly, and through a distributed kind of go-to-meeting platform, and then we cash them. But when we had 20 companies present at Coin Agenda, I really saw a much deeper level of engagement, although we typically get, the percentage of investments we've been getting in the companies has been going up. Last month we did 6 presentations in a 2-hour period, and 4 of them got funding, which is like a much higher percentage, whereas it used to be, I think last year we did about 200 that we looked at. We did about 40 presentations, and I think we had like 12 funds. So percentage is going up, and I think it's because the quality of companies that we're screening is going up. But from Bid Angels, I then spun off another sort of next step in the infrastructure. Gil Pinchina, who's the #1 angel on AngelList, approached me and wanted to start a syndicate on AngelList just for Bitcoin investments. Because first of all, Gil's main syndicate has $4.5 million per deal that is available. They obviously choose which deals they want, but considering a typical deal that's in his syndicate might be raising $200,000 or $300,000, that's way too much capital in one thing. So he said, I'm going to go and split it into 20 different sectors. I want to do a big data one with, some rock star in big data. I want to do it in e-commerce, and then just, split the carry. And so he approached me and Nick Sullivan. Nick is the founder of ChangeTip, and he's, geeks on a plane. He's like, very deep technical, and obviously they're looking at me for identifying deal flow. So we've been active now for 8 weeks, and we already have $850,000. Which I think may be a record in terms of getting to the top 10. There are actually 3 of the top 11 syndicates on AngelList now are Bitcoin oriented. Brock Pierce, he's at $1 million, so Brock's a good friend, but he's been out a year, and I think we're going to pass him probably in a couple of weeks. And then Ben Davenport doesn't do exclusively Bitcoin, but does quite a bit, and he's #11. So it really shows the sort of interest in these deals. I actually came into Bitcoin from, I've been a serial entrepreneur, but it usually has to do with marketing, and then marketing got me into investments. I've run several PR agencies and a social media company over the last 20 years. And Transform PR is a company that I've been running for about a year now. And we became quickly the #1 PR firm in the Bitcoin space. We represent about 35 companies. I don't know if anybody else represents more than maybe 2. And KNC Miner was one of our first clients. So we've been representing them for about a year. And so you told me about the issues that they had. And so, late night my time, early morning their time, they responded to, we haven't put out any public statements, but basically they have found that when people are not getting the hashing speed, it's because of the pool they're in. And right now, Ghash is one of only 3 pools that can handle the speed. And I also think that they are, they're very modest people. I mean, like I have to really pound to get them to respond. They're getting better with the new marketing director and to respond to when, they're compared to Butterfoot Labs or something. Up until the Titan, which I'd say still shipped on time, but with an asterisk, they hit every single deadline, and very few mining companies have done that. The Titan, they did have some firmware problems, and they said they were going to ship by the end of this past quarter. So that was a week and a half ago. They did start shipping. They haven't finished shipping. They said they will be finished shipping within 2 weeks.
Okay, so just to narrow the question real quick, just in general, for miners, where do we see consumer protection rules headed? Protect them. If it was a car, and a car for whatever reason didn't perform the way we thought it would, we have so many consumer advocate groups that will go after that particular car company, whether it be Ford or Chevy. Tim, I'm going to go ahead and point it to you and ask your opinion.
So, not being a miner, I don't have a strong opinion. So I don't understand really the question too much. But my bio should include my son, because he started Boost, which is the incubator for Bitcoin, and he's had about 30 Bitcoin companies go through there, and they've averaged about $500,000 in funding as they've gone through. Almost everyone has gotten at least $300,000. But the consumer, I look at Bitcoin as like wide open spaces. I'm thinking, hey, we take our lumps as we go, we try to make this thing work, and because as soon as the regulators start getting involved, they put a cap on all the great things that we can do, and whether they're protecting you or protecting citizens or protecting the widows and orphans, they're going to get in the way of progress. And I believe that the U.S. benefited hugely from the internet, and they had a hands-off approach. They were scared of the internet, but they let it rip. And they're scared of Bitcoin now, and there's this like, what do we do? They should let it rip, because if they don't, well, I already know Singapore and Korea and Estonia all are saying, yeah, hey, Bitcoin, this is great. Let's let it rip. And if you're in one of those countries, you're going to be one of the beneficiaries of Bitcoin. If you're in the US and we have anything but a very light touch, I think we've got a real problem. And that can come from anybody who complains to Washington that they need regulation or protection or whatever. I think we need Bitcoin. Bitcoin is so valuable to all of us. It turns out the wealth of a society is tied to the speed at which the money moves through that society. Bitcoin moves money faster than anything we've got, and so we should be supporting this. We should be behind it, and we should let it go. We should let it rip.
I'm of the mind that we already have adequate consumer protections that are not specifically related to the category. So Butterfly Labs is a unique example. There are some other ones that also had scams, particularly in the cloud space, where it's very easy to pull a Ponzi scheme. If things go up, you return the early money. If it doesn't, you go out of business and keep what you have, because you never bought any mining equipment. That's always a danger, because unlike exchanges, where you're actually, Marshall mentioned that in our mining panel we had a Coin Agenda, it's very difficult to go and be able to actually do an audit trail on cloud mining, as opposed to, say, an exchange where you can verify where the wallets are. But so with KNC Miner, with their early Bitcoin miners, they had a period of time when they said they would give them a full refund. For the Titans, because it was like very new, and they didn't know what the price was going to be, they said this is no refund. They said it up front. If you didn't want it, if you didn't want to have something that would have a refund, then you shouldn't buy it. And they've been very good in terms of like returning defective products. They did have that issue with the Super Jupiters, which was sort of a very limited thing that people didn't want to wait longer for the Titans, for the Neptunes, when they were a little bit later than they thought they were going to be, but they still shipped within the time frame. And they actually gave a free Neptune because the hash rate had been going up so high. I don't know exactly what the final resolution is in terms of, other than giving new Titans for anything that has any problems. They'll continue to do that. But the problem in this industry saying, hey, you have the right to go and return anything that you don't want, is if the hash rate goes up, you just return everything, because it's not a good investment. It's like saying, I want to return my Facebook stock. It didn't perform the way I thought it would.
Okay. And Josh.
So my view is a little different. So I think all mining companies should allow for returns, and I think that all mining companies should accept credit cards, because our company's been at this for about 5 months. If you annualized our sales, it's a little over $100 million. So in the way of scale and size, I think that we've kind of stick with some of the larger companies. So I found that if we do right by our customers and we do a lot of the right things, we deliver on time and things like that, and generally customers don't want returns. But to answer your question very specifically, I think the best protection outside of future regulation that's coming is just companies competing with each other. As this thing grows, you see more and more companies kind of rise to the top because they treat customers differently. They behave in a way that allows them to grow and to scale. So from my, to answer your question, I think it's really about allowing companies to compete fairly and openly. And I think the market, as it always does, has a way of kind of shaking out the winners and losers. So I think we've already seen that happen.
And there were warning signals with Butterfly Labs for a long time. I mean, they had products that they shipped like a year late, right? And that's not just a little thing. And one of the founders had served jail time, so it was a fraudulent type thing. So it's like the warning signals were there, just like we were about cops. You have to do your due diligence as a company.
Yeah, I think definitely doing research. Like I'm amazed by how many miners do business with companies that they can't even find any information about the owner. Like, my previous industry, like you don't like the first thing you do is figure out who owns the company and do research on them. And there's companies in this space that you don't even know who the owner is. So if you can't kind of validate the history and the credibility of the leadership team or the executive team at that company, then I think that's a real big.
I think the unique thing of the ones where you can't identify the owner are ones that are trying to be kind of like dark, right? So in other words, there's a couple of exchanges where, they could disappear tomorrow. You don't know exactly BTCE, right? I mean, nobody knows who owns that. They think it's kind of Ukrainians operating in Bulgaria. They always have the best rates, and they've been good citizens so far, but man, they could disappear with everybody's funds tomorrow.
And you guys have really the control and influence because ultimately you send your money where you want, and with no other industry that could ever happen. I mean, you couldn't, you don't go buy a Tesla because you don't know that Elon's running. You know what I mean? Like every other industry, every other business, you know about who's leading and running the company. So I think in this industry, like many industries when they first start, there's just kind of a general lack of education, a lack of there's just this bad rush. I guess things calm down. And I think we're already seeing it now. Miners are giving their business to who they think deserves it most. So again, competition always has a natural way of sending businesses to the top.
Okay. What I'm going to do now is this little bit give and take. So everyone in the crowd, I'm sure, has got questions. I've had questions for a while about a variety of things within the market, as well as just in the space in general. So I'm going to let the audience ask us questions. We'll have about 2 minutes to answer each question, and then after 2 minutes is up, we'll go ahead and go to each person, and then we'll just continue to move on until we have exhausted the joy of our questions. 1 second. It's going to go. Thanks. Okay. And Bob here will be taking the mic to you if you have a question. So if you do have a question, go ahead and just raise your hand, and then got one.
Hi, my name is Lily. I'm a pool manager. Knowing who owns the company doesn't help. Mark Purples, we all know who he was, and Cox is gone. So, again, to the question of who provides consumer protection and how, there's got to be a balance. There has to be some regulation. There has to be some accountability to these companies. But even when we do know who the owner is and there is accountability, we still haven't seen a good resolution to the outcome.
Well, we knew who Mark Purples was, but we also knew that he was screwing up royally month after month after month. It's not just
stop thousands of people from using Cox.
Yeah, I mean, it's knowing who he is, knowing whether he's been behaving honorably, and the writing's on the wall for Cox for a long time. If you look at the history of all the crashes in the history of Bitcoin, Mt. Cox had their name written on about half of them.
Yeah, and I think that so you're right. So ultimately, as time goes on, there has to be more regulation and obviously legal regulation. So I think the point here is that we're saying that's like the first step. At least kind of the first flags are learning who owns the business. The other thing too is their history. I mean, it's unlikely that if you a guy who's running the business has a history of success in running companies and selling them, it's unlikely that he's going to choose that one to be the one that just generally if you work with VCs or angels and you generally don't want that kind of on your resume. You've done this a lot of times, so again, it's not foolproof. Nothing really is, but I think that we would find that the amount of companies that are doing those kinds of things would drastically decrease if miners as a whole, kind of took a look at those kinds of things first before they spent $1. So.
I think we're over-regulated as a society, but if they stole from you, it's theft. There is a law for that. All right.
All right, so does anyone have another question? Okay, so if we're going to go ahead and move on to another panel question real fast, and this is going to be more specifically for Josh. As we know that a lot of the miners here have gone through a variety of different segments of the mining community. They've either bought equipment, they later went ahead and moved over to cloud mining or what have you. What do you think the future is in mining in general? Do you think it's going to go more exclusively into the cloud side, or do you think there'll be a mixture of both hardware, software, or some kind of hybrid in the middle?
So I think that there's always going to be an element of both, because I think there just always will be. But I think, obviously, I think we all know that it's moving towards the cloud. There's levels of efficiency and scale, and you just can't achieve with an individual miner. But, from our perspective, we're really trying to move things more in a social kind of platform way, where, because we find that miners, when we built our platform, we found that just as important as an ROI, miners really enjoy talking to each other, they enjoy socializing, they enjoy trading with each other and things like that. So I think it's more than just cloud mining. It's looking for ways to innovate outside of just dropping some Bitcoin and watching it grow. And I think the same thing will happen there. We'll see companies kind of rise to the top and other companies that may not. And I think it's one of the questions I get asked the most, and actually I had this exact question before I got into this industry, is that why would a mining company sell hardware if they could make more money keeping it? I still don't feel like it's a really good answer for that. I know our company, especially when we started, we weren't really that interested in making money. We just I was more driven by some of the things that I saw wrong in the industry, and we kind of continued looking at things the same way. But we found that the more money we make miners, the more money they spend with us, and the more people they attract, and it kind of ultimately builds on itself and grows. So I think it's it's going to be in the cloud, and I think it's like many things that are in the cloud, there's a large social aspect of it. So I guess
I think that the economics in the beginning of, if we look at the history of mining, it started out in the early days where you could have, an old PC, that could barely even run Microsoft Office, could be spitting out 50 Bitcoins every other day because, you were before the first halving, and there weren't that many people out there, and of course they're only worth pennies. So you lost them on sticks and things like that. As the difficulties go from, as most of you know, the difficulty level, the brilliant algorithm was put in, took a year and a half to go from 1 to 2. And then it took only 1 month to go to 3, and then another month to go to 5, then another month to go to 8. It's over 30 billion today. Right. And so it's, and you get half as many Bitcoins. So it's over 60 billion times as hard to earn 1 Bitcoin as it was 3.5 years ago. So that's just staggering numbers that I don't know any other technological precedents for. So it's with the dawn of basics, and with the miners that have made Josh's company and KNC and Big Fury and Cointerra into like 100 million a year plus companies. They had to go in and put huge investments into these chips to be able to get to market on time, and for most of them it paid off. But if they were just doing that and saying, hey, we're going to do this, we're going to mine, and the fact that they're able to get pre-orders in to help fund that really helped economically. And you're able to go and price the miners at sort of about 90% of what the value of the anticipated return was going to be. Now that Bitcoin has crashed to a certain extent, all of a sudden the chip makers are saying, cost plus 15% maybe, instead of how much money can we get out of this gold mine. And I think that with the power requirements going up, you're going to have a lot more industrial miners. You're going to have a lot fewer home miners, other than there are going to be sort of a cottage industry for, like with KNC Miner, for example. I mean, their next generation is going to be too powerful when they get to the 14 nanometer chip for most people to be able to put it in their home. On the other hand, they're going to make these like minis, right? And they're going to be very popular in cold weather. You have a little mini Neptune that costs maybe $1,000 by then, and it's 5 or 10 terahash, and it also heats your home. And so your power requirements, if you're just running in the winter, and in the summer, actually, there's a lot of interesting little hacks you can do. I've got some Neptunes at home. It's great in the winter. In the summer, it's a problem because it's Las Vegas, right? And one of my clients was telling me just last night at the closing party for Coin Agenda, he's like, you have a 60,000 gallon swimming pool. Why don't you heat that with the miners? Here's how you do it. And cool the miners at the same time. I'm going to try that. So there's a lot of creative things, right? There's a lot of creative things you can do with miners. And oh, I got a plus one. And I think
We've got some Zeus miners if you want to heat your pool. So.
Yeah, so it's Vegas. I'm a big fan of Vegas because it's the one place in the country where you pay 0 state taxes, 0 corporate taxes, and you get an LA, New York lifestyle of Cleveland prices. So come to Vegas, guys.
All right, all right. Very good, very good, very good. All right, now we're going to jump a little bit to another question, and Tim, I'm going to start with you. Obviously, with Draper University for Euros, you all are one of the first universities to actually accept Bitcoin for tuition payments, and that's unique because the fact that you've really accepted cryptocurrency as having pure value for education, and you have, of course, ignited the minds of other universities around the world to do the exact same thing. But what other industries do you feel as though can benefit immensely from the adoption of cryptocurrency? More specifically, I want to say Bitcoin, but any cryptocurrency in general, instead of payment types.
So I think that generally Bitcoin will benefit all of us in lots of different ways, but the places where it is the most valuable are the places where the banks are getting their highest margin. And so that is credit cards, where the merchants are all going to be much happier now because they won't have to pay 2.5%. The company called Atlas allows you to swipe a card, and it acts just like a credit card, but you don't have to pay the credit card company. Similarly, a company called Snapcard allows you to do that all online without the credit card. So that 2.5% to 4% tends to be about half of what merchants get on their bottom line. So half of the profits, merchants should be able to almost double their profits by starting to use Bitcoin. Remittance is also a really great place for Bitcoin when if you send money to your mother in Mexico or in the Philippines or whatever, right now you're paying about 8-9% to Western Union to do that if you wire it. With Bitcoin, it's instantaneous and much cheaper. And then with foreign currency translations, there are a lot of hidden costs. You don't realize that when you convert dollars to euros, or dollars to yen, or yen to euros, whatever, how much you lose every time that transaction happens. And with Bitcoin, those transactions are going to be almost frictionless. So I think that there's some really interesting opportunities out there. So what you guys do, all this mining and bringing these new currencies into the forefront, really is doing amazing things for all of us, for all of our society. And so keep up the good work there. The other thing is that you can almost look at Bitcoin the way, let's say, the internet completely changed the way media works, and it completely changed the way information works, and completely changed the way communications work. And all of those those industries were kind of oligopolies before the internet came along. And now it's spread out to the masses. It's democratized, I guess. Bitcoin is really doing that same thing for everything you might hear called a banking service, an investment banking service. We're actually thinking of using smart contracts for venture capital now. I'm starting to think about using smart contracts to do my venture deals. This could completely transform and democratize anything that has to do with commerce, finance, anything that has to do with money and contracts. So we are going to probably be able to disintermediate the lawyer and the accountant fairly easily through this too. There's something called network accounting. If I sell you something, normally we each have to do our own accounting. But if I sell you something and we're using network accounting, both of our accounts, our ledgers get updated. And so then we don't have to do that anymore. And so our accounting costs will go way down. And with smart contracts, you can actually make a contract for an event that happens, whatever that event is. Anything from a bet to a estate planning program or a company being bought. Any of these things where there's an event, a smart contract can operate and everything happens automatically, and we don't have to go through and talk to a bunch of lawyers and accountants to figure out who gets what, because it just happens. This is really transformative, and that's why I've made the big bet I have on Bitcoin. We've got the Boost Incubator. Draper Associates is making a ton of these small investments in companies. We're seeing 500 or 600 companies as of last month. There are probably 1,000 now that are building an infrastructure around Bitcoin. I wanted to say one thing about the price of Bitcoin. You miners, by the way, are driving the price down because you mine and then you turn it into dollars. And you're the only one, you're a forced selling component. There's nobody buying. Well, as these companies evolve and as all of these businesses allow us to use Bitcoin for more and more purposes, that will be what drives the price up. So for a while, you're going to be driving the price down, and at some point it's going to jump up because we're going to have so many companies out there driving the price back up. So I predicted $10,000 in 3 years for a Bitcoin, and I'm thinking I might have been too conservative with that.
All right, Mike. So I'm going to disagree with you on 2 points. We have to keep this lively, right? I think that merchant adoption is the necessary evil that will make more than the 2 to 5 million people who have Bitcoin today have Bitcoin. But in the short term, it's what's driving it down. Okay, we have a lot of miners in the room, right? And a lot of you guys have been around for a long time. Put your hands up if you sell 100% of your Bitcoins that you mine. Please put your hands up. Not a single one, exactly. One. Put your hands up if you sell 90% of your Bitcoins for cash. Put your hands up if you sell less than half of your Bitcoins for cash. Less than half. Put your hands up if you sell none of your Bitcoins for cash. See? Now, if I had merchants in the room and I said, how many of you sell 100%, it would be 95% of the room. And here's the reason why. Miners get it. They got into mining because they see the potential. Merchants, by and large, have been something like 100,000 added in the last year, which is great. There was only 2 years ago, all you could do is buy alpaca socks. But it was just like the early days of the internet when there was a place in Pasadena that sold hot sauce called hothot.com, and that was considered to be like an example of how e-commerce could work. Who remembers hothot.com anymore? I mean, now everybody's on the internet. Everybody's using e-commerce. And that was back when Macy's and everybody said, we never go on the internet, it's not safe, et cetera, et cetera. So right now the big problem is that you have the big players. Coinbase, 35 million in funding, 30 million with Fairly Fresh. BitPay, 30 plus million, seems to be the magic number for these kind of companies. GoCoin, which I'm an investor in, has also gotten some funds on a smaller level. They've all just integrated with PayPal. What do they do with that money? By and large, they're hiring sales reps. And the sales reps are going, and the business development people are going to companies big and small. Coinbase in particular has been going to really big companies. They go to Expedia, they go to Dell. And you know what their pitch is? How would you like free money? They're not saying Bitcoin is going to change the world, it's going to be $10,000, so hold on to it. No, they're salespeople, they're coin operating, right? They're going and they're saying, how would you like free money? There are these crazy Bitcoin people who want to spend their Bitcoins. It's not easy to do that. You're going to get 5% more sales and pay nothing on it, no return, sign here, free money. And that's why they're doing 100%. At some point when the price goes up, they're going to say, you know, maybe I should like follow the overstock model, only keep 90%, or maybe keep half of my profit ratio, depending on what my profit margin is. It's going to be higher in, like, you know, in commercial products or in media than it is in, say, retail. But they're going after retailers for the most part, people with low price margins. They're saying turn it all into cash, and that's a net drain on the system. So that, I think, is the number one thing that's depressing the value. I'm okay with that. I think it's going to be $10,000 Bitcoins. I think it's going to be 5 years, because I think that we still have a couple of things. Now, a couple of things can move it up. And I said, I speak at pretty much all the major trade shows in Bitcoin in the world, because I'm kind of like the guy that runs the investor panels. And then I decided to start my own conference that just concluded. And I said at the start of this year that there were 3 things that were really keeping Bitcoin back from being bigger, and they needed to happen by the end of the year. None of them have happened. I said, number one, and this is the one that we're closest to, because I like what Atlas is doing. There's about 5 or 6 other companies. Almost every company has said, we have a piece of plastic that you can put Bitcoin on in one side and take cash out on the other, and it will work in the United States. We had a client, we announced it, got on the front page of the Wall Street Journal, and they never shipped. And they never got the regulation. And the banks pulled out. And so I think the solutions are probably going to be getting around banks, getting onto the Stripe somehow through other ways. And I believe that hopefully will happen by the end of this year, but it hasn't happened yet. Atlas is certainly one of the ones that's very close, and so are FreshPay, and so are a couple of other companies like that. That will be, that will mean that these sales reps don't have to go so hard after making merchants convert, because you can go and use your Bitcoins to buy anything, like you can with gift, right? At 200 retails. A client of ours just got sold the first data for $80 million. That's number one. Number 2 was a fully compliant American exchange. You can't buy Bitcoins in the US very easily. If you tell grandma or a family office, hey, go buy Bitcoin. So I've been friends with the head of the New York Angels, Brian Cohen, and his wife was curious about Bitcoin. She said, I'd like to buy Bitcoins. How can I do it? And I said, well, it's not that easy to answer. And I gave her all the different ways. I said Coinbase first, because that seemed to be sort of, the training wheels wallet, right? And she goes, I tried that, and they really want so much information, and I heard that you can get your bank account shut down because you do too many ACH transfers. I go, that has happened. And she's like, I don't want that one. And then, by the time you start explaining, how to secure your wallet, blockchain.info, and get your anti-key logging software and do your 128-character password, and you can then encrypt that, and then you have to do that. They're like, whoa, that just doesn't make any sense at all. And so we need to find easier ways. And an American exchange, Circle is probably getting closer, but we're just not there yet. And it's this kind of collusion between the banks and the regulators to just sort of push it further down the road. And so instead of New York or Silicon Valley, what's the world finance capital for Bitcoin? It's Slovenia, because they let Bitstamp survive, even though their VCs are in San Francisco, right? So it's crazy. So those are 2 huge things. And then the third one that I think is going to start the drive toward 10,000 is going to be a public company that is going to allow the institutions that can't buy Bitcoin right now buy their charter, but they can buy Coinbase as a public company, and they can buy the Winklevoss fund as a public company. And those are things that if they succeed, they get more investment, they have to buy more Bitcoins, and that means that's going to counter and perhaps exceed the amount they're going out of the system from the merchant side.
So, I mean, couldn't have said a lot of those points better. So, I mean, I think that miners are, it's pretty funny when you're asking that. Our platform, we've got a lot of miners in it, and they believe in the currency the most, more than anyone else. And so I think they're the #1 drivers of creating more value in the currency. And I definitely agree with the point. I mean, I think that merchants are necessary, and I think that's what you're saying. I mean, they're kind of a necessary I'm going to go as far as saying evil, but a necessary part of this. But you know, we made a commitment to we keep every Bitcoin we're ever paid in Bitcoin, and you know, the last couple of weeks, I've had someone in my office almost every day saying, you know, dumping a ton of these things, and we've lost millions and millions and millions of dollars, you know, taking it on the ride down. But I just believe that that you can't just believe in something, you know, on the ride up. You know, you have to take it both directions. And I think that that you know, if it's something that we're going to, you know, like we're going to create revenue around, we're going to, you know, build a business around it. You know, we have to believe in it. And you know, it can't be schemes or gimmicks. You know, it's got to be real. You know, companies need to use their Bitcoin to drive other vendors to accept it. That's one thing we've done. We try to force all of our vendors, and at our scale, you know, we're usually able. I'll quite literally call a vendor and say, if you don't accept our Bitcoins, we just won't do business with you. And you know, sometimes they say no, and then the next day they call back and they're like, hey, we got a new blockchain address. But they want to do business with us. So I think that you know, again, I think the power really is in the miners. I mean, you guys have to demand companies do things like that. You know, demand companies, you know, to tell you, you know, what of their Bitcoins, you know, incoming transactions, do they keep in Bitcoins? I mean, you guys can figure all this out, I'm sure, but you know, demand companies to show you information like that. And again, if you only support the companies that are doing things like that, guess what? The other companies won't make any money and they'll go out of business, and that'll drive the value of Bitcoins up as a whole.
So I've never sold a Bitcoin, but I bought things with Bitcoin. And I think that's the responsible way of actually moderating your risk, right? So I'm much happier buying things with my Bitcoins when I think they're above. I mean, when it was over 1,000 and the 10x a year price curve said it should only be a little over 100, I knew it was a little bit frothy. And so, you know, I spent 40 grand on miners, but they were $1,000 coins. And if they've just been sitting in there, so, you know, I figure my break even on the miners that I bought, you know, is based on a coin to coin basis. I'm pretty much there now, about 90% there. And, you know, it's not quite dead yet in terms of, you know, what I'm getting out of them. So, I'm sorry?
And the future pool.
And they're hopefully going to feed that pool. I haven't quite hooked that up yet. Maybe they will also warm the house. But, no,
So Mike, you said that it was the merchants that are selling their Bitcoin, but it turns out that it's the miners that started with Bitcoin, and then they did what you did. They bought something from a merchant who then sold. So in effect, I get the idea, but that is the transfer that drives the price down. A miner buys something through a merchant, the merchant sells the Bitcoin.
I haven't sold any, I haven't bought anything with what I've mined. I've bought stuff with the fees I take for PR. So I have a business to run, and my wife says, you know, hey, you can keep as many Bitcoins as you want as long as you're running the business at profit. So I have to turn some of them in there. I
think the thing you did hit on, which I think is absolutely right, is the friction. I mean, when you're an engineer, you kind of go, oh yeah, I can do that. That's easy. I just do these 15 steps. But if you are a grandmother of somebody and you're not an engineer and you're saying, what is this Bitcoin? You know, it's not worth saving 2% on my credit card bill in order to use this thing if it's not just a snap. So getting sort of a Steve Jobs mindset into the one button to Bitcoin will be magic for our industry. That's fabulous.
I don't believe there's any
focus on ease of use.
I don't believe there's any particular killer app right now other than investment for Americans who have a bank account on Bitcoin. But if you don't have a bank account in the U.S., and if you're one of the 2.5 billion in the rest of the world that doesn't have a bank account, that's where you're going to get the massive consumer adoption when they figure out that they have a mobile phone and they can have all the access to the world financial systems that they don't have now. And I think what's going to happen is it'll be country to country. It'll be Kenya because they're already used to doing it with cell phone minutes. They can see that they have much more flexibility using Bitcoin. And it'll be places like Venezuela where people are trying to get their money out, in Argentina. And Cyprus was one of the biggest run-ups because they're like freezing bank accounts. They're like, how the hell do I get my wealth out of the country? And I think those are your big jumping points where you all of a sudden have the price of Bitcoin double because of that activity. Because Venezuelan Bitcoin affects the world supply, right? It's not like it's and that will then mean that American investors say, oh, there's momentum going. And the one thing that I've noticed about Bitcoin price that I can say is almost absolute is price goes up because the price goes up, and price goes down because the price goes down.
Okay, now, Mike, you must have read my mind, because the next question I actually had was, you guys know about the world's largest consumer class, which is the world's bank, which you just touched on. I'm going to address Josh as well as Tim regarding what do you think will happen in general to the price of Bitcoin if just the majority of the world's unbanked will be able to were placed on Bitcoin as their primary payment processing versus the cash economy that they're in now. Sorry, with Josh.
Okay, I think they, first of all, they will be more confident in their currency. So they'll be more confident in Bitcoin. As volatile as it is, if you're in Argentina, you know your peso is going down. With Bitcoin, it could go up, it could go down. That's a better bet. and if you're in India, wherever they're printing money, you know that they're inflating way too high, and you know that your currency is going down. Argentina right now, I mean, if they can retain 50% of their value in a year, they're just elated, and you can't short it. I mean, you can't hedge it. You're in really tough shape there. So I actually believe, well, first of all, in that scenario, I mean, it's just a matter of how do we get Bitcoin to all those people? So we need some way of making it easy. So smartphone is the best way to do this, all those people. And then, I mean, Bitcoin benefits generally goes up as it is spread throughout the world and as it is used more, and because it becomes a currency of real value. And so I think I think that's probably one of the 3 or 4 main targets to make Bitcoin more.
Josh, before you answer, I'm going to modify your question slightly, because uniquely you have a product that's
making money really, really simple. And it was really tough to decide that, because a lot of our customers, especially at that time, didn't like that. they wanted things to stay more technical and for us to show whatever, block this or that, and I just knew that, like, we can't keep selling to the same customer base over and over and over and over again and expect to be in business for us. So, we chose the path of focusing on, broadening the customer base, because having sold companies before, that's what creates value, obviously, is a large customer base. So, so I think as companies to continue to innovate, you will see exactly what you're talking about. Mobile apps that, they don't take, 10 minutes or 15 minutes. I mean, they take seconds, for confirmations to happen and money to transfer between each other. So, we're working on different things that I think will help with that. But I think, collectively, again, it's like every other industry, eventually those kinds of companies will rise to the top. We'll see that become a lot more common. So,
I think one of the easier on-ramps while governments are sorting out how they want to deal with exchanges and this whole KYC, AML, which, if the governments really care that much about stopping drug laundering and terrorism and everything, they would outlaw the $100 bill. How many people actually have use for $100 bills? Right? There's something like 1 trillion of them in circulation, and most of them are not used for anything other than criminal activity.
Or Vegas.
There's a lot of $100 too. But for the most part, what's interesting is that if you go in and if you buy a piece of hardware, usually in most places in the world, you're not asked to fill out all this KYC, AML. And if you're, that's one of certainly the fastest ways that people are able to generate Bitcoin wealth in China is to be able to go and buy. Okay, I'm sorry about these Benjamins. Yeah.
I think there are other uses for a $100 bill.
But there's not many Tim Drapers around me. I was circulation. You're one of the one for the sun, the one for the sun. So. And yes, I'm feeling all the pockets of all of Vegas.
I got Bitcoin in my pocket.
We're going to go to the spell unless we have any questions, but we're up for some quick questions before we end it. Actually, Buck, you want to stand up front?
I can probably yell about it. This is all good, the things you can control, but what about the things you can't control, like China? They have the ability to pump it up and to bring it back down. I mean, what do you do with that situation when you're dealing with OKCoin and BTC China? What do you do? I mean, they're the ones that are kind of pumping this up right now, it seems to me. I mean, they're buying so much Bitcoin, nobody can keep up with it.
I think there's a good thing that people are buying Bitcoin. I'm friends with Bobby Lee. I think he's been doing great stuff. Obviously they always have to fight kind of the winds of opinion in the Chinese government. Yes, we'll give you a special economic zone in Shanghai. Oh, but we're not going to let you do anything that looks like banking. Yes, we're going to do this. And I mean, that was part of the ups and downs, just sort of rumors about this. And I think that doesn't affect price anymore because they're just like, okay, China's going to be schizophrenic, and yet there's a lot of mining activity going in there, and people are having Bitcoins. But I think for the most part, Bitcoin is at the moment a relatively unregulated commodity market, like fine wine, like art, that has got, this last weekend we had a wall of 30,000 Bitcoins that scared the crap out of people and was really put in there to drop the price. And the real-time communication that came to have people watching the eating of the wall and don't panic and this and that did not happen a year ago. So I think that a lot of the market manipulation that some of the whales are trying to do is less effective, and it will continue to be less effective as more people get into Bitcoin. And some of the tools that we have now, I mean, one of Tim's portfolio companies, Hedgie, presented at a Coin Agenda. We also had ETCSX giving a demo. We had Tony Bays explaining all the economics of trading. And, right now, the family offices just hear of Bitcoin as, gee, that thing that I thought was hot last year, I'm glad I didn't get it because it really dropped. They're going to get it in again, but it has to be explained better. That's one of the real things that we want to do with Coin Agenda.
And we have one last question.
Yeah, this is specifically for Tim. I am a veteran, and I work with the Warrior Project a lot in Texas. I was wondering, at Draper University, do you have any intention to accept a GI Bill? I know a lot of veterans that really want to get into it, just don't have the technical know-how or the business sense or anything, and they are looking for a college, an education in this system.
God, that is a great idea. We here's one possible hitch. When we started Draper University of Heroes, I went to my lawyer and I said, okay, well, what do we do? And he started to make this list of things, and I was starting to think, oh boy, I'm never going to do this. And then he started talking about accreditation, and I said, well, wait a second, what if I'm not accredited? And he said, oh, well, then you don't have to do any of that stuff. And I started to think, okay, the accreditation was going to stick me in a box. I was going to have to look like every single other university. And I decided that at Draper University of Heroes, we wanted to be very different. We wanted to break all those traditions. We wanted to try new things and get people going. I think it's a perfect fit for the military. Perfect fit. I believe if we took any, now I'm going to look into this because it's a good idea, but if we took any government money, they would say, well, then you have to be accredited. And then you'd have that little carrot dangling in front of you all the time. And then they would say, well, you have to have, you know, your professors have to be, you know, accredited, and we're doing everything differently. We have everything. I mean, we instead of a professor, we have 50 speakers that come in an 8-week period. We have survival training, which I don't think is a part of the accreditation process. Military, you know, it's interesting. A lot of special forces guys are driving that little piece. We're team-based. We look at the A and we say that just means you didn't make any mistakes. And we are encouraging mistakes. We're encouraging trying things, failing, trying, and succeeding. And we're team-based, which is also a good part of the military. I mean, you guys have gotten a lot of the training that I give out. But the benefit you could get probably is the online school, because that allows everybody to at least get the benefit of all the speakers, some of the activities. Like we do some crazy activities, but there's method to our madness. So thanks for asking. It's a good idea, and I'm going to try to figure out if we can.
One last caveat, just to throw it at you. Wounded Warrior Project is very, very good at working with everything and anything. So if maybe you wanted to push it out as a free service to a select few individuals, I know that they would probably work with you and create a long-term thing that might make more profitability in the long run. But and if you want to get with me, please get with me.
It's a good idea. Just so anybody who wants to, I'm Tim at draper.vc. So anybody who's got a startup, wants to do something, send me a Bitcoin. And then.
Last words for the audience.
Just thank you again for you guys coming out and challenging us and continue to do that. I just want to thank both of you guys for being on this panel as well. It's a privilege to be here with you guys. So thank you.
Yeah, as a panelist, I learned more than I did. Sorry about that, but I did learn more than I did.
So just the final words.
The mining community should be very proud of itself. You are what drives Bitcoin, and that drives the entire digital currency economy. And keep doing what you're doing. And I think that there's some initiatives that I think that could come. For example, we're talking about keeping things in the system. When we have some of these merchants for merchants display on their sites saying we take Bitcoin, but we take Bitcoin and we keep it. And that would be even more valuable than saying that we take Bitcoin. And I think that that there's a lot of innovation coming up in mining, and I always explain to people what the revolution is in terms of Bitcoin, and I put it in 2 sentences. It allows you to make your own money and be your own bank. And the make your own money part, really, pre-Federal Reserve, people did make their own money. They killed animals and had footballs. They this myth that the government has always controlled 100% of the money supply since like the time of Jesus Christ. This was not true. So I'm very proud of the community and the miners of the heart and soul of it.
I'm going to ask you guys, thank you so much for coming up. And at this time, I'm going to ask one of our also our speakers, Marco Strong from Justice Minds, to come on stage. And he's going to actually put on a little solution spotlight for here for the miners to walk. Marco?
Thank you very much. Hello, everybody. A few words. I gotta say that I'm really proud to be here, and I can just a word about the mining itself. When I remember a year ago, when I was in a mining conference, when I was at a Bitcoin conference, I looked at the panel, and unfortunately, there were only some very few guys sitting there watching and hearing closely what was said. But the community itself and the people who were interested in mining grew since then enormously. And now we're having a private, separate conference only about mining. I think this is a real nice sign that this market is growing and evolving, and I'm really happy to be a part of this. And as you might know, Genesis Mining was one of the first large-scale cloud mining provider that offered solution. And we started with script algorithm. That's the algorithm where you can mine alternative currencies like Lifeboat and Dogecoin and others. And we evolved also. We grew very quick within the last year, and we offered a solution to mine as a cloud solution to mine alternative currencies in the cloud. And also we offered a solution to mine over altcoins with a trading bot in the back to mine effectively Bitcoin. This was a key product over the time, and now we are going to come to the next stage, into the next level. And I'm really proud to introduce our new product and our new project called Project X. And within this project, we will be able to switch not only between alternative currencies, we will also be able to switch between algorithms. You will be able to purchase a product and then decide and switch between SHA, script, and X11. So you can, for example, say on the one day you will mine SHA, and the other day you would like to mine script, or you would like to mine X11, which is a new evolving algorithm that has also high potential in this market. And not only that, you can also say, I want to spread 10%, and want to mine 10% SHA, 20% script, and 70% X11, and you can play with this. I think it's a key solution, and I'm really happy to show you the video for it. Thank you. I think the sound is good. Okay, I think we have a small problem with the sound. Thank you very much for watching. I think you mentioned that maybe some questions are appearing now. We are having a booth at the front directly. Everybody who's curious, feel free to go there and ask questions. We are starting the limited pre-order for this project very soon. Thank you very much and enjoy the content. All right, guys. Thanks, Marco. We're going to take like a quick, maybe 10-15 minute break, and then we'll go ahead and kick it off with the next session.
Yeah. I'm not worried about that. Yeah. I prefer not to. You can see there's cameras in there. Almost 120 players. Oh yeah, I gotta.
How much? Did you get my text this morning?
No.
How much can you sell that tonight? I'll take it all.
Well, I have quite a bit. The problem is we have to keep it kind of legit.
No, it'll be 100%. We just run into an MSP. I'll have Leo send you the contract. How much?
I guess I gotta find out. Because I ran into a lot of issues.
No.
I sold 70 BTC in December. About because it adjusts
my. So we just bought 1,000 through a government person, and it was all legit. IRS was like, "Yep." So Leo will. That's a bitch.
Huh?
That's a bitch. Leo will he'll make it all.
Be pretty nice. You guys
Are you still streaming?
Yeah, it's still streaming, but I need to fix this audio because they're complaining that. I think what's going on is that this line in works so when I use sound recorder, but it's using the camera's audio, and it's very hollow too. Test. How's this audio now, guys? This is a test of line in. Test of line in audio. Excellent. Test of line in audio. Test of line in audio. If you guys can hear this through the stream, let me know. Yeah, we're on. We reviewed a lot of stuff. Maybe about like the case that I said guys yet. Blizzard X3 and a ton of new stuff. 18 and a lot of stuff. We built a lot of the team that we put together. We're excited. We're really yeah, no marketing, so we jazz it up, make it really nice. Put together stuff. No, I with all the 3D graphics together, the new model. So yeah, we put these little things together. Real high-end sharp stuff. It's really jazzed up. It needs a good market. That's one thing that accomplishes. A lot of these things don't happen with that type of marketing. Yeah, absolutely. Yeah, get out there, get the message out for people and to engage and want to be more engaged, right? So you put together stuff like this, like all high school video, just do that traditional marketing video campaign. I've done all kinds of pricing game, market analysis, and then I got into sales marketing, account manager. So I was all kind of around. Now we're more chain related stuff. I'm not kind of so it's all yeah. Programming a lot of the interaction with the corporate suppliers, shippers, all those web portals and stuff. My team. This was a side project because I've been doing big things since 2009. I was in there really early, so I have a pretty good sense. I did pretty well. So I'm setting a nice little chunk. So it's like, how can I give back to the community? So what's most important? And I'm like, I said that 80 guys over for sell 7 minutes, got the capital. I see most of our get it, map out the price card, just run, leave me in a for us, stuff I got sound, all the audio factors,
I think I was good. I think you guys. You know what I think Rose I think that if it I think and then if oh right, oh yes. I did that, yeah. I just need to say something and then so don't forget. No doubt. I know, but I'll show you in a moment.
Okay.
Yeah, well, that's good.
Hi. Howdy. Good. David.
It wasn't really, but it was about quick. Yeah. No, I mean it was a good, not really. Yeah, it was really good. So we're going to the session starts in 5 minutes. Okay. Are you happy with that?
Yeah, no, it's it's getting enough down for you to ask me some
It's coming. I swear that yeah. See all the visuals. That's next one. We did it.
We haven't actually. We were thinking about looking out.
That was great. We haven't got any more now. So we have one now. Maybe I mean, bring it out after this. It's just not. It wasn't okay. It's just like I try to get. It's like it's really trying to get real problems. Somebody called and asked about a mixer DJ. All right. Those are people shots for you, you know. I would think that means, you know, so I'm going to do that. Stay on the screenshots. Watch the actual interfaces. We'll highlight the things. Right. So, David, I have here. You're going to be so David, broke it all down, spreadsheet style, highlighted everything, kind of shaped. Yeah, I've got it here. So if you want to go here, I'll show you. My main job is project manager. So I just so you can just click on that one.
Interesting. I think this might be stale since it's a local file. Is this on the network?
No, it's from my local file.
Okay. Let me. I can copy it over then. Looks like kind of is there HTML on it?
Yeah, I take it out because I was given stuff.
No worries. All right, let me just email it.
You emailed the link.
It doesn't matter. Because I updated the slides.
Okay, then. You don't have to go anyway.
Oh, yeah. I'll update it.
Okay.
All right, let's get it popping.
No, we've got 5 minutes. Okay, we've got 5 minutes.
You know, I think it was just trying to make
Where's
yeah, just basically, what is it? Does it work? Does it not work? Theme song. It's all kind of music. We had actually a theme song. Oh yeah. Done some.
Yeah, for mobile park.
People come asking.
Yeah, no, yeah. One second. I just want to make sure we've got everything for the next half. Don't do it yet. So, don't do it yet.
Tell people start coming in.
All right, okay.
All right, we're gonna go ahead and kick off our next round of sessions. If you guys want to start filing in here, we'll get it underway in about 5 minutes.
So I'm gonna come and Hass is I'll find him. So I'm gonna come when Jake finishes now, just to make sure that Hass is okay, right, so that is ready. It'll go to sleep in a minute, so we'll get it. What's that mean? Oh, it has to move in. I mean, it has to either you come and sit up there, so that he's just here, and then so Jake's gonna be here. Do you sit like here, and then has to sit?
And then when I announce it, I just come up here, or I just speak.
You can do it from there.
Yeah. We're going to get the next session going in about 2 minutes.
Off the squat, or somebody sitting there?
Go for it, go for it.
Next one seems interesting too. The one about the game theory. This one. Oh, that one.
Yeah. Game theory is one of my favorite. I was an econ major too.
Oh yeah.
University of Washington.
Oh yeah.
Yeah.
University of Washington is a really good econ program.
Yeah.
A lot of good statisticians and econometricians there. Did you know Nelson, Charles Nelson?
I'm really bad.
All right, so we're gonna go ahead and kick off this next panel here. It's with a guy that he's from where we're around about. That's Houston. Met this guy. We're working on a project for some airline revenue management stuff this summer, and he came up to me and he said, "Oh, what do you know about Bitcoin?" I said, "Sit down, brother. Let me tell you a little something." And we got to talking, and Jake he's a PhD candidate at the University of Houston, and he is probably one of the smartest people I know. He's got a lot of stuff to talk about exchanges, and he's actually got a white paper out right now that I encourage everybody to pick up. I think Chris is actually going to moderate this thing. So at the end, if you guys have questions or whatnot, feel free to don't hold back any hard questions for Jake. He's a smart guy. I'm sure he can handle it. So yeah, Jake, you want to introduce yourself a little bit?
Thank you. So as Marshall said, I'm an economist by trade. Closer. So yeah, I'll just speak up too. All right. So, okay. All right. So, maybe the technological or mining aspect. And so I'm working on this paper studying Bitcoin exchange rates. As I get into it, you'll see that in the econ literature, a lot of people have kind of written off Bitcoin because nobody knows what to make of it. And we just look at Bitcoin prices, as we all know, they're rather wonky, right? They don't always behave like we would expect them to. They don't behave like other currencies. And so this has caused a lot of people in the academic literature to write off Bitcoins and say, you know, it's too small of a market. We can't categorize it as anything we already know. So we're just going to write it off. Now, some of this stuff, because it's written for economists, some of this stuff, you know, it's going to seem very basic to people who know about Bitcoins, but some of this other stuff is going to seem very technical to non-economists. So I'll try to explain it as best I can and give some implications as how you as miners can use this research to, you know, make money even when, other than just making the Bitcoins, other than just mining the Bitcoins, what can you do once you have them, all right? So again, very basic. I have to explain this to professors, but what is a Bitcoin? So there's this nice paper by Ron and Shamir, which gives this concise definition. All right, Bitcoins are digital coins which are not issued by any government, bank, or organization and rely on cryptographic protocols and a distributed network of users to mint, store, and transfer, right? So we all know this. It's anonymous peer-to-peer transferability, quote unquote anonymous. It's not 100% anonymous. We're trying though. They're traded for currency as well as for goods and services. Now, what makes this interesting to an economist is that this is a currency that's non-fiat and non-commodity, right? So it's not issued by any government or bank. So it's not backed up by any government, but it's also not backed by a physical commodity. Right, so this makes it really hard for an economist to categorize and study. So that's what I want to do with my paper. So how do we categorize these Bitcoins? What I'm going to do in my paper, the innovation of my paper is I'm not going to look at Bitcoin prices themselves, but I'm going to look at relative Bitcoin prices. I'll tell you why I do that in a second. Right? So when you look at relative Bitcoin prices, what you get is what we call an implied exchange rate. So I'm going to look at these implied exchange rates and compare them to a conventional exchange rate that you would see traded on a regular Forex market. Right? When I look at these exchange rates, it's going to tell me something about Bitcoin prices. Right? These exchange rates can tell me how Bitcoin prices are moving. And I'm also going to ask, are Bitcoin prices predictable? So a little preview of the results of my paper is that implied and market rates are highly co-integrated. So what co-integrated means, that's a mathematical term, right? But what co-integrated means is that they're tied together. They want to move together, which is strange because everybody else who's looked at Bitcoin prices fly around, right? Seemingly uncorrelated with anything else. But when I look at them, when I put my little twist on it, you can see that these implied exchange rates and these market exchange rates move very closely together. What you also see is that innovations in the conventional market, right? So when there's a movement in the conventional market, we see big effects in the Bitcoin market, right? So when the dollar-pound exchange rate moves on the conventional market, you see huge effects on Bitcoin prices. But when you look at the flip side, say the Bitcoin price changes, right? That doesn't have any effect on the conventional market. So it's a one-way causality there. We see a rapid return to parity. So the Bitcoin implied exchange rate wants to pair up, wants to move back to the conventional exchange rate. Right? And an important finding of my research is that these exchange rate fluctuations, so the dollar-pound exchange rate, right, explains much of Bitcoin price volatility, almost 50% of the volatility in the Bitcoin prices. So yes, supply and demand plays a big role. There was a debate up here about that earlier. But almost 50% of Bitcoin price volatility is due to exchange rate volatility. So what this leads me to conclude is that Bitcoin behaves much more like a commodity money. It behaves much more like digital gold as opposed to a fiat currency, like a dollar or a pound. So some motivation for the paper. I got into this in December 2013 when a lot of economists were getting into it back when Bitcoin prices were over $1,300, right? So it's the most popular cryptocurrency and it's a sizable market. This has probably changed since I wrote this. But when I wrote this, there was about 6.4 billion in market cap and there were about $90 million in transactions a day. But when you compare that to dollar bills, you see that there are $11.4 trillion bills out there, and Visa alone processes $12 billion in transactions a day, right? So it's the most popular cryptocurrency, but we have to have some perspective on it. Okay? It's popular in the news and the blogs. It gets attention from serious computer scientists, right? But economists basically write it off. So there's really not a whole lot of academic work in the econ literature on Bitcoins, right? The one paper that really got me thinking was this paper by Yermak. This is also a working paper, hasn't been published yet. Bitcoin exchange rates. But what he was really looking at is the US, the dollar price of Bitcoins. Okay? So effectively what he was doing was he was assuming that Bitcoins are a fiat currency. Right? So when you look at the dollar price of Bitcoins and call that an exchange rate, you're assuming that Bitcoins behave more like a fiat currency. Right? And what he found is that Bitcoin has an exchange rate volatility in order of magnitude higher than the volatility of widely used currencies. Right? And that Bitcoin prices are uncorrelated with any other bona fide currency. So this paper got a lot of traction out there and led to a lot of economists just writing it off. Now that got my head thinking, or head scratching, like, why would we just write this off with this one paper? So my contribution is to not think of Bitcoins as a fiat currency, but try to think of them as a commodity, right? Even though they're not backed by anything, right, which might lead you to think they're more of a fiat currency, think of it more like a digital commodity. Think of it as digital gold. So if you think about a Bitcoin that way, right, the price of a Bitcoin is not an exchange rate, but an asset price. Just like the price of gold is not an exchange rate, it's an asset price. But if you look at the relative prices of assets, right? So if you look at the dollar price of gold divided by the euro price of gold, you're going to get an implied exchange rate. Okay? So I'm going to look at these implied exchange rates. Okay? I'm going to see how these implied exchange rates compare to these bona fide exchange rates. All right. So here's a breakdown of the data. So the first thing is I just collected Bitcoin prices off of Mt. Gox for the period 1st of September 2011 to 31 January 2014 before Mt. Gox imploded. So to calculate these implied exchange rates, you simply take the dollar price of Bitcoins and you divide it by the euro price of Bitcoins. And that's going to give you an implied dollar-euro exchange rate. I do that with the dollar-pound rate as well as the dollar Aussie dollar rate. I also do the same thing with gold prices. I look at the dollar price of gold and I look at the pound price of gold and I get an implied gold exchange rate. Okay. So if we just take a breakdown of the prices, you've all probably seen this before, right? Bitcoins were like a nickel for a number of years. Then we had what's widely believed to be a pump and dump scheme back in April of 2013, that little blip down there. And then we have this big run up at the end of 2013, right? So obviously, if you're going to look at this graph, and then you're going to look at graphs of other, the dollar pound rate, the dollar euro rate, you're going to look at this and say, what the hell is going on here? People in this market people in this market have no idea what's going on, right? It's a small market. They don't know what's going on. Forget about it. But if you add my little wrinkle to it and you look at those implied exchange rates, you think about Bitcoin as a commodity as opposed to a fiat currency, you get a graph that looks like this. Now, this is hard to see, but the blue line is the Bitcoin implied exchange rate. Okay? It's hard to see on this projector, but the blue line is the Bitcoin implied exchange rate. The green line is the market rate. So while it's true that Bitcoin exchange rates are more volatile, they follow directly the conventional market rate. This makes sense. It's harder to write off Bitcoins when you see a graph like this. So that was for the dollar-euro rate. If I look at the dollar-pound rate, I get the same type of thing. Right? Yes, Bitcoin exchange rates are more volatile, but they follow that conventional rate very closely. And this is the dollar Aussie. This is the dollar Aussie dollar rate. Same story. So what this is telling me is that there are some very sophisticated traders out there who are looking both at the conventional market and the Bitcoin market, and they're making trades to maximize these. So if we're just looking at the simple difference between the implied rate and the market rate, right, you can see it more closely. Now the blue line, again, is the Bitcoin spread. The red line is the gold spread. If you look at the implied exchange rate for gold versus the implied exchange rate for Bitcoins, this is the spread. So what this says is there are larger arbitrage opportunities. There are larger differences in the Bitcoin market than in the gold market. So if you guys out there want to start trading, the technology exists to take advantage of these arbitrage opportunities. See it also in the dollar-pound spread, right? There are a lot of people trading gold. There aren't a lot of people trading Bitcoins, right? When there's a lot of people trading gold, that spread is tiny. There's not a whole lot of arbitrage opportunity. But when there's not a lot of people trading Bitcoins, you get these larger arbitrage opportunities. Same thing with the dollar Aussie dollar spread. So now if we want to get into the mathematics behind it, we do what's called a Johansson test for co-integration. So I'm not going to get too technical into this, but what I'm doing is I'm mathematically testing for what I can see in these graphs, right? I'm just proving formally that these implied and market rates move together, right? And of course, just looking at the graph, you don't need a PhD in economics to see it, right? These implied and market rates are highly co-integrated. From there, what that implies is I have to fit a special kind of model, right? So I know that they're co-integrated, but now I want to describe this co-integration, right? How do they move together? For that, I have to fit what's called a vector error correction model, right? And what we see is that the co-integration is statistically significant, right? And we also see that the implied and market rates want to return to parity. So they want to meet each other. So if they're in equilibrium, right? So the market rate and the implied rate equal each other, and then one of them gets kicked out of equilibrium, one of them goes higher or lower, they want to reach each other. They want to move back to each other. That makes sense because there are these traders out there, right? They're making these trades from these arbitrage opportunities. That's going to affect the market price. So again, if the dollar-pound rate is up here in the implied market and it's down here in the conventional market, somebody's going to make a trade on that, which is going to drive them back together. Okay. Let's see. Also, what I see, if I want to quantify the effect on Bitcoin prices, right, I notice that when the conventional market gets kicked out of equilibrium with the implied market, right, Bitcoin prices have to do all of the adjusting. Right? The conventional market is so large, it doesn't care about the Bitcoin market. But the Bitcoin market is small, it cares a lot about the conventional market. So then when the conventional market moves, Bitcoin prices have to do all of the adjusting. Right? And that explains as much as 50% of the movement in Bitcoin prices. So while it's true that supply and demand, when we had this discussion up here earlier, right? While it's true that supply and demand have a large effect on Bitcoin, right? Most of it is because of people making these arbitrage trades. They're looking at the conventional market. When the conventional market moves, they're going to make their trades in the Bitcoin market of the price movement in the Bitcoin market. So what this graph is showing you is what happens to Bitcoin prices over time as I kick the conventional market, right? So initially they're in equilibrium, they're equal to each other, and then I kick the conventional market. Well, when I kick the conventional market, this is the effect on Bitcoin prices. right? So that was for the dollar-euro rate. This is called the impulse response function. I won't get in, but that's what's happening here. This is for the dollar-pound rate, same similar thing, right? When I kick the dollar-pound exchange rate in the conventional market, when I kick it out of equilibrium, Bitcoin prices are making this adjustment. Same thing with the dollar Aussie dollar rate. Now, say I'm in the Bitcoin market and the Bitcoin exchange rate moves for some reason, right? The Bitcoin implied exchange rate moves for some reason. There's no effect, right? There's nothing there. So for whatever reason, supply or demand or somebody does a pump and dump scheme, right? And the Bitcoin price moves, it has no effect on the conventional market, right? Because the conventional market is so much larger, everybody's in the conventional market. It doesn't care about the Bitcoin market. But the Bitcoin market cares a lot about the conventional market. Same thing if I look for the dollar-pound rate, right? There's nothing there. Or if I look at the dollar Aussie dollar rate, nothing there. So we have this one-way causality from the conventional market to the Bitcoin market, but not vice versa. So when you're trying to figure out why are there these huge jumps in Bitcoin prices, it's most likely because of the the floating exchange rate market. And this is not unique to Bitcoin, right? People have done this to explain gold price changes. Why are gold prices so volatile? Again, it's people making arbitrage trades. Why are oil prices so volatile? It's because people are making these arbitrage trades. So what we can conclude then is that Bitcoin is acting more like a commodity as opposed to a fiat currency, right? So to people in the Bitcoin industry, that might seem obvious, right? Bitcoin was designed to act like digital gold. But to economists who aren't in the Bitcoin market, that's novel, it's new. Okay. So then I ask, well then, is Bitcoin a commodity? So I just replicate this whole thing, but I'm looking at the gold rates. I'm looking at gold implied exchange rates. All right, so I'm looking at the dollar price of gold relative to the euro price of gold. Okay? The dollar price of gold relative to the pound price of gold. And what you see is the exact same thing. You're seeing that these gold implied exchange rates behave exactly like the Bitcoin implied exchange rates. Again, driving home the idea that we should think of Bitcoins not as a fiat currency, but as a commodity. That's how we should be dealing with them. And when you do this, when you look at Bitcoin like a commodity, you realize that it starts making a lot of sense. That there are people in the market, they know what they're doing. There are traders. This wouldn't happen if there weren't sophisticated traders out there making a lot of trades. Okay. So again, these are impulse response functions except for the gold market. When the floating exchange rate in the conventional market changes, gold prices have to adjust, right? But when there's a change in the gold price, there's no effect on the conventional market. So it's the same story. So in conclusion, right, relative Bitcoin prices are exchange rates. Bitcoin prices themselves are not exchange rates. Why? Because Bitcoins are not a fiat currency, they're a commodity money, right? They behave like a commodity. They don't behave like a fiat currency. So Yermak, this guy at NYU Business, right, he's incorrect. Bitcoin exchange rates are highly correlated with conventional currencies. Right? Innovations in the Bitcoin market, just to recapitulate, innovations in the Bitcoin market have no effect on the conventional market, but innovations in the conventional market have huge effects on the Bitcoin market. The Bitcoin market, Bitcoin prices have to do all of the adjusting. Right? There's this one-way causality which explains a significant portion of price volatility. And this mirrors the behavior of other physical assets, such as physical gold, oil, anything else, any other commodity traded in more than one currency. So I went through that fast because I knew there was going to be a lot of questions. So I didn't want to overwhelm you going into too much of the details. I kind of want to get the high-level stuff. So are there any questions about either the research or how you can use it, how you guys can apply it with your mining? Yes. Yeah.
The first thing is, which journal are you going to try to publish your stuff in?
Right. So the way academia, so the question was, which journal am I going to publish this in? So the working paper is available for download on the internet already. But the way it works in academia is you kind of have to shop it around. So one of the journals I'm looking at right now is the Journal of International Money and Credit. So I will keep, if you want to stay in contact, I'll keep you posted on when and if it gets published. Yeah. Uh-huh.
I've noticed some other staff that the price of Bitcoin, the direction of prices seem this year, especially since the spring, seems to go in the same direction as oil and gold. So when oil and gold went down, it seems like Bitcoin goes down, and then turning points. Is that something you're interested in following?
So a little bit, yes and no. So the question was, am I interested in maybe following how Bitcoin prices react to gold prices or oil prices, because they seem to move in the same direction? Well, the problem is that if you look at similar literature, which tries to predict gold prices based on oil prices, or tries to predict oil prices based on corn prices or something like that. The problem is, over and over since the 70s, you find that prices themselves are unpredictable. So this is controversial in the business side of things, but economists have known this since the 70s, that commodity prices are completely unpredictable. So when you're looking at CNBC and people are drawing these charts or trying to say, well, this price is going up over here, so this price is going to go up over here, it's complete BS. So I'm not really interested in trying to predict prices, because prices themselves are unpredictable. But when you do something like this, where there's some economic theory behind it, the economic theory is that, you know, there are arbitrage opportunities and people aren't going to leave those on the table. People are going to act on those, right? That's the economic theory. When you have some economic theory behind it, then you can start getting into predictability, right? So for me, you know, the guy who won the Nobel Prize in economics last year, that's what he did, was showing that asset prices are completely unpredictable. So for me, I'm not really interested in just prices. I'm more interested in things like this, like relative prices or other things like that. Yes. Right. Right. Uh-huh.
Do you foresee there being a transition from a commodity to a currency as the volatility theoretically should drop?
Right. So the question was, do I see a transition from Bitcoin acting more like a commodity to acting more like a fiat currency? The answer to that, I would say, is no. Because what determines whether it behaves like a fiat currency or commodity is the structure, is how Bitcoin was structured, right? It's structured from the ground up to, the key is that the supply of Bitcoins is determined by the effort of the miners, right? So if there are more miners mining, the growth of Bitcoins, the supply of Bitcoins is going to grow, right? Correct me. Okay. Okay. So, okay. Okay. So the bottom line, though, is that there's a stable supply of Bitcoins coming on the market, right? Right. So that is not like how a fiat currency is issued, right? The Federal Reserve puts cash on the market, takes cash off the market, depending on what it sees as economic circumstances, right? So I don't foresee Bitcoin starting to behave like a fiat currency in the future, right? I still see them, because of the way they're structured, because of the way they're built, I guess, right? Makes it seem more like a commodity, makes it seem more like an asset as opposed to a fiat currency. Okay. Am I out of time?
You can give more time.
Okay.
I had another question, actually. Like, have you seen the volatility decrease? Have you tracked any statistical data?
I haven't. Over the sample I was looking at, right, the volatility of the implied rates, right, appears to be relatively stable, right? If you remember looking at this graph, go back, right? So if you look at this graph, right, if you look at the arbitrage band, if you look at how wide the spread is, the spread appears to be relatively constant, right? That volatility, that spread appears to be relatively constant. Right. So the spread is going to be determined theoretically, right, by the technology devoted towards exploiting these arbitrage opportunities. So I can see it makes sense to me in the future that if more people are tuned into this type of arbitrage trading, that the spread might decrease. Because if you look at the gold spread, it's very tight. Why is it very tight? Because there are a lot of people in the market making those trades.
So would that just mean that there's not a lot of big money exploiting these to create a market efficiency?
That's what I would have to conclude, right? Is that there's just simply not enough people, or there's not enough of a profit motive for people to be making these trades, right? That's why this arbitrage band is rather constant.
Okay. So there's still a lot of opportunity to make money with that.
Yeah, there's still opportunity there, right? So to me, I look at this and say, well, if you can make money off of those tiny spreads with gold, why shouldn't you be able to make money off of these huge spreads with Bitcoin? Right? So that would be something more of a miner and a trader would have to look into, as opposed to me as an economist, right, running numbers.
Do we have any more questions?
Yes. Yeah. Right. Right. So the question was, has I looked into how what we call the money growth rate, so the supply of Bitcoins, how does that play into Bitcoin prices or into the market, right? Is that I haven't, but I would say that it seems to be a simple supply and demand thing, right? Obviously, the more Bitcoin you have, that's going to drive down the price. When we were having this discussion up here earlier, for me, I don't think it matters whether you keep it in your wallet or you trade it for $1 or you trade it for a good and service. As long as that Bitcoin exists, it's going to drive down the price, right? Higher supply means a lower price, all else equal. So maybe that could explain some of the trend we're seeing, right? Demand is staying relatively constant, but there's this constant supply that keeps coming, right? The supply keeps coming regardless of what the demand is doing. So that could explain this constant trend downward. Now, I think the important thing is if you want to drive, the supply is going to keep coming, right? If you want to drive the Bitcoin price itself up, you have to boost the demand side. So you have to get more people using Bitcoins, valuing Bitcoins, right? So I just see it as a simple supply and demand thing. If demand stays constant, but you keep pumping out more Bitcoins, regardless of if you keep them in your wallet or if you sell them or if you trade them, as long as they exist, it's going to drive down the price. So, yeah. 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 Uh-huh. Right. Right. I'm saying from my perspective as an economist, as long as the Bitcoin exists in a wallet somewhere, right, it's going to drive the price down, right? No, if you have a bar of physical gold, right, if I mint the gold, right, and I keep it in my vault, right, when the gold supply numbers come out to the market, they're going to take that into account, right? So regardless of whether or not, because it's always going to be sitting in a wallet somewhere, right? There's no reason why it shouldn't count unless it's spent, right? If you have it and then you send it to me, it's still in a wallet, right? So regardless of whether it's been spent or if it's been spent 1,000 times, right, the market's still going to account for that. It's going to show up in the price. That would be my take on it. Right. I wouldn't think so. Now, what that is going to do, if people are hoarding their Bitcoins, right? So people are hoarding their Bitcoins. what effectively you're doing is you're saying, I'm not going to sell until the price is up to this high. So you're just setting the market price, right? You're just setting the market price high because you want to hold them for whatever reason, right? Yes, if somebody tries to sell a whole bunch of Bitcoins, in order to do that, they're going to have to drive the market price down. But I'm saying that when you create a new Bitcoin, that gets priced in. Uh-huh. Right. Well, right. So again, think about when you create new gold. When you create new gold, that gets priced in. What was happening was he was trying to sell all of those, right? So if you want to sell a large supply of anything, you have to drive down the price if you want to sell it now, right? So that was happening there. There was a temporary increase in the amount of coins on the market, in effect. Okay, does that make sense?
As the market cap sort of increases, that won't have as big of an effect.
Right. So as the market gets larger, right? As the market gets larger, one person is not going to be able to manipulate the market. So that was another big criticism back, I think, last year, right? We saw this big blip, and I think it was about April of last year. It was a pump and dump scheme. All right. Somebody was trying to sap the market, and then they dumped it. Right? They drove up the price and they dumped it. But that won't happen when the market gets larger. Well, it'll be harder for it to happen.
Does that answer your question? Okay. Do you have any other questions? All right. Well, I'd like to thank you, Jake.
Thank you for having me. It was very nice to talk about my research.
All right. I'd like to introduce our next speaker, McCook. McCook is a chartered civil engineer who holds as bachelor and master's of engineering, as well as an MBA from Oxford. He's currently serving as an advisor for Lifeboat Foundation on their New Money Systems Advisory Board. His professional experience lies in the delivery, management, and financing of highly complex multi-billion-dollar civil infrastructure, which has lent him deep insights into risk management and competitive strategy. He's going to be speaking on the subject of competitive. All right, so we're going to get started. Pull up his presentation in 2 minutes.
Well, while we get set up, I'll give a bit of an intro. About to bombard you guys with a lot of info over the next half hour. We're going to have a look at basically the analysis of strategy in different ecosystems, specifically the legacy wealth ecosystem as well as the cryptocurrency ecosystem. We're going to have a look at the nature of competition within the legacy systems and within the crypto mining systems, and also give you a little bit of a crash course about some Bitcoin mining entrepreneurship and competitive strategy within the mining industry. So we'll just give the organizers a couple of minutes to pull the presentation up, and we'll get started. I think it's running out of juice as well. Yeah, I believe so. Okay. Yeah, Marshall, we need some technical assistance. It's running low on juice as well.
Cool. Presentation?
Yeah.
It's right here.
one. Yeah, it's just not opening. Cool.
What's that? Oh yeah. Uh-huh. Oh yeah, you should. A lot of people go from computer science to economics. You do all the math. You don't know how to make money out of it.
That's exactly right.
Yeah. Uh-huh. Okay. Yeah, for sure. I'm glad.
Maybe in a minute, so I'm having a problem. Pizza.
Just take a 5-minute break.
Yeah, it's now just shut off. I think it must have been held on.
All right, we're having a little bit of technical issues, so let's take a 5-minute break and we'll come back.
I just want to get my cable. I'm not sure if it's. Everything go right? All right, for yours?
Yeah.
Great.
I think so. People ask questions. It's good.
I don't really know what's going on. All right, okay, great. I'll do that at lunchtime. I'll just do the third of one. Okay, great.
And then we're still time-wise looking 140.
Yes. Right. I had the PowerPoint viewer. It's not I think there's something wrong with the PowerPoint viewer because when I try open it, it's not happening. Why that's it opened at this stage, but then I had a problem with Josh's presentation. It kept saying it can save a conversion, and I don't know why. Hi, I'm very well, thanks. How are you? I'm going to print out some more, so there will be some more available. Okay, yeah, it's been updated, so there'll be some more during lunch. There'll be some more available. A talk by McCook. There'll be a talk in a couple of minutes. In about 10 to 10 to. Okay, right. So, how do I do something myself? Oh yeah, jump in. Yeah, I think so. I have PowerPoint viewer, and everything's working, and then I have to put Josh's presentation this morning. It kept saying the converter can't save the file, but I don't know what that means. I'll have to check it each time what's going on. One thing is you know if there's any way you can make it a big screen? Another one might be better. So I have to just do a bigger screen. Right. I can't find them. Okay, alright, thanks. Yeah, no, they were in the corner. They were in the corner with the badges, but I don't know where. Yeah, I'll see if I can find them at lunchtime.
Shop around, it's not like
I'm having some problems with my mind. It's not but thanks anyway.
Rightfully so, though. Rightfully so.
No, well, I would do another thing because I'm having a PowerPoint viewer, but it's not opening files. So we're now just doing another.
Browser version of PowerPoint? That's nice.
If not, if you have a problem, you don't have PowerPoint loaded on this.
It has a PowerPoint viewer, but it's not opening the files.
So I've got a spare laptop. It's a real dog, but it will run PowerPoint. It won't pull anything off the net because it's so slow.
Yeah, but I just need to. Well, I think I might have this one. So, if I'm having problems with it at lunch, then yeah, got it.
You still have so much, right?
Yeah. Okay. Stop on the chart. We call that. Right. So. Okay, we're back. So you should be.
Yeah. Click on the arrows.
Oh,
the arrows work.
Oh yeah.
Yeah, they do. We'll do it live. It's okay.
All right, looks like we got the crosses loaded. Ready to go here. I'd like to reintroduce House McCook, advisor at Lifeboat Foundation.
So pleasure and an honor to be here. I'll add one extra thing to the intro. I'm also, in addition to being an advisor at the Lifeboat Foundation, I'm the Director of Education at the Bitcoin Association of Australia. So this talk will be quite educational, a bit of an academic slant, but also some practical tools that you know, entrepreneurs in the mining realm will be able to use. So without further ado, I'll get stuck right in. So first things first, being an MBA graduate, the first thing they teach you at business school in you know, sort of strategy 101 is what's known as the Porter's 5 forces, which as of late has been a 6th force added to that. So what the 5 forces are effectively are the forces within an industry that affect, you know, your profitability and the nature of competition. So when analyzing a market, there's 5 or 6 forces that we tend to look at. So the first force is the bargaining power of our suppliers. So how much power I'll explain this a little further with several examples. Second force is the bargaining power of our buyers. The threat of new entrants, or the barriers of entry we can set up to prevent new entrants from coming into a market. The threat of substitute products, and obviously the rivalry within the industry. Now, crypto is a interesting industry because it's open source. So open source industry. Another force you can look at is your collaborators and complementary products that sort of you can piggyback off, or they can piggyback off you, and you know, you can drive an industry forward. So the first thing we're going to have a look at is crypto's macroeconomic context and analyzing the legacy monetary system. So in the legacy monetary system, in just a simplified, summarized point of view, is you've got, you know, your fiat currencies, you've got your investment vehicles, and you've got your physical commodities. And this is what we're competing with as crypto miners. So you've got your currencies, you know, US dollar, euro. Your investment vehicles are, you know, provided by your investment banks, your ETF providers and whatnot. And your physical commodities are commodities that are mined by the big mining companies, oil companies, and whatnot. And rivalry within the industry is typically extremely fierce, and margins are quite low within the industry. So this is an analysis of the legacy monetary system. What we see is, first thing, the threat of new entrants is quite low. It's not very easy to create a new fiat currency or create a new mining company or create a new investment bank. So the threat of somebody entering your turf is quite low. What also assists with that is, you know, sort of regulatory capture and, you know, lobbyists and whatnot. Have the government on your side to help you sort of crowd out any possibility of new entrants. The second force is your supplier power. Your suppliers have quite a bit of power over you because, you know, obviously governments have lots of power. They have the use of military force. They have the use of regulations. You have a lot of collaborators in the space, which makes the legacy monetary system a lot more valuable. You've got, you know, your retail banks, your payment processors, and several other, you know, financial advisors, people that help you or that help the competitors push their products and add more value to products. Your bargaining power of buyers is quite low. As regular customers, we don't really have much of a choice in the currency we use, but we do have somewhat of a choice. I can choose to use euro or Australian dollars or pound or US dollar, but because the options are quite limited, our power is quite low. Because of all these forces, the threat of substitute products is quite extreme, actually, and we're seeing an invasion into the legacy turf by cryptocurrencies such as Bitcoin, Litecoin, Dogecoin, and all the other coins. So next up, we'll have a look at the crypto mining microeconomic context. So the threat of new entrants is not high, but it's also not low. The reason for this is things like network effects, first mover advantage. Obviously, Bitcoin is the market leader now, and it'll be very difficult to unseat Bitcoin, thanks to the infrastructure that's already been laid down. But it is quite possible that another alt currency will come in, invade the space, take over it. But not very likely, but somewhat likely. Bargaining power of suppliers is quite high. I'll go into the buyers though actually now first. So in the crypto ecosystem, our buyers are people like exchanges, investment funds, VCs, brokers, and their buying power is quite high because it's a pretty uniform product. You can buy it from anywhere. There's lots of choice for a Coinbase, to buy their coins from somewhere from several miners, several funds. But suppliers typically have very high power over miners, and our suppliers are effectively, the Ant miners of the world, the Genesis miners of the world, people that we need to either buy our hardware from, or buy our electricity from, or buy our data center space from. And because there's quite a few players in that industry, we don't have too much choice, so they kind of got us by the proverbials. Luckily, we've got a lot of collaborators in the ecosystem, which add value to our currency, such as, open bazaar, wallet providers, physical and online providers. We've got merchants, we've got the media. And because of all these factors, the threat of a substitute product, unseating digital currency, is actually very low. Okay, so now I'm going to talk about the nature of competition within the crypto and Bitcoin mining industry. Bitcoin, as many of you may know, is as close to a perfectly competitive market as is theoretically and practically possible. Now, what makes a perfectly competitive market? Well, there's probably about 11 or 12 things that make a perfectly competitive market. So, first thing is that all market participants are price takers. Now, as we saw, the other week with Bear Whale coming and putting 30,000 coins on an exchange, he's not a price taker. He's a price maker. So in the short term, Bitcoin isn't perfectly competitive, to that extent. But in the long term, as Bitcoin becomes less concentrated and more distributed, it'll be very, very difficult to become a price maker, as Jake alluded to. The second thing that makes a market perfectly competitive is having a homogeneous product, a product which is identical. And as we all know, for all intents and purposes, a Bitcoin's a Bitcoin's a Bitcoin. Third thing is very few barriers of entry and exit. If you want to start mining, you can just buy a mining rig, turn it on, off you go. If you want to exit the game, switch the power off, you're out of the game. And as miners, it's very difficult for us to crowd out competitors because it's open source. It's not like we can put a patent out on an algorithm or anything like that. So as opposed to banks that use lobbying and high startup capital to crowd out new entrants, it's going to be very, very, very difficult to stop people entering the crypto game. Okay, other things that make Bitcoin perfectly competitive is a large number of buyers and sellers. At the moment, there's not that many buyers and sellers, but as we move forward and the ecosystem grows, there'll be a lot. The transaction costs, are effectively, they're not exactly zero, but they're near zero. They can be zero if you want them to be, if you're happy with slower transaction times. There's perfect factor mobility in the ecosystem. What factor mobility is basically your factors of production, so such as your location, your labor, and your capital. So let's say the bit license regulations come out and they're not really favorable to us. It's pretty easy to hop on a plane, move our operations to another country, post everything in the cloud, ship people over to wherever there's a favorable jurisdiction, and life goes on. And lastly, because Bitcoin is a perfectly competitive market, as we know, in long-term equilibrium in perfectly competitive markets, profit is zero. So the only way to really make any profit is to differentiate yourself. So if everyone's sort of in the same game, sort of just mining Bitcoins to sell Bitcoins, in the long run, you will make zero profit. There are also very few externalities in the world of crypto mining. Effectively, the only externalities you see is electricity use and materials used to build rigs. However, you can recycle 90% of all rigs, so externalities are quite low. So the general point is Bitcoin's pretty perfectly competitive. In the long run, there'll be very little profit unless you're a market leader and keep innovating, which will result in a market that looks like this. So our suppliers will not perpetually, but in the short run at least, have high power over us. Our buyers will have very, very high power over us. The threat of new entrants entering the game is quite high because it's pretty easy to enter the game. We've still got a lot of collaborators and complementary products to add value to what we're mining, and we're pretty safe from a substitute product coming to the market. So now onto the organization and running a mining organization. Okay. All right. So it's all about making profit. So let's provide some pretty easy answers to some pretty tough questions. All right. So how can we be profitable? Pretty easy. Make sure our revenues are greater than our costs. How can we be more profitable? Also pretty easy. Increase our revenues and decrease our costs. So how can we increase our revenues? That's also pretty easy. So we can either make more sales or charge more for what we're selling. How can we reduce our costs? That's also pretty easy. We can sweat our assets more and try to screw down our suppliers. And finally, how can we capture the most market share? Well, that's also pretty easy. We just got to do what we do better than what our competitors do. But it's a lot more complicated in practice. So first, let's have a look at what our cost drivers are. So our cost drivers in the mining space can be split into our variable costs and our fixed costs. And the subcomponents of our variable costs and fixed costs are pretty uniform. So the main cost categories we have are our plant costs, which is effectively our mining units and whatnot, air conditioning, cooling, all that kind of stuff. We've got our human capital, our expertise, all of our software engineers, all of our maintenance crews. We've got our materials, which in our case is probably just electricity supply and energy supply. And we've also got a high cost of, or not a high cost, depends. We've got a cost of compliance. Now, what compliance is effectively insurance, security, keeping up with regulations, paying our lawyers, all that kind of stuff. And our variable costs include, our plant, our upkeep plant. So as you know, hash rate increases or has been increasing about 15% a fortnight for the past couple of years. So to maintain our market share of overall network hash rate, every fortnight we got to put probably 15% more hashes up so we can maintain our share. We've got variable costs in our human capital. The bigger our operation goes, more likely it is that we need more people to run the operation and make sure all the boxes are ticked. obviously, the more hashes we put on, the more electricity we use, the more cabling we need, the more cooling we need to run, and compliance as well. So we've also got our fixed costs as well. So all of our salaries and overheads for our core team, and rent and all that kind of stuff. All right, let's have a quick look at the revenue drivers. So our main revenue drivers are our price and number of units we sell. Now, there's some things with the price that we can control and other things that we can't. So of the external factors that we can't control is prevailing market price. Bitstamp is selling a Bitcoin for $350. It'll be very difficult for you to charge $500 for a Bitcoin. However, if you're mining Bitcoin for $260 per coin, you might be able to sell at $340 for quite a reasonable profit. We've got our different customer types and their willingness to coin. So a big institutional investor that wants to spend, I don't know, $50 million on Bitcoin might be able to negotiate a contract with you as a larger miner for 100 coins a week for this contract price. And because there are other mining companies out there, you'll also have to compete with the costs that your competitors are charging for their Bitcoins. Another thing that's kind of out of your control is the utility of complementary products. As the panel was talking about earlier today, it's pretty difficult to get your hands on Bitcoin at the moment. And because of that, price tends to be trickling downwards because it's just the complementary products aren't there yet. So as more infrastructure comes on board, utility will be added. Now, let's have a look at the internal factors, things that you can control that will allow you to command a better price or increase your margins. So your first thing is your brand strength. So if you're a trusted, respectable company, people will tend to come to you for Bitcoin. If you keep your customers happy, if you've got your finger in several pies, also helps quite a bit. Diversification. Your cost to produce coins obviously very important, and a good way to analyze your internal factors are traditional strategy tools like SWOT analysis and BWOT analysis, with a BWOT analysis being better, worse, opportunities, and strengths. So what do we do better than our competitors? What do we do worse than our competitors? Next thing is the sales volume. So you can achieve volume in two ways. You can either sell your Bitcoins organically, which is sort of pushing through the market using your own marketing team and marketing tools, or you can make inorganic sales, which is typically teaming up with a complementer. So for example, if you're a big mining company, have 20% of the network hash rate, producing a lot of coins per day, you can make you can do a partnership with one of the exchanges or one of the big brokers or one of the big venture capital firms to make sure you've got somebody to buy all the coins that you produce. The key things to sell organically is to make sure to have a good marketing plan and execute it properly. The ability to keep innovating and keep drawing new customers in with with innovations in your company. So you might start off as a miner, and then, on top of your mining operation, add a brokerage. On top of your brokerage, add an online wallet system. On top of that, add a physical wallet system. So it's always important to keep bringing new things to the market to incite new customers. With your inorganic sales, again, key partnerships as well as mergers and acquisitions. I expect that we'll see a lot of merger and acquisition activity in the Bitcoin space over the next sort of 3 to 5 years as companies sort of evolve into multi-service pure play Bitcoin companies. So how does it all tie together? So first off, the be all and end all is profitability. Those two black boxes which shouldn't be blacked out are your revenue stream and your cost stream. As you can see, everything kind of ties together quite nicely. So you've got your units sold relates to your units produced. You don't want to be producing more than you can sell. And if you're selling more than you can produce, you might want to up production. You can have a look at all your cost factors and how to make them more productive and sweat them a little better. You've got your different marketing tools and market analysis tools to have a look at what you can do with the price of what you're selling, and obviously you've got your mergers and acquisitions and partnering analysis that you can push your inorganic sales through. So now I'll pull the crystal ball out and try to have a guess of what the ecosystem is going to look like over the next 3 years. So first forecast is that the majority of startups are going to fail. So it's not enough to just be young, bright, and early adopter. You got to have good implementation, execution, and funding. Mt. Gox is a perfect example of this. Somebody found themselves right place, right time, and just sort of completely blew it and cost a lot of people a lot of money. So there'll also be a lot more price discovery, as Jake alluded to, in the face of further inflation and hype cycles. The regulatory landscape will become a lot clearer. There's going to be some jurisdictions that are quite forbidding and some that are going to be quite accommodating. And Bitcoin and mining operations will obviously gravitate to friendlier jurisdictions in the future. Product development will probably continue at the pace it's currently going at, leading to even more use cases than there are now, and ease of use as well. And I imagine there'll start to be a bit more vertical and horizontal integration. So as I alluded to earlier, a good example of this would be, let's say, an ASIC manufacturer branching out into cloud mining, branching out into brokerage, branching out into payment processing. So it'll all tend to come together in the future. Now for the long term. Bruce Henderson, a Harvard professor and also the founder of the Boston Consulting Group, had a theory that in the long term, competitive markets will always tend to be dominated by 3 or 4 major players with a lot of little niche players underneath them. It's been tested in over 200 competitive markets, and it always seems to be the case. 3 or 4 big players and a couple of little niche players. What should we expect then from the Bitcoin market? So on the 3-year horizon, about 2018, we'll start to see probably 3 or 4 like super integrated companies that kind of do everything. These 3 or 4 companies will probably be doing like 80% of the mining, with 20% of the mining being left to individual miners. We'll continue to see price discovery in the face of inflation. Bitcoin supply in 2018 will be about 16.5 million, and block reward at that stage will be about 12.5 Bitcoins per block. So inflation still quite high. There will be more even distribution of Bitcoin. Obviously, this depends on increasing adoption. So less and less people will become price takers. Some whales will still obviously exist. Product development will continue to endure. And on the 10-year horizon, 2024, we'll see the super integrated companies possibly even branch out further and move further up the supply chain, possibly even into becoming utility companies. So as we see solar power get cheaper and cheaper, we might see the biggest industrial farms build huge green and cheap energy farms, which are also on sale to local communities. There'll be much more consistent pricing. Supply in 2024 will be about 19.7 million Bitcoins. Block reward about 3.125 Bitcoins per block. There'll be even less whales, but some whales may still endure. People that have 10, 15, 20,000 Bitcoins will probably be whales for a very, very long time. And product development, just like the internet, will just keep enduring. I don't see product development ceasing probably for another 30 or 40 years. As we know, it's as Tim was saying, so many things that Bitcoin can do for us. Probably we don't know 90% of the things it can do for us yet. These will continue to come out as smart people keep developing products. So, in conclusion, when ignoring the price as a key success indicator, there's very little doubt that math-based digital currencies are here to stay. They're going to be useful forever, and as time goes on, they'll become greener and greener as we move to emissionless energy like solar, hydrogen fuel cells, possibly even fusion in the future. Also, as as Jake was saying, there's nothing really new about cryptocurrencies from a competitive strategy and disruption point of view. They work very similar to traditional commodities. This also applies to the the basic underlying economists that have kind of wrapped their heads around Bitcoin and how it works. They're kind of in agreement that it's not really that different. You can analyze it. With traditional theories. Finally, the true difference is in the concept of the blockchain, which inherently prevents markets from gravitating towards monopolies, duopolies, and oligopolies, just due to the nature of perfect competition. So we'll take questions. Personally, it's an unpopular opinion. I don't think there's a bottom. Because what was that, sorry? Yeah, so the question was, how low can the price of Bitcoin go before there's any more serious disruption? So, the jury's out on that, I suppose. In terms of, Bitcoin price, there's no, the bottom is zero. I suppose as long as people keep valuing Bitcoin, it'll always have a value. From a fundamentals point of view, it all goes back to the laws of supply and demand. As long as demand meets supply, price will be stable. Demand exceeds supply, price will go up. Demand is less than supply, price will go down. Also, something that affects quantity of supply on the market could be cost to mine. If somebody's mining at $200 a coin and prevailing market price is $350, price and cost will tend to converge in the long term because it's perfectly competitive. If traditional economic theories stand. Now, in terms of general disruption, for Bitcoin to lose all of its value or a lot of its value, something a lot better than Bitcoin has to come along. We haven't seen a serious competitor just yet, but there are a lot of smart people out there working on better algorithms, more efficiencies, and in the end, price is driven by the market, and if the market doesn't demand Bitcoin anymore and demands its disruptor, the disruptor will win. Any other questions?
State-sponsored by government decided to and now granted everybody's setting in line for mining hardware various companies. So a large like state-sponsored with a lot more money, a lot more things that we have tax and whatever else. Has anybody heard any kind of money or that would be?
So the question was, what about governments getting into the mining game with all the capital that's behind them? I've got a pretty practical outlook on that. There's lots of people with a lot of big money. So I remember reading on the list of speakers, there's going to be some people talking about game theory. Let's say China decides to get into the game. So just in generally speaking, we got the Antminer guys here, and I know ASIC Miner is their product, the ASIC Miner Prisma, currently costs 1 Bitcoin per terahash. So that's about 35 cents a gigahash. So there's 250 odd million gigahashes on the network. I could put 250 million additional gigahashes on for about $100 million. $100 million isn't a lot. So let's say I've got $100 million. I throw it down and put another 250,000 gigahashes on. If somebody sees me getting rich off that, they'll throw down 200 million. Somebody sees them getting rich of it, they'll throw down 500 million, and so on and so forth. But in the long run, they're all going to make zero profit unless they're doing something really innovative. So that's how I see the game unfolding. If market demand for Bitcoin rises and pushes the price up way above the cost to mine a coin, more miners will enter the game. So it's not very different to, for example, the iron ore market that we're seeing now. So being an Australian, we love our iron ore. Iron ore price has dropped from $135 to about $70 a ton. The only person still mining iron ore in Australia is BHP Billiton, and they're going vulture on all the small iron ore companies, buying them all out. If iron ore should hit $200 per ton again, new miners will come into the game and start mining iron ore. Exact same thing with Bitcoin. I believe if it works, you know, just like traditional commodities work, which I think it does. Any other questions? All right, we'll go to an early
If there's
lunch.
no more questions, I'd like to let's have a round of applause for Haas. Very educational and insightful. Let's give another round of applause for Jake. And we have about 30 minutes or so until lunch can be picked up in this room right over here. So just go, network, have fun, and see you guys around.
When's that game theory talk?
Oh, I thought it might be after lunch.
That should be an interesting one.
Yeah.
Yeah, it's all about education, really. We just gotta teach more people. Yeah.
Thank you very much.
No worries, my absolute pleasure. Absolute pleasure. It's all right. It took the sting out, took the nerves out.
Yeah.
We just like a Dropbox or something for all the presentations.
So again, it's all in supply. So it's the demand fluctuation. 50% of the price inflation. That's what I'm saying. I'm thinking the other 50% due to demand fluctuation. Which is why I'm shocked.
Some do, but most gave up on it last December. That's one of my favorite concerns. We hit that that's what happened with the there was inflationary pressure, so people had an expectation of the value of the dollar. So why would I spend it if I know it's going to be I like to see savings being another person tomorrow. Bitcoin is tomorrow.
That's classical. Oh, what you're saying is no. They do have different people have so you could have massive increases in demand for ships in the neighborhood, right? What I'm saying in the long run, all else equal, there's a greater percentage of inflation, right? So in the long run, all else equal, there's a greater than 50% chance that value because there's the value, yes, the value is value. Price. So the value price is good. The amount of Bitcoin you have to pay that's what so, and that's what we saw in the Great Depression. That's why the gold standard failed. Right? The gold standard
We've had so all of them are gone. They got taken, but more are being printed as we speak. So yeah, man, it's perfect time actually.
So, Rich, you say that you actually have a Rich?
Yeah, you see the booth.
But then it was exacerbated by
So you're trying to bubble, right? You're trying to
eliminate the chance of a bubble by not having a credit card. The only way you can get a bubble is if you borrow the credit. To replace the gold standard. But where we have to You can do that. There's nothing stopping you saying, there's nothing to say, I'm sorry, it's market. Right? This is my market. The thing is that I will always redeem one market. Half of it. Right? And say, I will always find the exchange rate and do things at one forever. The problem is I get people to adopt it's the U.S. government to convert $1 for always everywhere. That's what we had in the standard in 7, right? The U.S. government said we will always trade $1 for this amount. I keep it right. Take it to $1 million. Still base. I'm saying if the government comes out and says we will honor what Bitcoin is worth or what $1 is, such and such a Bitcoin, right? Immediately the market's going to adjust because any arbitrage opportunity or whatever they're going to trade on that. The price of the floating market, it won't be floating anymore. It will be tied to
You know what I'm saying? So if it's a free market, it could be a free market.
I'm a patient candidate, so I teach and I go to school. All right, this is me.
Presentation.
Yeah, we're actually really now we are
Right. Oh, that's cool.
So you're optimizing the machines based on the hash rate and also on the there's a lot of my partners oh yeah. The game theory in mind is starting to get
It takes time for that.
oh yeah. I mean, especially academia has always been. You start researching something, you graduate, and you stick with that. You know, everybody thinks, people in academia constantly get new things and always on the frontiers. No, I started researching something 30 years ago. People are still studying since the 70s. Organizations that people are still studying. It's like, it's like. Oh yeah, yeah, that's very cool. That's the real interesting. That's if a state adopts it, not a big thing, but the technology, digital, kind of this blockchain type yeah. I mean, if you're a borrower, then At that point, everybody's losing. When you don't know the price of something, what's the honestly is a better currency. People are just not people are doing that now in Argentina, right? They don't want the Argentinian peso, they want dollars. In Mexico, they don't want the Mexican peso, they want dollars. And so as soon as they get paid, they immediately exchange all of these. There's a black market. This is the government rate, which the government says this will exchange at. The market rate. One of my colleagues from Argentina is actually studying this rate. So how does that spread I mean, I never really talked to her much about it. She's from Argentina, so she's Argentinian. So. Oh, I'm sure if I explain it to her like that, like here's another alternative. Right, so I mean, there's an opportunity where it really benefit me. As soon as you get paid in the Argentinian peso, you have to spend it. So it's that many, unfortunately, that many buying food or things that are harder to trade. With Bitcoin, it's easy to trade too, right? So you spend it right away. On Bitcoin, it's easier to buy dollars in Argentina, right? And then you still have a currency that you can easily trade. So there's an not that yeah, that's not we can do our own. Oh, yeah, right. But I mean, the kind of general consensus on economists is that stable inflation can be like around 2% is good inflation because it greases the wheels. Right? Every year we're producing more, so we actually keep more dollar bills to process those transactions. I think that's banks are less risky. I mean, if I make an overnight loan and I'm a bank, I mean, there's very little chance the bank is going to fail overnight. I mean, if I take out a 30-year mortgage, there's a ability that I might default. Oh, right. So there's fear. You're getting more affordable. I agree with that. Like, now you're getting away from right. You get no Argentine in there. Yeah. So that's what I'm saying. You take the Argentine back all the way up. So people like me are chance to remember. Yeah. It's not a purview of manipulation. Oh, I'm sympathetic to that. So I find that. Yeah. So I love having you. Yeah. Right. And I would say things that are attractive to Bitcoin or attractive to economists are that it's decentralized, not subject, not as subject to manipulation by others. Right? Especially economists. Right. So that, and the fact that you can set them they brought it up. That's very cool. Look at all the international transactions that occur. Yeah. And so that's very attractive. There are some other things that you're right. But it is because every year we produce more stuff. Right? You're producing things. Well, there's nothing wrong with that. I know tomorrow I'm going to be able to buy more than I am today. I'm just going to save tomorrow. If I know tomorrow, that day after that, I'm just going to keep saving. Right? And the problem is, if there's no borrowing, you can't untap right? It's like buying a car or buying a house or anything. I want to build an accident. But that's an assumption. That's an assumption. Then there's no incentive to build a computer. Well, the thing is, that's due to technology, not due to monetary value. Continue the fact hasn't stopped. I'm saying, but it's evolving now. That's a tech thing, right? And it's still very small. It's a small group of dedicated individuals who see it for more than just economic purposes. Right? I'm saying if you want to expand it, right? I think that inflation and inflationary pressure that fixed supply is supposed to be back. Right. I think that's great. I think the technology is great. Like very high level, right? Creating these new ones on an even high. No, because they're competing. That's not how they do it. I mean, they're competing currencies. They're actually Yes. Business currencies is our networks. The more people using the currency, the more value we have. So if you have main currencies, it takes away from that. So, Bitcoin is correct. I don't want to exchange it back and forth. That's why one of the reasons the dollar is currency, because everybody uses it. So exactly. You take gold anywhere. So, what I'm saying is exactly. Yes. That's why. So that's why it makes it funny. The reason for each is so in good times, excess reserves do. Banks lend out whatever they can and keep what's required of them. Right now, it's record high that people are free. Right? That's what banks are. Banks are afraid. They don't know who to lend to. Right? They're still scared. So as soon as the money comes in, they see the money back out. They just want to. That's what because they're scared. But Bitcoin, I mean, 2013 was basketball, right? I can't say it wasn't. But you it's just it's a game competitive, right? So it's either you can buy it low and sell high. So that's how these transactions go. I have it's because it could. And that's what actually competition is. So I started. That's expected. Supply is going to be fixed, right? But you're still going to have demand fluctuations. At least when supply was growing, whenever you had a positive demand fluctuation, you get something, right? But now when the supply is fixed, you're going to see the full effect of the demand fluctuation. So at least on the one side, the increased supply of how the growth was mitigating some demand fluctuation. But now we have reduced supply. Why are you going to see that? Well, maybe things just I know you increase you're going to need more GDP goes up. Need more money to chase this. What's wrong with it? It has implications for the water. It grinds the economy to a halt. Because why would I spend today if I can spend tomorrow? A lot of things that if you maintain it right, it's a better standard of living, right? I can buy that. I can buy that. But open the discount. The thing is, good, you could, but the interest rate you're going to get at the discount if it was open would be much higher than that. Because interest rates.
Briefcase and then show them. Oh, you guys love it. Yeah.
Yeah, that does. Quite space. I like it.
A little time to myself.
I think it's all gone now, so it's a little bit like it was. We had enough for the majority of people, basically. The majority, but so it's there until it's gone. So. There is there's a couple cafes downstairs, and but they're very reasonable price, like $5 to $8 to $9 and stuff. Okay, sorry about that. Hi. How are you? No, it's normal food. It was we changed it. No, it's all going to be here. All right. Thanks for checking out. Hi. Sorry? Oh, when? It'll be. Oh, where? I actually am not sure exactly what we're going to use yet, because we also have the video, so I'm not really sure if we want to put everything together or just send it. Oh, the video, right. The video is on Bits and Chicken YouTube. Yeah, so it's on that. Yeah, it's a YouTube channel. Bits. Yeah. You're welcome. Good question. Yeah. I'll have to check with Michael. Yeah, but that's a very good question. I'll have to check. It's in someone else's channel, yeah. So they do yeah, they'll know because it's like here. They do mining, they have a mining channel. Yeah. Okay.
Hi, I have a question. Is there any way to get into bottled water?
I can.
Yeah. The drinks are on the cloud.
In where? Okay, I'll go because the soft drinks will be in the back next week. I'll get some water.
Is anyone?
I'll contact all these outside.
How do you know about students?
Okay. Is that just now or is it when it's actual presentation?
When the music.
All right. They should they should be playing in the whole time.
No, they would.
Okay. I'm going to. I'll sort that out. That's not.
So it's really hard to hear them. That's why I asked.
Okay. I'm sorry about that because it was specifically the stuff in between sections. I had to go chase some things, so I'll go and make sure that's sorted out. Okay. Thanks for letting me know that.
Oh, perfect. Yeah, just gonna full screen it here.
Are you David?
Yes, it's me.
Okay, I'm Steve Reed. I'm going to be your moderator. What I'm going to do is, I've got this introduction I'm going to read.
Okay.
And like yourself, I also have an interest in artificial intelligence. Oh, wonderful. But I won't say anything about it.
Perfect. Sounds good.
And then when there are questions, there's the roar in the back, and the fact that we don't have a mic on people are asking the questions. And when you hear the question,
Be sure
just
to
repeat it.
Absolutely. Got him. There we go.
I'm going to take some shots.
Good afternoon, everyone. I'm sorry. Good afternoon. Good afternoon, everyone. My name is Stephen Reed. I'm a researcher in Austin, Texas. I'll be moderating the next two sessions, and then for 30 minutes after that, I'll make my own presentation. I'm here this afternoon to introduce to you our next speaker. And it's a fairly extensive bio. David Leo is the
Oh, yeah, absolutely.
David Leo is the owner of Coin Heavy, which provides free consulting and implementations for nonprofits and charities. He includes consulting, integration, e-commerce, point of sale, training and education, and mining systems. He is currently working in San Francisco Bay Area as a financial technology researcher for a stealth startup headquartered in New York City, and as a research and teaching assistant in the field of artificial intelligence. His topic will be an overview of cross-industrial, academic, white paper, and experimental research pertaining to mining. And here's David.
Thank you. So I'm David Leo, and thanks for the introduction. There's a lot to cover. The space moves really very quickly. It's exciting. A lot to cover. I'm going to go take a high-level view. We'll breeze through it all, and we can circle back around to what's most interesting to everyone at the end. So if you're inclined, we can, here we go. Back up a second here. If you'd like to follow along, the presentation is available at davidleo.com/mining, or for anyone watching remotely. And if you're interested in the research that I'm talking about today, you can go to smithandcrown.com. It's the company I work for, and sign up. We're still in a private beta, but go ahead and sign up and we'll send you an invite. So before we get into it, I saw this the other day, thought it was interesting. Mining by hand. So there's a fellow, his name's Ken Sheriff, and he wanted to see what it'd be like to attempt to mine a block or to hash a block by hand, how long it would take him. And he figured out it'd take him about a day and a half to do it by hand. So 17 minutes roughly to do one hash. You need to do 128 of them. He didn't do all 128, but he saw how long it would take. He even did a fun calculation to see energy-wise, if he used donuts, which was a cheap source, how much efficiency he'd have as opposed to a miner. So he's about a quintillion times slower than an ASIC. But website, therighto.com. And I mentioned him up front because if you're in the mining space and you're looking to get closer to the protocol, to learn what's going on, he's got some great articles about taking you through step by step exactly what's going on, sort of byte by byte. So excellent resource there if you're looking to begin to get a bit more technical in the mining space. So I'm going to talk about some context of how I'm looking at the lens sort of I'm looking through when I'm looking at this research, current state of affairs, the papers. So I'm doing a broader overview, sort of general Bitcoin research. And this particular talk, I'm focusing specifically on things that pertain to mining and branching out a little bit from there to what the future of mining and mining related technologies might be. And then taking a look at the future, sort of where we're headed, which is most interesting. So the good, right? Very exciting space, is very compelling. A lot of scrutiny. There's 250 core developers, technically, contributors on GitHub, right? So that's a lot of eyes. There's a lot more eyes than that on the problem, and these are very, very smart people solving problems every day. It's evolving, right? So the code base is evolving, and over time, the severity and frequency of bugs that are being discovered is going down. It's diminishing, so that's great. The network's been operational for over 5 years, which is impressive. It works, and yesterday, right? So there's a 23,000 Bitcoin transaction, and it's cool that $10 million can be sent somewhere. It worked, and then other people can see that and hop on the forums and say, "Oh, I wonder what that was. That's interesting. Let's try to figure it out." And then the investment in the space. So we just tipped over cumulative investment of $300 million in the Bitcoin space and VC funds. So incredible. It's not all good. So regulation looming overhead. I think there's a lot of people. There's a lot of money on the sidelines, waiting to see how things shake out. A lot of uncertainty there. And then the operational security overhead, right? To really own your own private keys, to do that securely, it's intense. Even if you're a technically minded person, it takes time and vigilance, and it's a lot of work. Public perception, I mean, when you talk to people, you get a whole range of responses. It's always nice to ping people who haven't heard of Bitcoin or anything, and you get a range of responses. I found personally, just anecdotally over time, it's been improving. I'm getting less pushback on, oh, it's internet drug money and that sort of thing. And people seem to be more curious now as things are evolving. And then because of the operational security overhead, pseudonymity isn't really anonymity. Because it's so hard to hold your private keys, most people use cloud services, store their keys elsewhere. And now there's a strong link between your identity and your funds. And so some of the privacy and anonymity appeals are gone for a lot of users. There's a lot of discussion of zero confirmation double spends. So even the language there is a little strange, and we can get into it. For a while, it seemed like the language about double spends was a double spend was considered Bitcoin being spent twice, the same unspent transaction output being spent twice, which never happens. But now, because that doesn't happen, double spend tends to refer to a Finney attack, which is sending out a transaction on the network, having a merchant accept it without a confirmation, and then sending out a transaction that contains it's one of the same unspent transaction outputs, but with a higher fee, and propagating that quickly enough so that the second transaction is the one that gets accepted. Actually, if you're nefarious, you could be sending it to yourself, and the merchant gets stuck with nothing. But it's a known issue. I mean, there's if you shouldn't be accepting zero confirmation transactions in almost all cases, but there's been some talk of it recently. And then version. So this isn't necessarily a bad thing. It's just something to be aware of. The current version of the Bitcoin source, right? It's not 1.0. We're still in beta. It's still evolving. Even though it's been 5 years, you know, it's going to take some time to really get there. And then there's a couple of interesting things to note on the ugly. So this initial bug here, let's go through them one by one. For about 2 years, there was a bug, and here I'll just read this. Bitcoin D before 035 did not properly handle script opcodes and Bitcoin transactions, which allows remote attackers to spend Bitcoins owned by other users. It's pretty bad. But it was, the first 2 years, not a lot of people using it. It was caught, verified on testnet, and then patched on mainnet. No one actually used it in the wild. But it's an interesting thing to note that as you look into the technical details, Satoshi, whoever that entity might be, genius, brilliant. But not perfect, right? So if something like this was around for 2 years, it's just important to temper the optimism with some reality. And that's patched. I mean, it's nothing to worry about. It was never used, but it was a serious bug that was in the initial source. Distribution. So this is interesting. There's a economist, Risto Pitila, I'm not exactly sure how you say it. There's a great thread, and this is his analysis on not addresses or anything, but actual people. So these numbers have been anecdotally verified by a lot of very early adopters on the forums and elsewhere as being in the right order of magnitude, at least, if not exact. So you can see it's pretty top heavy. I mean, there are some early adopters who are huge whales who in these markets like that 30,000 coin wall the other day, they can affect the market significantly. So this is another thing to keep in mind. I mean, if you take someone down explaining to someone new about Bitcoin, a lot of times if I get far enough with someone, they'll ask me about distribution, and it's an interesting thing to explain that this creator who's anonymous or pseudonymous controls, potentially 10+% of the currency. That's significant. It's not to be scoffed at. Now, presumably his interest is in propelling the currency forward and not, or Bitcoin forward and not tanking it, but it's a lot of power to be aware of. And this will change over time as price fluctuates and early adopters continue to get out, new people come in. This will happen, but the numbers are interesting, at least to be aware of. So looking at nodes, this is an issue that core developers talk about quite a bit whenever they're asked for their concerns for the future. So this is just kind of a heat map representing nodes around the world. And you can't really tell too much from it, but all right, everyone think of a number in your head. How many full nodes are running out there, Bitcoin network around the world? Just think of what your guess is. And let's take a look and see how close you are, because there's about 6,700 nodes right now on the network, which is less than a lot of torrents, right? I mean, that's not a lot of nodes. So part of that is pooled mining, right? Miners aren't necessarily running a full node anymore. And that's a low number for all the money that's online. It's interesting to think about. If you can run a full node, there might be something that's good to do. What is something that's good to do? All right, mining pool concentration. You're all miners. You're all well aware of all this good stuff. Discus Fish recently has been offsetting a bit of G-hash's dominance, but and this is a good graphic here. Mempool.info has a great display of the current mempool, which is nice that transactions that are waiting to be mined, which could be interesting for a lot of you miners. And then /pools has some analysis on blocks that have been mined recently and trying to attribute them to their respective pools. Here's another visualization from another good resource. This fellow puts out a weekly sort of pool status update, keeping his eyes on the state of the industry. And this visualization is a little different. You can see that dark orange there at the bottom. He's aggregate all the unknown hash, which is also significant. It's something to be aware of. We don't know exactly who controls that, and if you add that up to certain other sectors, there it gets a little daunting. So this too recently on Hacking Distributed, there's a great article about mining pool concentration, and everyone's concerned about 51%. I mean, there's been instances this year where it happened, and another thing to keep an eye on. I mean, it's a really exciting space and we're moving forward, but it's not crystalline, perfect. It's still evolving. So looking at the papers here, sources for all these, academic journals, industry white papers, the developer mailing list, if you're technically minded and you're interested in how things are evolving, signing up for that on SourceForge is a great resource. I don't contribute to it, but it's great to see what the core developers are talking about off the forums. GitHub, obviously, very cool to see. And IRC, the community is small enough that everyone's very accessible. If you dig into something and you hit a wall where you can't find an answer, you can reach out to the people who would know, and they'll respond. And then the forums, obviously. All right, so let's get into some of these papers here. If you are attending this conference and you haven't read Satoshi's white paper, you should go home and read it tonight. 15 minutes, it's concise, It's what started it all. It's great. If you're interested in space at all, you owe it to yourself to read it. There's a link there for a good web resource. So mining history out of UC San Diego is a great paper. It's kind of an overview of how things evolved. So if you're a new miner and most of us weren't around the days of CPU mining, obviously, it's nice to see how things evolved just to get a bit of perspective. It's a great introduction for new miners. And the only thing it's really missing is the last year or so of basic advancements. So pool systems, if you're a pool operator or thinking about running a pool, Manny Rosenfeld, great researcher, a lot of papers there. This one in particular, it's a couple years old, but it goes over most of the sort of pool reward systems in great detail to understand a little bit better what all the paper share and paper last end shares and all of the non-standard reward mechanisms are. And then it also looks at a lot of mining pool attacks and countermeasures. There's certainly more that have come to light since this paper was written, but it's a good starting point if you're seriously thinking about being a pool operator. Botnets, right? So not as much of a concern to Bitcoin anymore. Now that CPU mining isn't viable, most botnet machines are very low powered, old systems. You're not going to be hashing with a CPU effectively. But still interesting to see what was going on in the early days. And still, if you're running ASICs and you're connected to the network and everything, botnet operators are just getting smarter, and it's going to be more of a targeted attack to try to control hash power. So being vigilant with making sure that your machines have been running for a week, that make sure they're running for you and all that sort of thing. A little bit more research in the botnet space. There was a paper out of the Cyber Defense Research Group, and this is a more of a deep dive into one particular botnet. It wasn't the largest one or anything, but it's a very interesting deep dive into exactly what was going on there. So it's a cool case study if you're into security. So moving on from there, proof of stake, right? So thinking about mining more broadly, right? You're providing a computing resource to a network and being rewarded for it. And now that with the state of ASICs for script and SHA-256, I think it's important if you're serious about being a miner fully to think about what the future of mining might look like. Maybe you're providing other computing resources besides just hashing. And we'll get to some of that. Proof of stake is something that existentially, I don't want to say it's a threat to miners, but it's something that smart people are seriously considering as either a full alternative or to work in tandem with proof of work. There's a lot of concern. No one can really know for sure. There's a lot of concern eventually that transactional fees won't provide the right incentives to really secure the network over time. It's so far off, and it's really hard to say. I would expect that market forces could create a sort of equilibrium where that would be reasonable. I think developers are smart enough to try to work towards that too. But there's a lot of concern. Proof of stake is one of the things that tries to address that. And here we've got a paper by co-authored by Mr. Charlie Lee back there, and he'll be speaking later today, so maybe we'll hear some about it. Proof of activity, this is very exciting stuff. It's sort of, proof of stake is very difficult to implement. And one of the ideas is to encourage more nodes and foster decentralization, and that you could generate more coins by having coins as opposed to mining them by hashing. So it might be included eventually in Ethereum. Vitalik Buterin, the creator of the Ethereum project, said recently, and if Charlie Lee's working on it, it's got to be good. So if you're into proof of stake, that's kind of the leading edge there of where things are headed. Selfish mining. So this paper came out last year that reported to expose a new attack, a new sub 51% mining attack, required at least 25% network hash rate, and involves a block withholding strategy where a cartel would, if they successfully mined a block, they wouldn't publish it immediately, and they would try to mine to get ahead to get a benefit. And if people are interested at the end, we can circle back around and get into the details of it. But the core developers have responded several times. They pointed to threads as far back as 2010 that really look at similar attacks. The real novel thing here is that they assume a Sybil attack where an attacker would spin up a bunch of nodes that they controlled, sort of sock puppet nodes, to control propagation on the network. And people much smarter than myself seem to think this is not one of the biggest issues to worry about. And Vitalik Buterin has a particularly good article about this on Bitcoin Magazine. That's quite well written. So if you're interested in selfish mining, I would check that out first to save yourself some time. looking elsewhere. So salvage mining is one type of block withholding attack, but there's others. And this paper in particular looks sort of broadly at what could you do if you withheld blocks. And it looks at it from an interesting perspective on an aggressive vector. So rogue infiltration block withholding. So the case here, the example case is, let's say you have 20% of the network hash rate and you wanted to use a block withholding attack. You take 10%, you put in your own private pool and you mine. You take another 10% and you infiltrate other pools and you mine on those pools and you submit shares, but you modify your code so that if you find a solution, you don't submit it. So what this does is over time, you'll still be paid out on that 10% that's mining for other pools, even though you're never submitting a block that you successfully hit. Your private pool will be mining at an advantage. And if you average it out over, it's about 6% advantage that you could get potentially by using this strategy. And it was fairly theoretical until recently. Allegius announced that they had discovered that they were the victim of one of these attacks to the extent of about 300 Bitcoin. I think they identified it quickly enough that they were able to save themselves something on the order of 200 in terms of payouts. But it's a very interesting attack observed in the wild. Luke Jr., I think, goes into it a bit, and his partner there, WizKid on the forums, I'm not exactly sure who he is. They look at it. Very interesting attack. It was observed in the wild. Again, if you're running a pool, worth checking out. So decentralization is a big area of research, obviously, especially now that pools, everyone's mining on a pool, things are moving to ASIC or have moved to ASICs. It's not just people with their home computer anymore, and that it's reflected in the node count as well. Less than 7,000 nodes is very few. So this is a great paper, non-outsourceable scratch-off puzzles to discourage Bitcoin mining coalitions, and it's cool even just in the title. The analogy is interesting, right? We talk about mining, but mining is a comparison. It carries with it a lot of other baggage. It's a very involved thing, and I kind of like the scratch-off puzzles, like a scratcher, as a quicker, cleaner analogy. If you're talking to someone new about what mining is, maybe a scratch-off puzzle is a little bit easier to wrap your head around. So this is a proposal for protocol change, and it involves a two-phase proof of work. And there's a weak version and a strong version, just if it's detectable or not. And the way it works is you implement a second crypto puzzle. So you have the way things work now. You have a second step where in order to submit the block, in order to actually claim it, you have to sign a message in such a way that it proves that you have the private key. So again, we can circle back on this and go into the details a little bit more if folks are interested, but it allows for two difficulty parameters on two different puzzles, where over time, a shift in those, algorithmically, just like the mining rate declines, these parameters could shift over time, and it would allow for a change from pooled mining down to individual mining. In a sort of a non-outsourceable fashion, where if you did want to join a pool, there'd be a different level of trust, so different trust expectations there. And this is kind of in reaction to more cloud mining going on, more concentration hash power, a lot of reaction to dhash.io. That's a great paper, very, very interesting stuff there. Coin mixing, so it's another area that's sort of interesting. Coin shuffle seems to be the most viable candidate at the moment for decentralized coin mixing. So coin join was proposed by, I think, Gregory Maxwell a year or two ago, and that is a way where you can get some anonymity out. You can have coins and then sort of obfuscate blockchain forensics, a bit. But it's still coin join requires a trusted third party. There's a server who's still going to know sort of the inputs and the outputs and how they got mixed, even though to everyone else they might be left in the dark. Coin shuffle is a proposal for a truly decentralized sort of coin mixing service that doesn't require trusted third parties. It's still in development. There's a great SF Bitcoin devs demo video. I think Brian Vu from Google goes through coin join and coin shuffle. They made a test case out of the SF Bitcoin devs custom wallet that they have. It's very interesting stuff if you're into sort of the anonymity side of things. So proof of space. So here we get into what I was talking about in terms of you're providing hashing power as a miner, but what if in the future you're providing other resources as well? Proof of space is actually, we'll get to the proof resource in a second. This is actually a way to, instead of proof of work, instead of using ASICs and hashing power to generate coins, what if you were proving that you had storage space? You had a big storage array, and that was like your ASIC. So this is a protocol where the intention isn't to create decentralized storage systems. It's not trying to be a Dropbox, decentralized Dropbox. It's an attempt to replace ASIC proof of work or be an alternative with sort of disk proof of work. So it's a neat idea. It's very cool. Most of the rest of the research is heading in the direction of why not use that space for something and provide distributed storage. So MadeSafe recently had a crowd sale. It's a little controversial because of the way they pegged Mastercoin prices to Bitcoin prices at an artificial rate that sort of was skewed based on what the market was reflecting at the time. But the idea is sound. They raised about $6 million. It's still in development, and storage is their first application they're going to target, where you as a farmer, instead of a miner is the language that they're using, as a farmer would provide storage arrays. And then as a user, you could, instead of going to Dropbox, you could go to MadeSafe and use their SafeCoin to buy cloud storage, essentially. And the files would be encrypted and sharded, fractioned, all that, and distributed, so that if I was a farmer and I decided to unplug my array, well, those files still exist in enough other places that statistically no one's going to lose anything. So it's pretty cool. They're going to move on to other things, general proof of resource for CPU. So let's say I have some supercomputing problem. This is a way where people, some of you might have had the SETI or folding at home screensavers. There'd be a way to do something similar, but maybe to be generating some cryptocurrency as a result. And then bandwidth as well is another interesting application that's on the horizon, providing sort of relay services. So proof of storage A is another thing in this space, and should be very interesting. They raised almost 1,000 Bitcoin. It's very cool. Metadisk is their sort of client platform, and then DriveShare is the farming interface. It looks great. It'll be exciting to see some competition in this space. We all have a lot of files to store. This could be exciting for all of us. And as a miner, you're already maintaining a bunch of equipment, right? So maybe a storage array isn't the worst thing to look at adding down the road. Proof of retrievability. This is another paper in that sort of proof of storage space. It's anonymous in its authorship. Makes similar claims, and it's as of yet unlaunched, but another one to keep an eye on. And the proof of bandwidth is a cool one. It sounds really difficult, and it is really difficult. It's a problem that's still being worked out, I think, in the details of the protocols. But Tor path to Tor coin is one specifically where what if there was a way where you could incentivize people to provide Tor nodes, and in doing so you were rewarded in proportion to the bandwidth that you were providing on that Tor circuit. So this paper comes out of Yale and the US Naval Research Laboratory. It's very compelling and something that's worth keeping an eye on. Decentralization in general, this paper by Karame, who has a number of good papers. Actually, this ETH Zurich, I want to point out here, is a research organization that I think has the most, as far as I've found, out of the couple hundred papers that I'm aware of, they have the most authorship in the Bitcoin research space. Their students and their faculty. It's a real hotspot for Bitcoin research. You ever find yourself over there and in the area, you should stop by. So they look kind of generally at decentralization in the context, not just of mining, but mining in pools and all that sort of thing, but web wallets and SPV clients and how that might work down the road. SPV client is where on your phone you can avoid downloading the full blockchain but still interact with the network. They also look a bit into the developer power and politics. I mean, it's this great decentralized thing that we're talking about. It's very grand, but then we look at less than 7,000 nodes and there's a handful of developers, and there's some things that are worth looking at. If you're really in this for the decentralization, there's some things that are important to keep in mind and be aware of. It's a good overview paper for that. And then Ethereum is something that should be talked about at any conference, not just mining conferences. I think it's very exciting. They raised almost 30,000 Bitcoin in their crowdfunding campaign. It's a new blockchain, and the idea is Bitcoin is very restricted in its opcodes and its scripting language. It's very simple for a reason, because with complexity comes potential vulnerability. The idea is to have an ASIC resistant mining algorithm where the ideal computer is sort of a general computing device so that a laptop is still in the game and that sort of thing. But to tweak the settings so that, again, botnets aren't going to be effective because those are tend to be older, weaker computers. And if you look at their team, so Merkle trees, as miners, you see a lot about Merkle trees and everything. Well, Ralph Merkle is an advisor to the Ethereum team. So just to give you a bit of perspective on the seriousness of the team they have over there. And Vitalik Buterin is the creator of it. And in any space, particularly mining, though, I found I go to, when there's something complicated I don't understand, I look for an article that Vitalik has written to help explain it to me, because he'll explain all of the technical detail, but in a way that's very comprehensible to someone like myself. So their white paper is very exciting. It's worth taking a look at. And just 2 days ago, there was a new announcement about not the initial mining algorithm, which has sort of been established, but potential add-ons where proof of activity is being considered for proof of stake. And then also it's this ghost slasher protocol that they're trying to work out and talk about publicly to get some ideas for it. Very exciting. That's the bleeding edge of mining research. If you're interested there, take a look on the blog. And I think they're shooting for by the end of the year for that blockchain to be launched. So that should be interesting. So the future of mining, right? I think it's now that we're at ASIC levels for SHA-256 and Script, GPUs are sort of finding a way to stay relevant on different altcoins. So there's gonna be hash mining, but there's also gonna be storage farming, right? And there's gonna be CPU farming. And something like Ethereum, there's gonna be smart contract processing, where that network is gonna run a full scripting language where you can program, like Tim Draper was talking about earlier today. He's excited about smart contracts so much that he wants to do a VC action in a smart contract. That's a very compelling idea. I think it's really exciting. It'd be a great sort of test of the contracts. And there's also gonna be bandwidth relaying, right? Where, because for decentralization, all of these things could potentially work hand in hand in such a way that you can program with contracts and you can store things in storage, and then you can do the computations on a different network, and you could end up with completely decentralized web applications. And the first generation of those is already starting to be developed and very alpha stages. And the next extension from there that people are getting excited about are decentralized organizations, which I'm sure you've heard mention of, where not just a web application, but a whole business could potentially be decentralized in one form or another. So that's kind of the future of where things are heading. Proof of stake viability and security. It seems as time goes on, it's a very difficult problem, but it seems like there are some approaches that are worth trying seriously that will be tested. Proof of resource. Each one of those individual components is a very difficult problem, but they're all being solved. They're all being funded, and intelligent people are working on them, and better solutions are coming out every day. Mining decentralization. So if you're mining on a pool that is a huge pool, I would urge you to consider looking at P2P pool, which is a way where you can mine in a peer-to-peer fashion. You still reduce your variance. You're getting paid out the same way you would be with a normal pool, but you're doing so in a way that's much more decentralized and sort of generally secure, where you aren't just giving your hash power to someone else who could, if they were a nefarious actor or got compromised, could use it to negatively impact the network. So P2P pool is worth looking into. Also, in mining decentralization, there's a get block template feature that is allowing for, instead of you getting all of your work just from a pool provider, it's allowing a little bit more flexibility on me as a miner. I can still work for a pool and work under their constraints, but I can decide, have some impact on which transactions are getting added to the block. So to help avoid things where transactions are getting, could potentially be frozen out by a bad actor. Increased anonymity, so a lot of the coin mixing stuff. A dark wallet is a project where they're trying to build that into a wallet client themselves. So it's very seamless to the user, and they get that experience of obfuscating themselves from blockchain forensics, but not having to go through a lot of machinations of manually forming transactions to do so. Smart assets are very cool. There's a couple of companies already that are trying to work on physical exits, right, for we can have tokens, colored coins, and these sorts of counterparty, these sorts of things where we can have an identifiable token that is particular to a company or an entity, and we could have a digital bearer bond that are starting to exist, where I could buy it in Bitcoin from someone on the other side of the world without having to trust them, and then take that token into a storefront, and I would need to trust that entity, the brick and mortar entity, to deliver gold bullion or what have you for that digital bearer bond. So there's companies working in that space, very, very exciting. Smart contracts, like I was talking about, crypto finance, really. I mean, being able to program a contract where one of the simpler cases is an insurance contract, a crop insurance contract. So let's say there's a farmer somewhere and I want to provide an insurance contract for him. We can agree that in a week from now, if it's raining at his GPS coordinates, I'll pay him. And if it's not, then he can pay me. We can program that in code and run it on the Ethereum network. The testnet, you can already do some things like this. And we can do that in a decentralized fashion without trusting one another. But what we do need to do is ping the outside world in a week to see if it's raining there, because there's no way the blockchain can know that. But what we can do is we can trust some oracles, is the language that's being used. So we could go to weather.com's API and several of its competitors. Let's say we had 5 weather sites. And we said, as long as at least three of them agree, then that gets consensus. And if we make the contract for $100 or 1 Bitcoin or something, then it's not going to be worth it to either of us to try to hack 5 or 4 major websites. The expense of that attack would outweigh the contract. So we can be reasonably assured that we've now created an insurance contract, never needing to trust one another. So that's pretty exciting. And then decentralized organizations are sort of the next extension from that, building layers and layers on top of that. And that's probably going to take some time to get to. So development is going on right now. Just recently, Gavin Anderson released a good sort of scalability roadmap and looking at bigger block sizes. And he's thinking ahead. Right now we're at about 1 transaction a second right on the network, and the 1 megabyte block allows for about 7 transactions a second. And we're not there, just a normal activity. But when there's large moves in the price, with big swings, the price spikes up or something, there is a spike in transactional activity as well. So he's trying to think ahead for, okay, maybe we're stabilizing around 400, 350, this sort of range now. But the next time, if we go up past 1,000 and there's a spike in activity, we really don't want to be hitting block limits, or it might not be great to be hitting them. So let's think ahead to how this scales and sort of doing the math over time to see what makes sense. This is another one that's just kind of interesting for me as someone. If you interact with the Bitcoin daemon at the command line, it can be a little frustrating sometimes if you're trying to just figure out address level features. Up until now, there hasn't been this get transaction outs by address. This would be a nice feature where if you're doing some things as a developer, in order to keep track of every address's balance, you needed to roll your own solution and scan the entire blockchain to keep track of it yourself. You couldn't just make a daemon call, and this is allowing for you to do that, which is quite nice. And then CoinJoin and CoinShuffle, I think they're getting to a point where they're worth looking at closely because they're going to start to be implemented in the real world. So resources, the code's online, and people talk about it online, and it's a great place to go. Even if you aren't hyper technical, a lot of the conversations are at a high enough level where you can understand the issues before getting into the code. And IRC, there's always people online talking about Bitcoin, and if you have questions, there's a lot of people who would love to answer them. Especially for miners, Bitcoin mining on Freenode. It's a great channel. The developer mailing list I mentioned earlier, the forums, obviously, I'm sure you're all on there. Meetups, though, are great. It's nice to get together and not just be on computers. It's good to see one another here. The New York BitDevs meetup is fantastic. It's very technical. It's very interesting, relatively small. And the San Francisco BitDevs meetup is a great meetup. There's another one, Sunnyvale, that's a bit less technical. That's a quite large as well. Great speakers. And those are nice, a little more regular than annual conferences and that sort of thing. So I'd encourage you all to go to meetups. And the testnet. So if you're trying to get to the lower levels, the protocol level, you're trying to do some research, it's terrifying to do anything with Bitcoin and fire off a command on your going around to test something. The testnet exists, though. It's a version of the Bitcoin blockchain that is just for tests. You can mine testnet coins. People can give them to you. It makes it easy to try something out to see how it works without stressing yourself out about hundreds of dollars being at stake every time you do something. And then the get block template for miners in particular. You might look for pools that allow this just to experiment with it. And it's a way to still mine at a pool, but get some more control at the individual level over which transactions are being included in blocks to avoid things like a cartel being able to block out transactions from a rival entity. So that's kind of the broad view. If anyone's involved in the Bitcoin mining sort of research space and thinks that there's something glaring that I've omitted, I'd love to hear about what other areas maybe I didn't touch on. Does anyone feel like I left anything major out? Good. And then questions. Is there anything that was particularly exciting you'd like to circle back around to? Can I answer any questions? Yes. Yeah, just be loud. I'll repeat it.
Hello, my name is Sean Wilkinson. I'm the lead developer for Storage. Great to see us up there.
You betcha.
Do you see, kind of just like your opinion, do you see as proof of research and proof of storage and these kind of operations replacing mining, probably because there's probably a larger market that these algorithms appeal to? You can see the miner just losing so much money.
Right. So this is Sean Wilkinson from Storage A, which we talked about earlier, and he's asking if proof of resource will sort of replace mining. I mean, so mining will exist, but it seems like it's getting centralized as the power requirements go up and your cost for electricity becomes more and more important, and heating becomes a bigger concern, and it's harder to be that independent cottage miner and really be successful at it over time, it seems. I think proof of resource is a great way that for the cottage miner, for the independent miner, I think that will replace it. It'll make more sense to run a storage shelf and relay some bandwidth and have your computer churning away than it will be to run data center level equipment at your house, for instance. So I think on that level it will, but they're all going to work in concert, right? I mean, the value of a lot of those systems will be to augment Bitcoin applications where we can build applications that use Bitcoin as the real money, but we also have sort of sub currencies that we're using to transact to get storage and computing power and all that sort of thing. So I think there's a synergy there, but yeah, absolutely for the independent miner, I would look much more towards the future. You're always going to be playing catch up with the next generation technology. I guess as it curves out with ASICs, maybe less so, but it seems to be the case where especially for myself, just mining mostly for research level, getting into GPU mining kind of at the wrong time, looking at ASICs, you get in the first batch of those for scripts. And it's just, you're always kind of chasing it. And I would look ahead to try to stop chasing those sorts of things and proof of resource exactly how to do it. Thank you. Any other questions? Come on. All right. So that's it for me. If you enjoyed any of this, please go to smithandcrown.com, sign up. We'll send you a beta invite whenever we can. Provide the market data and industry and technical research in the Bitcoin and broader crypto financial space. And then you can find this presentation at davidleo.com/mining. It's LIO. And I'll be sure to follow up with some annotations and some more sources and that sort of thing. A lot of the links are on the slides, but for those that aren't, I'll be sure to put them up there. So thank you very much. For the presentation, it's davidleo.com. It's my name, LIO, and then /mining. We'll get you to this talk.
Thank you, David. That was awesome. And as someone who knows a little bit about Bitcoin myself, I think David has the field mastered A to Z. Thank you so much. And our next round of speakers is 4 of us. Again, I'll be moderating it. And let me straighten out these water glasses while I invite Irvin, Sean, Andrew, and Ermin to come to the podium, please.
Yes, absolutely.
Sure, we'll do one way or the other.
Yes. So you yes. So we change everything to the office.
There's plenty of time. We'll just run into that. Okay. Okay. You want me to drink the water? Yes. We will bring some. That sounds good. We disconnected while I load up.
Yeah.
Thank you. Perfect. Thank you. Could you send it to randomwalker@gmail.com?
randomwalker@gmail.com.
Yep. I'm sorry, on this list you are Sean Bowie? Bowie. Sorry to bother you. Yes, on this list you are
Gün Sira.
and how do you pronounce it?
Emin Gün Sira.
Emin Gün Sira.
Yeah, perfect. Thank you.
You're Hi, Arvin. Ray. That works. Stress on the second syllable. Narayan. Narayan. Yep. Yes. So, are you supposed to go first? I'm going to go first. Okay, we get my notes. That won't be just. It's okay. You're gonna. I don't know what the order.
Conventions.
Yeah, I have trouble with getting online.
It will come online. It just takes a minute. So
okay.
If you don't mind, we can try again.
Sure.
Sometimes.
Andrew first. Let's just give it a minute.
It's
What are you doing? Oh yeah. All right, not over here. That's right. Yeah, I'm sorry. That's right.
And I'll let you.
I don't have a bio on any of you, so I'd like you to say a few words about who you are. Sounds good.
Sounds good.
Yeah, do you have a flash drive?
I will find the flash drive. Does anyone else have a flash drive?
I have one in the emergent, but it was formatted Linux.
Perfect. Thank you so much.
Okay, I think I have it.
You have it.
Yep.
Let's make sure. This works.
So you want to take questions for each of your cases? You want to questions?
No, let's just go 1, 2, 3, 4. We have something to
Yeah. So we're going to be a bit controversial.
Yeah, we'll be fine.
I'll find it.
We'll fight it.
So just to say that when you hear a question from the audience, repeat it so that you know. Yeah, I'm just trying to click on enable editing so that yeah. Okay. Excellent. Plus Maryland.
No, I'll sit wherever that's.
I believe so.
Come sit here next to me, Sven.
Good afternoon. It's Steve Reed back again, and it's my pleasure to present a forum of intellectual giants. I'm going to say the names, and then they will tell you a little bit about themselves. And I've been led to understand that there's a group dynamic, and they'll field questions as they see fit, or hold your questions at the end. And please feel free to join in whatever controversies they may ring. we're going to start with Andrew Miller. He's a PhD candidate at the Cybersecurity Center and Programming Languages Lab, University of Maryland. And then second will be Ramin Gunseer, a researcher at Cornell University. Third will be Sean Bowe. He's the creator of the SimBit. And fourth will be Arvind Narayan, the assistant professor of computer science at Princeton University. And our four speakers. Here you go, Andrew.
Thank you. Can't really go full screen. I'll have to start with this. Okay, so I'm Andrew. I'm a PhD student at the University of Maryland in the Cybersecurity Center. I've been studying, I study cryptography and distributed systems and programming languages, but I've really been focusing on all sorts of things related to Bitcoin for about 3 years now. I'm interested in all aspects of Bitcoin-related research, but my favorite topic is kind of the blue sky redesign potential. So I'm interested in what we might be interested in doing if we could redesign Bitcoin from scratch, or what could be the designs for future generations of cryptocurrencies. I'm especially interested in what effects you can have on the incentive structure of a cryptocurrency by changing details about how the mining scheme and the reward system works. In the Bitcoin community, most of the focus has been on alternative mining puzzles that are ASIC resistant, but I'm going to talk about two other approaches to alternate mining puzzles that came out of our research. The first one of these concepts is called permacoin. The idea is to have a modified form of a cryptocurrency that has this useful side effect of encouraging storage. So if we could have a mining puzzle where instead of at each step having to compute a hash function, you'd actually have to access some chunks of some large data set, mining would effectively require you to be storing parts of a large data set. Instead of a mining device being a device for computing hashes as fast as possible, with a puzzle like this in permacoin, a mining rig would be a storage device like a solid state storage disk or RAM that's actually storing portions of a data set that we care about. Okay, I'm not going to describe the details of the puzzle construction we come up with this, but our puzzle construction has this process a bunch of security properties that we've argued are essential for any cryptocurrency to work. It doesn't help to have a useful side effect if you compromise on the essential required parts of security. There are a bunch of potential uses for this. The one that we focused on is having this beneficial to society kind of public goods idea, almost like charitable contributions. So we've used the example of storing the Library of Congress archives on a permacoin network. There's other uses it could have though too. I think the Bitcoin community is maybe not concerned about having charity essentially while it's got to worry about its own security. Like this could do is getting extra income for the network, which if it were maybe in the form of government grants or something for providing some useful function, if this could be distributed to all of the holders of the currency, then it would be a way of lowering costs or subsidizing other function of the network. Besides this kind of externally useful approach, there's a way that a storage-based puzzle could actually be useful for the network itself. You could use a storage-based puzzle to solve a scalability problem that exists in Bitcoin already. So as you know, the block size is always increasing, and the number of unspent transactions that every miner has to store in order to validate transactions is increasing. And that costs some money in terms of what you have to invest in hardware to store. If you have a choice between either choosing to have a hard drive to store the blockchain and the unspent transactions database, or adding one more mining chip to your mining rig, well, you get a reward for adding one more mining chip. You don't get any direct reward for doing this validation in the storage yourself. If we had a storage-based proof of work puzzle, then the mining device would be exactly the device that you need to do this extra sort of otherwise unpaid overtime. Okay, so having a storage puzzle could have this beneficial effect even just for the network itself. Another topic I want to talk about are non-outsourceable puzzles. This is meant to address one of the kind of controversial concerns in Bitcoin, which really came to light earlier this year. Decentralization is considered one of Bitcoin's core values, and phrases like one CPU, one vote sort of allude to this principle of democracy through mining, the idea that power in Bitcoin should be defined. And as we know, there's actually been a lot of power consolidation in Bitcoin in two forms. One is in the form of hosted mining or cloud hashing, and the other is in the form of mining pools where individuals don't validate transactions themselves necessarily, but have a pool operator do the validation for them. Now, I don't want to actually make the argument that this is bad. There's lots of counterexamples or counterarguments for why this kind of consolidation isn't that bad. But the point that I do want to make is that the fact that this can happen at all is a consequence of the design of Bitcoin's proof of work puzzle, and we could change that in either direction if we wanted. Right, so in a mining pool, the members of a mining pool don't inherently trust each other. Instead, the reason that they're able to participate together in a pool cooperatively is because of this clever shares protocol. So members in a pool submit shares of partial proofs of work to the pool operator to show that they're doing work that helps the pool, right? And they get compensation from this in the form of the shares, and when they find a block, it helps the entire pool. Now, there's an attack that could be done on a mining pool. I call this the vigilante, and people have actually done this around this time that ghash.io got so large. In the vigilante attack, you submit shares that you do to the pool as normal, and you get money back and rewards for the shares that you submit. But if you actually find a real winning block, you just throw it away. You discard it, right? And this lowers the overall mining effectiveness of the pool. It punishes you a little bit. It's called a vigilante attack because you don't get any benefit from doing it, but it hurts the rest of the pool in a sense more than it hurts you, right? And people actually said, oh, I'm doing this attack, I'm doing it even though it's not helping me. I'm doing it because of some, moral outrage is why I'm motivated to do this. If we wanted to protect pools from this kind of attack, it would be possible to modify the Bitcoin proof of work puzzle to actually prevent this attack from happening. There's an alternate puzzle scheme where a miner can't tell, a pool member can't tell whether it's actually a winning block or just a share. The pool operator has to be involved to do the final step of the work to find out, right? So you could modify the puzzle to prevent this attack and make pools even stronger. On the other hand, if you wanted to discourage pools from forming, the approach would be to actually encourage a vigilante, to tempt them into doing this, rather than making it so that they have to lose something to do this attack. And the basic approach we've come up with to show how to do this is to have a modified puzzle where the idea is that there has to be a secret key that you use every time you make a mining attempt. So think of it as signing your nonce, not just hashing. Instead of just hashing, you do both a hash and a signature. And the private key that you use to do each step is the private key that you use to then claim the reward at the end. Right, so if this works, then it means that the vigilante attack actually has a really good incentive to do it, because not only do you get your shares from ordinary mining, but if you're able to walk away with a stolen puzzle solution, you get the entire block bonus for yourself. Right, and this would be a big disincentive for pools to form. All right, and there's a lot of other caveats. You would have to do something to allow miners to get the kind of low variance which drives them to pools in the first place. So there's a lot more difficulty than this. It's not that simple, but that's the high-level point of that. So let me just describe, there are a bunch of potential goals that you could have if you were going to modify the proof of work puzzle, right? So you can have side effects that do something good for the environment or for society, or that's simply a way of making extra money that the network can use. You could have modified incentives that improve some kind of scalability or incentive problems in the rest of the network. You could encourage or discourage mining pools from forming, right? And all the other things people look at, like ASIC resistance, are possible too. There's an almost orthogonal concern, which is if you wanted to have a different proof of work puzzle, would you want to preserve all of the prior investment in research and development and hardware costs for miners? Actually, Garza showed that that's possible to do with actually most of the things that I've described. So you don't necessarily have to throw out all of the mining equipment to adopt one of these new changes. In some cases, maybe people would be interested in that, though, too. Okay, so I've suggested a bunch of things that could be changes, but would any of these ever actually take hold? Now, there's two ways that could happen. One is that an altcoin that adopts one of these changes could become, could exceed Bitcoin. It could become like the next largest cryptocurrency. The other alternative is that if the Bitcoin community decides that while the Bitcoin community could adopt it, there's nothing stopping them from choosing to. I imagine that because the mining community is such an important part of the Bitcoin ecosystem and they're powerful players, that anytime that there will be a consideration in the future of a possible change, there will be some kind of complicated tug of war. There will be this balance between, is the new change worthwhile, and what are the trade-offs, especially in terms of prior investments that might be threatened by it. Okay, that's all. Thank you.
Great. So my name is Garza. I'm a professor, associate professor at Cornell University. And my claim to fame with regard to Bitcoin is maybe threefold. I was the inventor of a system called Karma in 2004. It was the first decentralized peer-to-peer currency with distributed mining. Of course, Satoshi did it much better. Following that, I'm a co-inventor of selfish mining, which is an alternative strategy you can follow to make more money mining than your fair share. And that's what I want to share with you today. And I want to sort of pictorially go through how this works and explain to you how, by deviating from the protocol that Satoshi specified, you can make more cash. My other claim to fame is something that Andrew just mentioned, which is 2PPoW, two-phase proof of work to protect against really large mining pools. So let me tell you just very quickly about the selfish mining business. You might have heard about it. It made the news. When it made the news, the Bitcoin community sort of banded together and tried to sort of minimize the impact of what this meant. So there's been a lot of confusion. I think over time, everybody has now settled down and understood, thanks to simulators and so forth developed independently, and Sean is going to talk about these, that this is a real attack, that Bitcoin is vulnerable and every other blockchain-based system is vulnerable. So we have a fix for it. So it's not something to be concerned about necessarily. It's something to know about. And I want to just tell you how it works. So I'm not going to waste your time describing how important Bitcoin is, and I'm not going to waste your time describing to you how crucial the blockchain is and how exciting an innovation the blockchain is. What I will tell you, though, just briefly, is you all know and understand the block formation process, and you all understand how miners actually solve puzzles to put together a series of blocks that encode essentially for posterity the entire transaction history of the system. So far so okay. So during this process, we all understand that forks may naturally arise. That is, at the same time, Arvind and I simultaneously find a solution to a block, and now we have a bit of a race in the network. One of us will win this race, and the other will lose. And of course, the right way to resolve these races, if we want to make sure that nobody can go back and revise history, is to pick the longest fork. So this is exactly what Satoshi prescribed. Now, following this, or the outcome of this, is a very resilient blockchain. It's highly available, append-only, distributed mining, It's got great features. And around this is the entire sort of Bitcoin system has been formed. Now, there are a couple of folk theorems that a lot of people took for granted. So let me sort of go through them. One of the Bitcoin folk theorems is, in the presence of an honest majority, so as long as 51% is honest and the 51% is following Satoshi's prescribed protocol, Bitcoin miners will follow the protocol. The rest of the folks cannot damage the system. Their best strategy is to follow the protocol prescribed by Satoshi. Deviations will not pay off. It doesn't help you to deviate from the protocol. A lot of people believe this. And in the presence of an honest majority, miners will earn Bitcoins in proportion to their mining power. So if you command X% of the mining of the hash power, you make X% of the block rewards. Our work showed that all three of these statements are false. So let me tell you how they work and how the attack works. There exists a strategy called selfish mining, and the core idea is to withhold blocks that you discover. You do not, as prescribed by Satoshi, share them as soon as you find them with other people, but what you do is you keep them close to your chest, and you judiciously release them into the wild so as to invalidate the work of other people. With X% of the hash power, obviously you cannot solve more than X% of the blocks themselves. But what you can do with judicious release is cause other people's work to be lost. And therefore, you end up occupying more than X% of the slots on the chain. So in essence, what you're doing is you're causing other people to have to work on stale blocks and therefore cause them to lose their rewards. So the way this works is as follows. When you follow selfish mining, there are only 4 cases. I want to go through them with you, and then that's going to be the end of my talk. When you find a block, you keep it secret. So if the blockchain ends on the red one and I discover a block, I keep it to myself. I don't announce it to anybody else. So from that moment on, all of the honest people out there, they're actually trying to solve a puzzle that you have made stale. That work is in danger. When you are ahead with some probability, you'll be able to build on your secret block, and you keep those blocks secret as well. Okay, so now this particular miner is 2 ahead, and that's a very commanding, very strong position to be in. Now, the next thing that can happen is, suppose you're 2 ahead, and the honest folks discover a block. They discover and release the blue block. What you do then is you release your own set of 2. And as soon as you do that, the blue is going to be orphaned. The blue is going to be orphaned, and you're going to win two chunks of revenue, 50 bitcoins for this effort. So another case is when you are 3 ahead and 3 or more ahead, and somebody else discovers a block. Well, then that's okay. What you're going to do is you'll release 1 block, and at some point when they release another one, you'll release the final 2, and you'll end up winning that chain. If you've managed to pull ahead more than 2, you're in an extremely strong position. That leaves out one last final case, and this is the case where there's a race inside the network. So suppose I'm keeping my single block secret, and there's somebody out there, an honest person, who discovers a block. Well, now 3 things can happen. The first thing that can happen, well, so what I should do at this point is, he's released his block, I need to release my own block, or else I'm going to lose a lot of money. So when that happens, that is, we start going head-to-head inside the network, so a couple of things can happen. I can get lucky myself and build on my own block. So I'm smart. I've discovered my orange block. I'm not going to build on the competitor's block. Of course, I'm going to build on my own. So that's going to happen with some probability, whatever my hash power is. Another possibility, if I do this, of course, I win. Another possibility is there's an honest person out there who doesn't hear the honest block, but here's my selfish block first. I get to him and I convert him to my cause. So he doesn't know Joe from Jill. When he gets my block, he's going to be like, okay, this looks like a legit block, and he could build on it. So to the extent that I can get to other people first, I convert them to my cause. So this can happen with some probability. I'm going to call this probability gamma. And it depends on how well networked I am. It depends on what the delay is in my main loop of my client. And the final thing, of course, is somebody releases a block, and then somebody else or that person builds on it. And if that happens, I lose. So this whole strategy is kind of like, now that we're in Vegas, it's like a winning strategy at blackjack. Okay, so there is a possibility of losing, but on the whole, if you do the analysis, the selfish miner comes out ahead. So under what conditions does the selfish miner come out ahead? There are 2 parameters. The X, what we call alpha actually, the percent of hashing power that he commands, and gamma, the rate at which he ends up converting other people to his cause. And I've plotted this here. If we assume that this person is incredibly badly networked, that he has no ability to convert other miners to his cause, he still wins with the selfish strategy if he has more than 1/3 of the hash power. So the G hashes of the world could immediately turn into selfish mining, and with, let's say, 40% of the hash power, they can make 50% of the rewards. With 45%, they end up making 65% of the rewards. But things get better if this person is better networked. If he wins some of these races, even at 20% of the hash power, he makes actually 26% of the rewards to be made. So that's where I want to end. I think it's kind of a fun thing to contemplate, that there are deviations possible from the Satoshi prescribed protocol, and these deviations can pay off. They're not illegal, and they're kind of fun to contemplate. And it's important to design a system where such deviations do not actually pay off dividends for attackers. So we have a fix proposed for this, and luckily we haven't needed to deploy it yet, but it's kind of an interesting proposition. So I leave that for your consideration. Thank you. Yes?
The question is, suppose all the pools are selfish, what happens?
So the question is, suppose all the pools are selfish, what happens? So this is an interesting question. Interesting thing about these graphs. If you look at the revenue for selfish people, it's non-linear. So if I command 10% of the network and I'm making 12%, you command 10% of the network and you're making 12%. What we could do is we could join forces to become 20%, And we don't make 24%. We make more than that. We make 26%. So therefore, there's a reward for us joining forces. So this is actually a very dangerous dynamic for the network. And so therefore, once a selfish miner emerges, rational people may flock to him. And such a pool will tend towards that 50% boundary because people will want to join their forces with them, or rational people will.
Algorithms and processes that occur inside of Bitcoin and other cryptocurrencies, and be able to swap different things, swap a blockchain for a tree chain, and see how that affects this. And I think that it would be very useful to have a very diverse framework of tools to study these attacks. I think that eventually we'll come to the conclusion that the externalities with Bitcoin are pretty much make mining, or make miners particularly, want to act rationally, want to act in a way that they will not attempt to do something that the network doesn't expect them to do, so to speak. So they're going to want to do something altruistically. They may want to, in a selfish mining attack, there's other things inside of cryptocurrencies that cause these issues. For example, miners may not necessarily have an incentive to publish transactions along with their blocks, because if they do, it actually makes block propagation slower in some contexts. So the fact that miners even include transactions in their blocks, considering the fact that block rewards are such a dominant part of their revenue, implies that these miners are altruistic, and they also expect that over the long term, behaving in a way that allows them to gain a fair amount of revenue actually increases the usability of the currency. If there was an attacker with 30% of the hash rate that was trying to attack the network right now with a selfish mining attack, it probably wouldn't end well for the currency. The value would probably plummet, and all that investment that the miner did the ability to see what incentives there are for selfish miners to collaborate, and also what disincentives there are for them to collaborate, and how they have to check each other, make sure that they're actually trying to solve or trying to perform a selfish mining attack. They're not trying to pretend like they are in certain situations. You can look that up. It's called a fair weather attack. And all these different things are very useful to simulate. So that's all I want to say.
Cool. Thank you, Sean. Can you guys hear me? Yes. Great. So, you know, this panel has been a little bit different in that there's been a lot of academics here, and there's something you may have suspected about academics, and which I can confirm, is that our main incentive is to be clever, right? And so when I saw Gun's paper, I was very impressed by how cool the idea was and how well worked out the math was. But I wanted to find out, okay, so what does this mean for the Bitcoin ecosystem? What does this mean for miners? How practically relevant is this? My name is Arvind, by the way. I teach at Princeton. I'll say a little bit about myself. Said by looking at Bitcoin from a game theoretic perspective. And I found something that surprised me. It turns out that selfish mining is not the only way in which Bitcoin is broken, and I'm putting that in quotes, in theory, from a game theoretic perspective. There have been a whole bunch of others. And in fact, the first thing I want to show you is, let me start with this. This is a picture of George Box. And he has this great quote. This is from many decades ago. He's a famous statistician. He said, all models are broken, but some models are useful. Right? And so this is a good perspective to bring into this. There are many theoretical analyses of Bitcoin, and we know for a fact that these models miss some aspects of the way that Bitcoin works in practice. But we still want to ask, to what extent is this model still good at predicting the practical behavior of the system? To what extent can rely on this model? So let me walk you through very quickly a bunch of other cool game theory examples of what people have said about Bitcoin. And this is my colleague Joe Bonneau at Princeton. He came up with this very interesting idea that he proposed just as a proof of concept to get us to think about what game theory says about Bitcoin and what we should take away from it. And he came up with the idea of outsourcing double spending. Okay, what does that mean? Let me show you a picture of, and I have to thank Joe for this particular slide as well. So this is what a double spend might typically look like. You have the main branch over there on top, where an attacker is paying to some address A some amount of value, whereas in the other side chain they're paying to some address B the same amount of value, which constitutes the double spend. Right? Is this mic okay? Are you guys hearing a? It's okay. Good. Perfect. Thank you. It's too loud. Okay. Thanks for the feedback. So the reason that double spend are hard in practice is that if you typically wanted to execute this, you'd have to do something like a 51% attack, right? You'd have to have a whole lot of hash power and use that on that shorter chain and hope that it overtook the longer chain. But here was Joe's idea. He said, why not, instead of doing that, basically pay miners to mine on that shorter chain for you? How would you do that? One cool way to do that is you could start a mining pool, which instead of treating the block reward to be 25 Bitcoins, treated the block reward to be 26 Bitcoins, and therefore had a payout that was greater than any other mining pool, right? And paid the pool participants to mine on the shorter chain for you, and thereby successfully execute a double spend. Of course, that's just the kernel of the idea. There are a lot of practical difficulties. Joe's worked through those difficulties and shown at least how, in some theoretical model, you can make this attack work in practice. So that's interesting. Instead of this one game theoretic attack, selfish mining, now we seem to have two different, totally different ways in which Bitcoin could work or could break in practice based on a theoretical calculation. Let me just show you one more. And this one is, yeah, this is just, the slide says that bribery is probably better than doing it yourself. And this one is by Andrew Miller, who's sitting right here. He was too modest to talk about it himself. So let me very quickly show you the cool idea that Andrew had. So in this situation, you have an attacker over here on the left who has, let's say, 20% of the global hash power, right? And so this attacker announces, I want to implement a blacklist. I'm blacklisting this particular address X, or it could be a series of addresses and so on. And this attacker makes this news public that they're going to implement this policy. Everybody else is looking at them saying, whatever, you have 20% of hash power. I don't need to care about what you do. When transactions from that address reach any of our mining pools, we're going to put that into the blockchain, so everything's going to be fine. The attacker reiterates that what they're going to do is they're going to consider all transactions with input X to be invalid. And really, that doesn't change anything because of the same dynamic. This attacker has only a minority of hash power, so the other miners are all unconvinced. Now it starts to get a little bit more interesting. The attacker says that they will not mine on top of any blocks that include such transactions which the attacker has considered to be blacklisted. So this is a block discouragement attack. So imagine how the honest miners might respond to such a thing. They're still going to say, you have only 20% of hash power. If you try to do this, we're all still going to be mining on the longest, the legitimate chain. So all that's going to happen is that you're only going to be hurting yourself. Right, because you're going to be creating a lot of orphan blocks, which the other miners are just not mining on top of. So everything still seems to be fine. But here's a really cool idea that Andrew came up with. So now the attacker says, but if such a transaction has 2 confirmations, then I'll accept it. Let's pause for a second and think about what are the consequences of this. So let's say you're a legitimate miner, and you're faced with a choice between meeting the attacker's demands and treating all transactions from address X as blacklisted, or just ignoring the attacker and including transactions from address X. Now, if you include that transaction, there is a small chance. There's a small chance that the attacker will find the next 2 blocks, not just the next block, but the next 2 blocks. We can numerically compute what that probability is based on this number, 20% of hash power that the attacker controls. It's going to be about 4%. Right, it's 0.2 squared. That's the probability that the attacker is going to find the next 2 blocks. And if they do, because they've announced this policy that they're not going to mine on top of blocks that include these blacklisted transactions, the attacker is going to find 2 blocks that are on a different chain, which is going to start to look like the longest chain because they ignored the block that you just found. Right? And now the honest miners are going to go, you might just be crazy enough to really do that, what you really said, because the attacker is taking a huge personal risk and risking that all of their hash power is going to end up in orphan blocks. However, if they're successful, if nobody calls the attacker's bluff, then what's going to happen is that a rational miner who is honest is going to think, okay, I can either agree to the attacker's demands and blacklist all transactions from address X myself, in which case I maybe lose a small amount of mining revenue corresponding to the transaction fees of those transactions. Right? Or I can ignore what the attacker says and construct legitimate blocks, which means that there is a 4% probability that the attacker will find the next 2 blocks and orphan the block that you just found, which means that you're just losing 4% of revenue. Right? So again, under some theoretical model where all the honest miners believe what the attacker is saying, believe the attacker is actually going to behave like this, they're forfeiting 4% of revenue and agreeing to put all transactions with address X on the blacklist. To have to blacklist transactions from address X. Here's one other paper. This is again by my colleagues at Princeton. They came up with a game theory model in which when the block reward runs out in 2040 or whatever, it's going to be a very serious problem for Bitcoin. Under their game theoretic model, the system's going to collapse. And there's a paper called On Bitcoin and Red Balloons that said, if you really look at how transaction fees are set up, the nodes that are relaying these transactions really don't have an incentive to do so. Miners should try to suppress transactions, keep it to themselves, and earn extra revenue by being the only one who can put that transaction into the blockchain. So really the conclusion from all this is that while game theory is very useful, currently the game theory of Bitcoin has a little bit of a spherical cow problem. Have you guys heard this parable of how a physicist was asked to model a problem that a dairy farm was having, and then they spent months on it, and then they came up with a solution they were very excited to announce. It turned out that the solution started with assuming that all the cows were spherical. Anyway, it's a commonly told parable to illustrate the problems with some sort of academic modeling of these things. Nevertheless, I want to say that theory can be very useful if done right, because it can really help us to forecast problems that are coming in the future that we're simply not able to observe by looking at the network right now. So I think the theory that we've had so far is a great first start. I really, really like the selfish mining paper. I want to be very clear about that. But what I do think should happen is that the theorists and the academics who are working on Bitcoin really need to reach out to the Bitcoin community more, to the Bitcoin miners, and really have a firm grasp of what are some of the strategic considerations that are going on right now, and import all of that into the game theoretic models that we're building, instead of the models that we're constructing now, which I think are a little bit restricted and are not making really solid predictions. So let me quickly go back to saying a little bit about the kind of research that I do, and I'll finish up with some thoughts of what are some ways in which we can better model the existing practices of Bitcoin, the mining community. So I have an NSF grant for research on Bitcoin, which might be at this point the only US government support of cryptocurrencies, although that might change pretty soon. I'm also teaching at this point what I think is the first university course on Bitcoin, currently teaching this at Princeton right now, and this was really a collaborative effort. There were 4 of us who did the online lectures for this: Joe, who I mentioned in the beginning of the slides, Ed Felton, who's also a professor at Princeton, myself, and Andrew Miller, who's right here. So these are the online lectures that we're using for this course. We're developing homeworks and a textbook and all that, and this is actually going to be an online course that we're going to release in January. So let me end with just a few sentences of how to solve a bit of a spherical cow problem that we're having now, and how to create a more solid model of how Bitcoin mining works. And here are my 3 suggestions. One is that the academic models really need to take into account what are the Bitcoin clients that miners are using. And we don't really have a very good understanding of this right now. And just to illustrate, the 0.7 versus 0.8 update hard fork, right? You guys remember that? So the reason that that happened and was a serious problem was because Bitcoin D had basically a monopoly type market share. This can be really modeled using game theory. It's not happening right now. Another quick example is the backbone network that a lot of miners are seem to be, from what I understand, slowly moving toward, and I'd love to hear more about that from you guys. And another point that I want to make is we need to have really good models of what checks and balances there are among the clients that miners are currently using to protect against misbehaviors of pool operators. And I think this is a huge open problem where game theory can really help, but only if we understand what miners are doing today. So I want to end with this plea to have a greater cooperation to understand the strategies employed by miners right now, not just deviant strategies, but that you guys are that into. All right, I'll end with.
Can I take the mic? I'd like to follow on. Okay, so I'd like to follow on to a couple of things that Arvind pointed out. So it's important to understand the difference between game theory and distributed systems. So the selfish mining attack that I described has absolutely nothing to do with game theory. So it doesn't rely, game theory relies on trying to understand people's incentives and how they would behave given their incentives and the rules of a game. In selfish mining, it doesn't matter what their incentives are. The protocol allows them to do certain things, and the distributed system enables them to make the money. I've made no assumptions in the work, in what I showed you, about what anybody is trying to achieve. So when somebody does not make any such assumptions, they're not doing game theory. So we can talk about other things. I mean, there are a couple of attacks that Arvind pointed out that are game theoretic in nature, right? So if I were to give you a reward for this and that, would you do that? You know, would you follow what I said, or would you follow what Satoshi said? That brings in game theory. So that's step number 1 in responding to Arvind's. Essentially, Arvind is equating a lot of work that is protocol oriented versus game theory oriented into one big under a big umbrella called theoretical work. And that therein lies a bit of a problem. The second thing I want to talk about is actually some of us have actually branched out and talked in big mining pools. I was at the Coin Summit in London where the Ghash folks first came out and had their debutante ball. And we talked to them and we tried to push back on their 51% status. And I spent a fair bit of time talking to pool operators. And I think, at least as of today, Bitcoin mining pool operators are fairly simple-minded. They're not very complicated. And yes, Arvind is very difficult to model how they make money, what miners might want. In fact, one of the papers that Arvind flashed up there, another paper from Princeton, made some assumptions about what's possible and ended up drawing an incorrect conclusion. It's very difficult. The conclusion that they drew was that Bitcoin is incentive compatible, something that we showed to be not true. So indeed, it's very easy to get into a mode where people think they understand what the miners want. So no miner would ever want to go right? It could be, so miners typically sell coins to people. As crazy as the following might sound, it is possible. A miner trying to satisfy a client who wants to buy a lot of coins might want to depress the price of Bitcoin by going over the 51% boundary. It's possible. Nobody can say that that's against somebody else's interests. It could well be that there are people who take over mining pools and start doing completely irrational things. So there's a lot of game theoretic work that unfortunately makes some assumptions that are not borne out in practice. So one thing that I want to be clear about is in our work, we did not do a game theoretic analysis. We made no assumptions. It's all distributed systems, straight up old school distributed systems. So
we should change the title of the panel.
We should change the title of the panel.
Speaking of the title of the panel, I think I left it out. The title of the panel is A Step-by-Step of How Game Theory Relates to and Impacts Cryptocurrency Mining. Okay. Now, could I show a raise of hands of someone who'd like some more explanation of what game theory is about? Y'all got it? Well, here we are in Las Vegas. Oh, go ahead. So I'd like one or two of you to say a little bit about what game theory is for a layperson.
Yeah, game theory is really it's the study of decision making, strategic decision making. You consider in which you have different actors and they have to make decisions or sequences of decisions in response to events that take place or information that they know or other factors, and their behaviors and their goals are incredibly important to understand when you're trying to do one of two things. You either are trying to design the system so that you discourage certain behaviors or encourage certain behaviors, or you're just trying to analyze what strategies are best for an individual within a pre-existing system to succeed. With regards to the 51% attack, that is you can study this within the context of game theory, and what kind of separates the 51% attack from something like the selfish mining attack is that Bitcoin is going to be vulnerable to the 51% attack, whether or not there are incentives or technological reasons why miners themselves do not want to congregate into large factors or segments of hash rate. You can have an external entity like the government that comes in and grabs these pools or these cloud hashing companies or whoever else and tells them you have to censor this transaction or whatever, and they can influence the consensus. So the real problem is trying to design a consensus model in which it doesn't matter that one entity has a majority influence over the consensus. And so when we're building cryptocurrencies, we're assuming that nobody can obtain that, and we're trying to obtain a fair and equitable distribution of the hash rate using approximations like with proof of work or proof of stake. And so game theory is really important. Economists know game theory. Well, good economists know game theory. Military strategists know game theory. And studying it within Bitcoin's context is incredibly important, especially with these attacks. You simply, Amin did this earlier. He dissected the attack in terms of what decisions can be made and what probabilities those decisions lead to and stuff like that. So.
Thank you very much for that answer. Are there questions from the audience? Anything? Yes, go ahead.
Yes. Yeah. So you mean how do you fund software development in the academic context? Yeah, so I think what's been very successful so far at Princeton is that there's a huge amount of energy from undergrads really all across the country. I mean, MIT successful. I think what researchers or professors at university can try to do is channel a lot of that energy into useful software development. And we were pretty lucky. We were in a position that we've done several types of Bitcoin research over the last couple of years. So once I started teaching this class, I found out to my surprise, how interested students are in implementing some of the ideas that have been around. And just last week, one of the students came to me and reported that they had started implementing Mixcoin, which is a paper that we did, Andrew Miller's one of the co-authors, which is similar to CoinJoin, a slightly different principles and anonymity mixing system for Bitcoin. They've been implementing that. And also, as class projects, we've been proposing a variety of interesting academic projects that people have done but are lacking implementations. So that's worked quite well so far at Princeton. I don't know how generalizable it is, but that's my answer.
So to build up on your question, another question you could ask Arvind is, what happens to the coins you guys mine with federal money? Oh, no, never mind. So leaving that aside, and on the more serious topic, there's a lot of interest on campuses in cryptocurrencies. And at Cornell, we've seen this. In fact, Coinometrics was a startup that actually spun out partly from Cornell. There's no shortage of undergraduates who come to me and say, hey, I'm really excited about this, and how can I get involved? So, Bitcoin is a very hot topic, especially among students of that age.
Are there questions? Yeah, go in the back.
I'm curious on how we can get.
Thank you. I'll repeat it. My name is Sean Wilkinson. I'm with Storage. My question is, how can we get more of the traditional academic space into Bitcoin? One particular problem I had, I've done a lot of research under undergrad, and I want to kind of go to graduate school for Bitcoin and cryptocurrency. And I looked around at the offerings, and there weren't really that much. It wasn't until I started reading stuff like Andrew Miller's paper that I said, okay, this is starting to build up. This is starting to actually gain a foothold in the academic space. And so the question is, how do we grow that? How do we accelerate that? Because the academic space is really starting to solve some of the hard computer science problems that me as a developer can sit there and implement in a piece of software or an application. And so how do we grow that?
So it takes a long time for the academic wheel to kind of start turning in this direction, but there's been a lot of increased interest in this from the academics over, in the past year and couple of years. It's kind of lagged behind, the Bitcoin community growing. The Bitcoin Foundation's done a bunch of things that I think are helpful for this. They threw the first Bitcoin research workshop, which was co-hosted with Financial Crypto, which is a very interesting conference because they should have invented Bitcoin like 20 years ago when they were, studying eCash and this sort of thing, and that's going on next year. I think Gun is on one of the chairs of that workshop for the next year. Bitcoin Foundation's also had a small grant program that they've used to fund, so that answers your question too, that contributes a small amount to fund open source development projects. They've also funded university research. I think that there needs to be more of it. I'm not sure where it's going to come from. It's really interesting that Arvind was able to get NSF funding for that. So maybe there's interest even from, the kind of pure science funding to see more of that. If NSF starts funding it and there are foundations providing things, academics will notice that for sure, and you'll see it balloon out if it doesn't already.
And another follow-up question, if you don't mind. What are ways that perhaps we could help you directly? Because I know there's people on my side of the fence that are willing to, I'm willing to throw down some coins towards, any kind of academic development in terms of Bitcoin. I know some other large investors are ready to throw down money on it. So the question is, where does that go? How do we get people working on projects? How can we help you guys more directly to continue doing what you're doing?
That's fantastic. So we would be delighted. I think the traditional way this takes place is through organic connections. So just talk to academics that you see as like-minded people with similar interests, and try to arrange. Essentially, every school will have an industrial affiliates program, and there will be ways for industry to essentially put funding in place with very little overhead taken off by the university, actually, so that money goes directly into supporting graduate students who do the bulk of the work, and that's the best way to forge those relationships. And it's very, very kind of you to actually try to have that as a goal. That's very nice.
All right, thank you very much, and thanks for all you guys have done.
Besides trying to contribute money, I think you can essentially invite yourself to come interact with anyone who has a distributed systems or cryptography group. I think
That
at
too.
Cornell, Peter Todd has a standing invitation to come there. At Maryland Cybersecurity Center, we hosted Vitalik from Ethereum last week. He gave a talk at our cryptography reading group, and it was interesting to see a bunch of people in theoretical cryptography get told what Ethereum's all about. I don't think that's too hard. That could be done anywhere, I think.
Yeah, forge those connections. We're all open. This is the one good thing about academics.
I want to say a quick note of thanks to the community as well. One of the things that happens in academia and in computer science departments is that it's very segmented into different disciplines, and Bitcoin has forced a lot of us to work together. Like, I'm a cryptography and security person to a certain extent. Gun is a distributed systems person primarily, et cetera, et cetera. Andrew has 3 advisors because to really bring the expertise together to do research on Bitcoin takes this kind of unique sort of setup that hasn't existed in academia. So we're very welcoming of this, and I think academics want to do more on Bitcoin. And so, yeah, talk to us. Invite yourself for a visit. I think that'd be wonderful.
Thank you so much. Is there anyone that could join in the conversation? Mark?
Yeah, hi. My name is Mark Lowe. I post a Cypher doc on the Bitcoin Talk. And I'd like to ask you, what's the chance that we've seen last episode of a mining pool reaching 51% of the hash rate? We've seen it 3 times with first with DBit, then with BTC Guild, and now the last one being with Ghash. And I ask that because, I personally think that mining is in a Nash equilibrium game theory. And there are some reasons to think that that might be the case that we've seen the last episode of that. I think that the large leaps in the technology development of the ASIC chips seems to be really reaching a plateau. I mean, we're getting down to 20 nanometer, 14 nanometer. These companies have kind of leapfrogged Intel and have gotten to a level now where I'm not sure how fast it's going to get these chips can get much smaller over time. And so as a result, I think what we're going to see is an increasing commoditization of ASIC chips. And as this commoditization begins to progress, we'll see the cost of these mining units coming down. In fact, I was just out front there looking at Bitmain's, Antminers, and was pretty shocked to see that I could buy a 2 terahash unit for $1,200, which is basically 72 cents a gigahash. And I could see a situation where, as this commoditization of mining hardware continues, that the accessibility for consumers can actually begin to reverse itself and actually get greater access. Individual miners would now have the opportunity to purchase these highly powered machines for reasonable retailing costs now. So as a result of that, I believe there's a real significant chance we've seen the last episode of a pool getting up to 50% of the mining hash rate.
So that's wonderfully optimistic of you, and I respect everything that you said. That's a reasonable set of conclusions, given your mindset. Let me try to provide the opposite side. So the empiricist in me says, if we look at data, this has happened 3 times so far, and there is really nothing in the protocol to push back against a 51%er. Once somebody reaches 51% or above, there really is nothing whatsoever to really push them back down, except social pressure. And the extent to which that works is, of course, it's debatable. Personally, so I saw 2 things. I was at the London summit where Ghash actually came out for the first time, made a public appearance, and talked about their business model. I came away from that meeting thinking their business model is very much based on 0% fees, and that they're us, the academic community, the core developers, the VC folks actually who wield a lot of power, managed to convince Ghash that it's not in their interest at all, or it's not in anybody's interest at all. In fact, they're doing great damage to Bitcoin by exceeding the 50% line. And Ghash then came away and said, okay, we understand your concerns. We will make sure that we will not do this. But what they really mean, I think, might be we will not publicly exceed 51%. Whether or not they do things in the background, that is, publicly they look like they're at 30-something, but unknown percentage has gone up. You know, that is a different thing to be decided. And in fact, if you look at the other thing that you said, which is what's happening with commoditization of hardware, we suddenly see that everywhere we look in computing, there is economies of scale. And so I'm not running a mail server anymore. Gmail runs it for me. I'm not running a whole bunch of other things for myself. Other big companies run it because they can do it at scale much better. They can situate themselves next to dams, get really, really, really good electricity costs. The same applies to Bitcoin mining. So I think this is why it's critical to look at things like non-outsourceable puzzles, which is the kind of thing that Andrew worked on and my group also worked on. So these are mechanisms in place to try to push back. And when somebody's exceeding or approaching that 50% boundary, to say, hey, don't do this. And there are technical measures in place to push back on you.
Awesome. We still have a few more minutes. We have another question.
Yeah, I just want to jump in and mention that the pools, non-outsourceable puzzles are not. They're going to potentially be a solution for mining pool behavior that exceeds 50%. But I think there are a lot of other things where economies at scale make a 51% attack possible too, and that is miners are much more efficient doing the same thing with the same infrastructure. And in fact, you have like the people who I think sponsor this conference, I think they're in the cloud hashing business, and cloud hashing itself is one of those things that pools, even if we eradicate mining pools, we're not going to be able to solve cloud hashing and all these other incentives to congregate hash rate within the proof of work model.
So I don't dare go into any of the technical details, but there's a variation of the non-outsourceable puzzles that would address it would discourage even cloud hashing from working.
Oh, you could explain a little bit, right?
It's a lot more complicated, but the high level summary of it is that the reason that if you understood the non-outsourceable puzzle the way that I stole it, the idea is that whoever's actually doing the mining work has the private key you need to take the reward at the end. But that doesn't say anything about whether or not it's apparent that you did that. So no hosted mining organization would do that if it was going to be obvious to everyone that they did it, because they would instantly, all the customers would go somewhere else and they'd have a horrible reputation. So the approach that I take to strengthen the non-outsourceable puzzle uses fancy cryptography called zero-knowledge proofs. And the only thing you need to know about it is that the point of it is to help. It adds a new thing. It says that whoever's actually doing the mining work can take the puzzle solution for themselves, and they can evade detection. They can get away with it. There's no way to detect or prove or even have a justified suspicion that that's actually what happened. And it's a lot more complicated to get that to work out, and it's far more tricky, and I'm not 100% certain that it would work the way that I think my approach would work. But that's the approach.
Yeah, the part that sort of interests me in that is that without non-outsourceable puzzles, the pool is probably going to expect that a miner of a certain amount of hash rate is going to produce a block eventually. And when they don't over a long time, they can pretty much determine that that miner is taking advantage of the pool. And I think the other way around might work. I'm not sure, but you could potentially have a customer of a cloud hash business that expects a certain amount of revenue but doesn't get it based on what they've paid. And I think that may defeat the very exotic, very interesting technical ways to avoid that.
Hello. Andrew, I think you spoke closest to my question and this idea in general I'm posing. I wanted to know how soon it would be that there would be a script available that would let me selfishly mine. And I think as a miner, I'm interested in mining novel coins or coins with essential differences. I think that it would be very attractive to miners if an altcoin was released that either incentivized selfish mining even more, made it easy in some way, made the barrier to entry easy to go into, or disincentivized it. Those altcoins tend to have higher variability in the initial price spike when things do hit the open market exchange. So it would be wonderful if somehow somebody could publish a way for selfish mining to be easy, and then even come out with an altcoin that either incentivizes or disincentivizes selfish mining itself. So are any of you interested in
Can you download a selfish mining script?
is that
from
already
Cornell's
possible?
webpage?
So we purposefully did not make our code public. And we did not want people selfishly mining or attacking currencies. So that's where I'll leave it at. But I can talk to you afterwards.
Okay. Would it cause rapid blockchain forking? Just the public possibility?
Right. It would not be good for, it's not good for the community, right? So we discovered it and we came up with a fix for it. And I would like to see altcoins actually adopt measures against selfish miners. And we haven't released any code that actually does selfishly mine. It just seemed like the not right thing to do. So
okay.
Also, one thing you have to consider is that the selfish mining attack is called selfish because it involves not disclosing your blocks, and if everybody did that, then there would be no consensus. So I don't think you would see an altcoin where that was incentivized or even widespread use and support of a selfish mining script. But I'm sure it could be built. I think Peter Todd was bragging on the mailing list that he wanted to help a big pool implement it or something. So I'm sure eventually you'll see it.
Yeah, real quick, I just want to know what kind of communication, pushback, feedback you guys have gotten from the core devs, Gavin, et cetera, on the selfish mining stuff.
So we have we've talked about Gavin, Greg Maxwell, and Peter Todd about selfish mining. So it's a tough game that they play. So in public, when we first released it, there was a little bit of a pushback from the entire community saying, it's not as bad as it sounds. Well, I don't want to make a value judgment. It is what it is. It's just part of the protocol. We have to accept it. I got a lot of negative messages initially from the community. In fact, threats. You noun phrase, right? My emails would read you noun phrase, and that noun phrase is never something nice. Okay, so but I think over time people realized, hey, these guys are actually trying to help the community, and this is just a scientific fact. We can't just, if we bury our heads in the sand, it's not going to go away. Somebody could actually exploit it. So Gavin and Greg Maxwell and Peter Todd and myself were at a workshop organized by Arvind and Ed Felton at Princeton, and we further developed a fix for the selfish mining protocol. And if anybody were to selfishly mine on Bitcoin, I think we would be able to deploy a fix pretty easily. So everybody understands the severity of the problem. It's been peer reviewed. I presented it at Financial Crypto. In fact, the Bitcoin Foundation was there, Gavin was there, and so forth. So they all know about the attack. then they start winning over 33%. So these old notions of the only attack we need to worry about is the 51, but no, that's gone, right? So you can start doing things that are bad for the protocol at 33% and above, and you unilaterally do them. You lose those one-to-one cases, but you win enough of the two-to-one cases that's a straight up win.
Thanks. I think we've reached the end of our time slot. We're going to take a break until 4 p.m. in which I'll make a presentation about my work. I'd like to thank our panel and those who perform the same theoretical examinations of Bitcoin. It's very good for the community to talk about our vulnerabilities in public and anticipate what they are and anticipate fixes ahead of time. I know the core development list is full of such talk, and again, I applaud our panel and their work. Thank you. Again, take a break. We'll be back here at 4 o'clock.
What happened with that? You guys are awesome. Thank you. Still working. Yeah, it's been delayed. We're literally working on it right now.
That's very nice. We played well together. All four of us.
Yeah, awesome.
Sure, of course, of course. Yeah, let me come down.
New money systems? No. I'm on AI. Yeah. Which is a challenge in its own right. Yeah, it's what I hear from Professor Kerr as well. Yeah. And oh, very cool. And let me come down. How far down the track do you think it is? Which one? Yeah, AI. Well, the theory is that the intelligence is called marginal. Set it up on the search engine. Part of my work is I'm not talking about it here, but I'm going to deploy see how it probably outperforms humans. Because the algorithm well, yeah, they're awesome. He was great. Of course, they were laughing. Yeah. No, so I'll do my thing. I'm not going to go 30 minutes. Okay. But I'll think right as I finish. You can take it. They're going to ask him funny questions.
Yeah, I'll just make sure.
He's ready.
I'll make sure that he's ready.
Yeah. I want to make the hands off.
Okay, all right. Marshall's going to be moderating that session anyway. So
for Charlie.
Oh,
awesome. Give a little bio where I'll introduce myself. He just needs to give my name and I'll say it.
Yeah, that's fine.
Great to catch up. We'll catch up over the next couple of days. Yeah, sure. Yes, it's as is with every huge technology, not specifically. There's sort of internal risks and external risks. So looking at it from internal and external. Internal as in we don't want to see cryptocurrency space, the story itself. Level of actors, incompetent actors, box strategies. At the same time, seeing how we can help mitigate other risks. For example, so mitigating, for example, population aging and demographic change require quite a bit of human mobility to mitigate that risk. Like human mobility also requires financial mobility, which is a risk that cryptocurrencies can mitigate. We've got climate change risks. We have cryptocurrencies that are basically a conversion of electricity and energy into wealth. Yeah, I did research on that actually. I got it published in CoinDesk. It's available. 15,000 word thesis on it. So did a comprehensive environmental, economic, and social analysis of Bitcoin compared to gold mining, printing and minting coins, and keeping the lights on. Yeah, that was my stuff. Yeah, absolutely. Yeah, no worries. You've got a session here. I've got 2 last degrees. You guys collaborate. Get a supervisor. Leave a pen up here. There we go. Pretty good so far. It was fun having these guys come on right afterwards. I didn't realize, I didn't look at the program. I didn't realize that, Sean was in the audience. These guys come right after. Oh, yeah.
I'm an educator at the moment.
do anything else this week? Yeah, that was it's a really interesting one. Yeah. What did you do was actually a really small, intimate thing for most of us. So they partnered up with us on this one. And so if you go to the money, and quantity, that's yeah, and there's also like VCs. And if you were here, you should have gone to the right on. You were Sky. Cool, man.
All right, we're going to get started here again in about 5 to 7 minutes. And this will be a talk where you guys can tell somebody he doesn't know what he's talking about. So all you skeptics out there, it'll be a fun time.
Just wanted to give some time to the audience to show back up. Early 60s.
Yeah, this one, I just get ready, get the other stuff, so I know it's ready. Okay. There you go. So you can use the arrows.
Awesome. I'll just hit it 6 times.
Okay.
Thank you very much, Steve. That last panel was so awesome.
Yeah, so everyone queuing up to do questions. Yeah, well, when I was reading about Emin's work, I saw the kind of visual he was receiving, and I thought that's going to make a controversial topic. But I also wanted to have some other stuff in there that wasn't just about that. And also, it's now been quite a while since he first published it, about 6 or 7 months ago.
That's right. We're putting it together.
Yeah, so I knew there'd be a bit, but and then I was just trying to find the right people to complement that, all aspects of that, and that's where eventually found Arvin and Andrew, who was a lot later actually when I discovered Andrew as a person, and Sean was kind of in between because he's on the forums talking about that stuff as well. But from a mining perspective, I thought that'd be really good to have these 3 academics, but then also someone who's bringing that real world, who's doing it. So
it's a great job. I hope you're recognized for that.
Oh, great, thank you. It's good to know. It's one of those where you wonder, well, it's 3 academics that going to work, but I think
the audience was receptive to their work. In a more general Bitcoin conference where there's something for everyone.
Yeah.
This is a miners. The miners are here. They're interested in what can go right and along the decisions they need to make, and it's a good forum for them outside of an academic conference.
Yeah.
This is where they meet the real world.
Yeah.
And then
All right, we're going to go ahead and get started on this next panel. If you guys want to come try to vet somebody's idea, let's let it rip.
I heard you, and there's only one speaker after me, and Marshall to make sure he knows.
Okay. Like this morning, I can hear you.
Okay.
And they had music.
You heard Arvin. Remember Arvin? He was
He was the one I heard. But before that, everyone was really hard to hear, except for the keynote in the beginning. That I heard, but in between, it was really hard to hear. And that music, like, I was talking like, it's like all over.
Okay. I'll look for you, and if you just go like this, if you want to allow.
Yeah.
That's good feedback.
We'll talk about it later.
Oh, all right. Well,
Don't worry.
I give everybody a long leash.
Yeah.
Give everybody as long a leash as my wife gives me.
So again, you're talking about cooperative mining.
Yeah.
And
yes. Okay. Blurred line.
All right, we're going to have a talk here about cooperative mining and some of the new strategies associated around that. And we're also going to have a time for you guys to proactively ask questions. And that's a nice way of saying somebody doesn't know what they're talking about, which we all know miners love to do that. So we're going to go ahead and get started in about 2 minutes.
Hi, what y'all doing tonight? I actually want to just do so. Dude, just come to the house.
Dude, we're going out on Saturday. Like you're coming. You're not going to be.
Okay. Yeah, but why don't you just come to the house?
What time?
We have that final fix stuff until 8.
8?
So like 9?
All right, cool. All right.
Hey, I want you to bring Jonah in here to have see what this guy's talking about, because Jonah will definitely speak up.
Do you want to have him on your channel, or you just want me to?
No, I want him in the crowd. So when I ask questions, I know he'll speak up for sure.
Just a little baby.
Yeah. Little baby. I'm a little baby.
I'm gonna leave it dim until. Yeah, sure. I'm gonna fill a little bit of time with this off the cuff.
Okay. Yeah, when we start talking full time.
Then I'll hear.
Here, let me see your paper. I'm actually gonna go ahead and just do that. You have like the.
No, I don't have the elevator speeds.
So we're gonna go ahead and like start it, but I'm just gonna have like a. Did it skip a slide? No, here we go. All right, so on this one here, this is Stephen Reed. He's a computer scientist. He does a lot of research in the computer science field. He'll also be talking about how to do cooperative mining, sharing rewards among the full nodes, and non-forking, these kind of really interesting things. And he also has a really interesting coin coming out early next year. He's gonna be talking about a lot of new strategies and techniques and how to, effectively do some brand new things that a lot of people haven't thought about. We're gonna let him talk for about maybe 10, 15 minutes. And we're gonna open up the floor for people to, ask him questions. It's actually gonna be a grill session. Steven says he likes the challenge. So, I know a lot of you guys out there like to tell people they don't know what they're talking about. So now is the time to do that. So Steven, if you want to take that away.
Thank you, Marshall, and thank you, Hashers United, for inviting me to this conference to moderate a couple of sessions and then to beat my own drum a bit. So cooperative mining is something that is quite at odds with what Satoshi designed for Bitcoin. It tries to preserve his overall goals, but takes a different direction than he did from the very beginning, but it tries to work its way back to preserving the benefits that users have of Bitcoin today. So let's take a moment to imagine a hypothetical world in which, instead of using computers to perform the proof of work calculation, we do the paperwork, the illustration that was shown earlier this afternoon, where a group of us work together in a room to pretend that we're miners, but we do it all on paper and pencil. There's a dozen of us in a room. We're doing the mining calculation by paper and pencil. And it takes all day to calculate the hash for a block. And we look at each other and we say, hey, why do we all have to do this together? Why do we all have to race each other when, look, Charlie will go, he'll do the calculation for today, and the rest of us take the time off and do what we want, and then tomorrow Steve gets his chance, and then Sally gets her chance on Wednesday. Well, that's the idea behind cooperative mining. The idea is that if we, instead of working adversarially to each other, instead of racing to use expensive mining equipment to try to get the first block before someone else does, we take turns creating the block. Anticipated this in his paper. He said, well, of course, if there's a central mint, everything gets easy. But we don't want a central mint because it's something we would have to trust. And so when challenged by Bitcoin developers in the forum and my local Austin talent that does contributions to Bitcoin Core, when I talked with them, they said, well, you might have a solution, but show us the code. I can't show you the code today. It's under development, but I can tell you how it works. And if you see a flaw in it, you can save me months of effort that I'd otherwise would spend. Here's the challenge. The challenge is that according to theory that was not talked about earlier this afternoon, there is a thing called the Byzantine general's problem of distributed systems. And a Byzantine problem, as computer scientists see it, is one in which all sorts of faults are considered. If I was a bank like Visa or a banking network like VisaNet or SwiftNet used for monetary transactions around countries, I would know that every one of the operators is either one of my employees or a site that I can send my auditors to. And the only kind of problems I'm going to see are those done by the network failures or by bugs in my software or by some criminal who's managed to infiltrate my systems. And so Visa and the banking systems have an easier time of designing their software and their networks than Bitcoin does, because Bitcoin assumes that any player can run any kind of software they want, and they can be malicious. And the brilliance of what Satoshi Nakamoto designed is a system called the longest chain rule, in which the longest chain is one that has the most difficulty put into it. That difficulty is a effort that has to be spent. And so my system is a way to have a central mint, a way that can be trusted. And I'm going to read to you a 7-minute talk based on only 6 slides with no animations. And then I'll take some questions after that. And I apologize for me reading through this. I'm working on a new mining technique called cooperative mining. The technique secures the blockchain without using expensive proof of work. It uses ordinary personal computers and servers at a data center. I published a white paper last May called Cooperative Proof of Stake. It had several thousand views on it and brought the attention of the sponsors here and got me here today. Thank you for anyone who's read it. The paper describes what I'm going to share with you. And my plan is to release an experimental altcoin to demonstrate this technique using cooperative mining early next year. And the Bitcoin Core developers I spoke to will give it a serious look through and challenge some test cases when they see the code in production. But I can describe to you today sort of briefly how it's going to work. So how does cooperative mining work? Miners who install the software on personal computers are called peers. Miners who install the software, the same software at a data center, are called super peers. The super peer miners take turns acting as the mint, creating new blocks every 10 minutes. Whoever is the mint uses the first hash that is computed as the solution for the block. This requires no changes to Bitcoin D, the fundamental code that we all run to mine Bitcoins. I simply use the regression test code that's built in there and send the Bitcoin daemon a command to mine the block using the outstanding deposit, and the software is arranged that only one peer in the whole network is the mint who gets to do that. In contrast, Bitcoin proof of work requires, as of today, about 184 million terahashes to solve a block. My technique uses the first hash, which can be done in a few microseconds. Cooperative miners, that is everybody else, verifies the new mint's block, and they copy it to their own blockchain replica. Now, with cooperative mining, there's not a bunch of different blockchains being worked on. There's one, and copies of it. A lot of copies of it. This algorithm needs no special equipment. The laptop that's in front of you or a server running in a data center is what runs the network. In this version, there's only one version of the blockchain. It does not fork. If there's no competition to make the blockchain, and there's only one blockchain and only one mint adds blocks to the blockchain, there are no forks, no orphan blocks. This is the key, and one of the places that my idea can be knocked down. When miners disagree for whatever reason, distributed consensus, and that's an important aspect of any cryptocurrency, is if there's a disagreement, how does the thing fix itself automatically? In my system, it's achieved by a miner's vote, and that vote is weighted by their respective coin stakes. Now, proof of stake is not exactly what I'm talking about. Proof of stake, as in used by Peercoin, as pioneered by Sonny King, is the idea that we have a forking blockchain, but instead of using hash codes and expensive proof of work done that way, the various forks of the blockchain are secured by a vote of stakeholders, that is, people who expose their wallets, expose their coin that they hold to the system. And the nature of the blockchain is that coin can only be voted once, because it's easy to examine the blockchain and see who owns the coin, or who you could confirm that someone claiming to own a coin owns it. Each Bitcoin wallet has the potential to sign messages and to validate the ownership of an address. That's proof of stake. I don't use proof of stake to prove the longest chain. I use proof of stake when necessary to solve disagreements. Yeah, sorry, I went too fast. Let's go back one. Yeah. All right, here's an ideal arrangement. In the ideal arrangement, there are three players. Bob and Alice want to transact with each other, and the third is a super mint peer. And I took this pretty much from Satoshi's definition, where you have a blockchain and you have these peers, and transactions are happening between the peers. They're recorded on this public ledger called the blockchain. In cooperative mining, the distinguished peer, that's today's or this week's super peer, the nomadic mint. By nomadic, I mean it can move around the network when necessary. It keeps a definitive blockchain, and Alice and Bob keep copies of it. And this can be done using the ordinary Bitcoin software that we download, wrapped with the custom code that I'm writing. There's something new in there called a tamper-evident log, and I'll get to that on the next slide. So let's go through this and see how a transaction works. Here are three miners. Alice and Bob are the miners, having personal computers. The Mint is a super peer miner located at a data center, and that's important because in cooperative mining, the payouts, depending on where they're located, and I'll go into that explaining how the network is the topology of the network in a subsequent slide. So Alice wants to send Bob some coin. Alice prepares a transaction, and this is the standard Bitcoin thing, using Bob's address, and Alice sends that transaction to the Mint. Now in standard Satoshi Bitcoin, Alice, on a best effort basis, puts her transaction in the Mint, into the network, hoping that it reaches the pool that's going to mine the next block. And it's very likely that, given a sufficient fee, that the Alice's transaction would be included in the next Satoshi Bitcoin block. But with this system, she sends it to the super peer, who she knows is a certain address on the network, and she sends the transaction to the super peer. This super peer verifies the transaction using the rules built into Bitcoin Core. And then that Mint immediately sends the acknowledgement, and this is a new thing. It sends acknowledgement to Bob and back to Alice. Now, Alice and Bob both know that the Mint will put the transaction into the next block. And this is different from Satoshi's Bitcoin. So within a few milliseconds, Alice knows that her transaction has been seen by the Mint and likely seen by Bob, and she can verify that later. So Alice and Bob individually verify the block that the Mint creates at the 10-minute mark, and they add it to their own blockchain replica. And this is a key innovation of my work, is the introduction of a Nick Szabo idea. Nick is a cyberpunk, or a well-known figure in the crypto community prior to the invention of Bitcoin, but very likely influenced how it was built. And one of the ideas that Nick Szabo had was the idea that agents in a distributed network could verify each other's work if the results were kept in a tamper-evident log. Let's talk about what that is. Bear with me if we bring up the right slide. Yeah. One more. Okay, tamper evident log. A tamper evident log is a generalization of what the blockchain is. As you guys know, the blockchain is a sequence of transactions gathered together into these containers called blocks, and a hash is a checksum performed on each block such that the checksum from block N is appended to the next block, block N plus 1, and is included in its hash. And so at the change of any particular piece of information anywhere in the blockchain is evident because the final hash, when recomputed by a verifier, will not match what the originator of this corrupted blockchain claims. And so a tamper evident log is a generalization of that. It says that if a peer will record its context, it'll record the inputs that it received, and it records the outputs that it sent to other peers, and puts this into a log that is hashed by itself, and it's verified by the signatures of peers, then that's a very good way to make sure that a peer is doing the right thing. And that goes back to the room that I talked about earlier, where a bunch of us are doing the calculations by hand. And the reason that Bob can trust Alice to do the calculation when Bob is not doing it is because he can watch what Alice does. He can check the results and make sure that she did the right thing. And as long as a majority of the participants, weighted by their stake, are doing the right thing, well, then the system works the same way that Bitcoin does. So, in addition to the way I've explained the tamper evident logs to work, is that, and this is a contribution that it was in part due to Andrew Miller's work, and he was on the previous panel. He did some work in what are called self-verifying data structures, where you can take an arbitrary computer science data structure and run hash codes across it. The Merkle tree is one type of that thing, but there are others. And I'm using a temporal, that is a calendar-based Merkle tree, to tie all the agent logs together. And periodically, that when changes are made to an agent's log, it goes into a distributed Merkle hash tree with a single root to it, and that gets published. And so an agent not only has a log that they can't corrupt, but they can't lie about it because they publish the hash for all to see. So another innovation that I use is the authentication of each miner. Now, when you mine Bitcoin today, you give no identification to the mining pool nor to the system in any other way. And all you need to do is have a Bitcoin address. None of the traffic in the Bitcoin network today, you can't tell where it came from because the IP address of the sender is not in there. The nodes, the peers know where each other are because that's how they reach each other. They communicate to each other through various IP addresses in the network, but the messages are not, you can't tell who sent a message. My system, because I need a higher level of trust, that is algorithmic trust, not human trust, I identify each node with an X509 certificate, and that's just a fancy word for what used to be called an SSL certificate. When you go to a banking website and it's got HTTPS, that S means secure, and that S means that there's an X509 certificate that's on the server, and your browser knows that that server is who they say they are because some third party said so. But an X509 certificate is also an implementation of public key encryption. And what public key encryption does is it says that I can publish what's called a public key, and I can retain what's called a private key, and I can sign documents with my private key, and the recipient, who knows what my public key is, can do some math and figure out that only I could have sent that message. So I identify all nodes in the system with an X509 certificate. In my forum on Bitcoin Talk, where I explain this algorithm, I got into a heated discussion, not heat on my part, but heat on my critics' part, that, oh, you're going to use a certificate of authority, and they're corrupt, and they've been broken, and that was a scandal back a couple of 3 years ago. And so I said, well, wait a minute, I don't need to vouch that Sally is in fact Sally. All I need to do is make sure that if Sally claims to be Sally, nobody else can claim to be Sally. And so this system has what are called self-signed certificates. Anyone can generate them with a bit of computer power. It takes a about it takes about 2 minutes on the system that I have at home. And so each user will go, hold on, so let me take us back. Yeah, so we'll have the certificates, internet standard, cryptographic authentication, and then each user, you don't have to use a real name. They can generate a handle for themselves. It's unique across the system, and the X509 certificates guarantee that. And then hacking attacks directed at the data center nodes are discouraged because the data center nodes will be required by the protocol to have denial of service protection and intrusion detection. These are services that any financial network except for Bitcoin uses. I will say that the pool operators generally will pay for DDoS protection, and some of the networks, the larger ones, may have intrusion detect. They may buy the intrusion detection honeypots and all that other stuff that they can put on. All right, this next diagram shows how cooperative mining scales to handle all the world's transactions. Well, how can I make that claim? Well, unlike Bitcoin, and Satoshi in his genius was inspired by Napster. What's Napster? Those of you who were active back in the 1990s may recall that Napster was a way to share songs with each other. It was peer-to-peer. And it was adversarial, or it was set up the way it was because at the time, and still is the case, that the powers that be that hold the copyrights wanted to suppress Napster, but technology found a way. And Satoshi looked at that and said, Napster's a good model because it's peer-to-peer. And the way Satoshi did it was anyone can join and leave the network. That's still the case today. That when you saw the diagram that showed the nodes, the full nodes in the world, 6,700 of those nodes, they can join and leave the network. When they join the network, a full node downloads the current blockchain, about 25, 30 gigabytes, downloads those things. And that causes some of the slowdown in the network for people joining it. But that network is completely ad hoc. There are no rational connections. That is, if you're going to send a transaction from here to San Francisco in the Bitcoin network, that transaction may go through Hong Kong, no problem. But Visa doesn't do it that way. Visa's got VisaNet, the model that we're trying to supersede. VisaNet has 2 data centers, only 2 in the United States, and has some elsewhere, like in Europe. And they have what's called a backbone. Visa spends money to have a dedicated high traffic traffic dedicated data pipes between their data centers. And that's what I'm representing with the blue circles in a so-called hub or a ring. Now these are super peers. There's a science for network topology in which a peer-to-peer system can be made much more efficient. Instead of having random connections, you have a hub and spoke method where traffic goes from the hub out to the spokes and from the spokes back into the hubs. Well, what are the spokes? The spokes are consumer wallets. The spokes are payment processors. The spokes are the originators and the recipients of transactions. In the center, at the center, are the processors of the transactions. In today's system, those would be like mining pools. In my system, they're simply the super peers that have the responsibility for creating new coins and safeguarding the network. These guys are rationally connected. They have, each one of them has a direct connection to every other one and routes the messages where they make the most sense. That is, if a new transaction comes in, it gets to today's nomadic mint in the shortest hops. And I sent transactions back and forth to London to see how long it would take. Not Bitcoin transactions, but just inquiries on a website. And I did trace routes to see where the hops were. And I can get around the world in much less than a second. I can get to London and back in maybe half a second. And when Alice sends Bob a transaction, she should be able to get an acknowledgement in back about half a second. The best Bitcoin can do is probably a couple minutes between the time that a transaction goes all the way around the network and all the nodes see it. So in this system, ordinary miners are connected to a few super peers, and consumer wallets are each connected to ordinary miners. And this is my last slide. So what are the benefits of this system? Now remember that there's only one mint. There's only one blockchain. So what does that do? What kind of benefits do we get from that? Well, we get some big benefits, and I'll tell you what they are. Because no changes are made to the Bitcoin wire protocol, that is, I use Bitcoin daemon. That's the C language program that's written by the Bitcoin core team, whose source code is on GitHub. I use that code, would make about 20 lines worth of coding changes to it, mainly to allow the use of the regression test mode in production. Everything else that's in Bitcoin core is left unchanged. So existing wallets and payment processors just work. That's in theory. Haven't gotten close enough to actually test that, but that's the theory of it. When they're reconfigured for the network seeds, the IP addresses of the network seeds, and the port number. It's a convention, a polite convention among altcoin developers, not to use the same addresses, IP addresses, nor the same port number that Bitcoin does. And that's to protect the consumer from, and when they connect to my network and say, oh, I've got some dollars there or some coins there, and then they go over to Bitcoin and they say, oh, where is it? The idea of a different port is to protect the consumer. So with Bitcoin, who knows when a new transaction will be included into a block? And we've had conversations, some of us here today, about transactions that get reverted. It's possible when your transaction is part of an orphan block, and merchants know that. In cooperative mining, the technique that I'm developing, an accepted transaction, that is, if it makes it to the mint, and the mint says, oh, it's not a dust, and the inputs are unspent, and so forth, there's a whole set of criteria that makes a valid transaction. If that transaction gets accepted, that doesn't mean it's in the block yet, but if that transaction gets accepted, well, then it's certain that it's going to be in the next block by the design of the system. So if a transaction recipient, Bob in the case of the earlier diagram, he can immediately spend it. Now there's a rule that some of you may be aware of it used to be the case when you solo mined, you saw this, that you cannot spend the Coinbase reward until a sufficient period of time has gone by. It might be 100 blocks. I've forgotten exactly what the figure is, but it's quite a while before you're allowed to spend your Coinbase transaction, and the mining pools hold a reserve to make their daily payouts because of that. Well, in this system, the Coinbase transaction and any transaction can be immediately spent because it's going to be certainly in the blockchain, and there's no forks and no orphans. Well, in cooperative mining does not need to pay for expensive mining equipment and electricity because we use the first hash. It can be done on a Raspberry Pi if you wanted to. That would be enough to solve a block. There's no competition, no other miners trying to do the same thing. So transaction fees can be much lower and match the actual cost. Now, when I do my coin, I probably have a market cap of 10,000 bucks if I'm lucky. And thus, my transaction fees will be somewhat higher than would be the case if this technology were in Bitcoin. But if it were in Bitcoin, and that's the goal, is this is an experimental thing. It's just to prove to the core developers that this is a possibility. When down the road, and I'll go into it later if there's time, but it doesn't really matter, that some people think that spending all this electricity on doing a mining thing is not the right idea. There are arguments that it is the right idea, but let's not get into that. It's just that my idea doesn't require that electricity to be spent. And it could be because of that, and because not every full node has to archive the blockchain. We just need to make sure there's enough copies that when there's a nuclear war or the asteroid hits the Earth, or the wrong people take over the government in the United States and shut down all the miners, that there's enough copies of the blockchain left to keep the thing going. And it might be only 100 copies are enough, not 6,000. So, well, how much does it cost to store those things? If you guys have been to your local computer store or Amazon and you've said, well, how much storage can I buy for $200? It's getting up to 2 or 3 terabytes. And if you run the math, and you know that the average Bitcoin transaction is about 220 bytes, that is a change address and one destination, that you can store a lot of gigabytes on a drive with 100 times replication or 200 or 300 times replication for a lot less than 5 cents a transaction. And that's what Bitcoin charges. Bitcoin charges 5 cents a transaction. And that means that it doesn't make any sense to do a Bitcoin transaction less than 50 cents because now your transaction fees are 10% of what you're paying. With cooperative mining, that doesn't happen. Furthermore, some Bitcoin issues just go away. I'll list them. And in that list, it gets longer because the previous panel was talking about some vulnerabilities that I didn't include that go away. There's no centralized mining. Well, why? Because the algorithm employs general purpose computers that every one of us has. Like back in the day when I did solo mining, every one of us had a computer and every one of us for a few weeks had the chance to mine some blocks. There are no orphan blocks because there's a single non-forking blockchain version. There's no double spending fraud. Well, how does that happen? It's because the transaction races around the network trying to find the miner that will first put it into a block. And if the transactions are sent in 2 different paths with a different transaction fee, a merchant might be defrauded, but with my system, that cannot happen. There are no impersonation attacks. Well, early on, Satoshi was very concerned about a so-called Sybil attack, and that's a reference to impersonation. And that can't happen with this system because each miner is uniquely identified by their own certificate, and they can make as many of these certificates as they want, but nobody else can claim to be them. To summarize, cooperative mining enables fair sharing of the rewards, lowers costs, and secures the blockchain. And I'll demonstrate this with a coin that's under development, and I'll release it next year. I've got an active thread on Bitcoin Talk Forum where I'm known as Slippery Slope, and the thing is called the TexAI coin. And I'd be glad to talk to anybody about it. Thank you so much for your time.
All right, Steve, I actually have one question before we open the floor a little bit. I think we have like about 10 minutes for questions, but you mentioned about the nomadic super peer. And I guess my question would be, what determines if there are several data centers? What determines who is the primary super peer?
Sure. So in Austin, back in May when I was thinking about this a little earlier, thanks for the question, Marshall. It's a good one. The reason I'll say it's a good one is that one of the smart guys in Austin, a student at University of Texas, a mathematics student, he goes by the handle Andy Toshi, and he's a mathematics guy interested in crypto. And he's an advisor to the Bitcoin core team on the strength of their encryption. And I put this idea to him, and he said, well, wait a minute. His very first thing was, this is not Bitcoin. This is not what Satoshi wanted to do. You can't call it Bitcoin. So I didn't. But he said, well, what happens? What happens when the network is disrupted? How do you start the thing off? Who gets to be the super peer? Right. Well, there is a whole scientific discipline, and we could have a panel of experts on it that doesn't really need to fit in this forum, but it's called fault-tolerant computing. And they have a sub-study of that called Byzantine fault-tolerant computing. And Byzantine fault-tolerant computing says, well, wait a minute, let's have a distributed network, and let's figure out how this distributed network can function, continue to function in the face of Byzantine faults, and Byzantine faults involve criminals or adversaries running different parts of your network and trying to screw it up intentionally. How do you make it work? Well, all right, so you do it by voting. And there is an algorithm for the solution of a distributed consensus, and it involves, there's several of them that I could use, and I'm going to use, because I'm writing in Java code, and it's controversial because it's legacy and old-fashioned, but that's who I am. There's some convenient libraries for doing distributed consensus. And the way it works is that it's done by an election. Sure. And so at random intervals, peers who are on the network, and let's assume that the network is well enough connected where they know each other, some of them are, they will vote for a peer, and a peer will keep track of how many votes it's gotten. And when it reaches a certain threshold, to say, I am the super peer who's going to mint, or I am the super peer who's going to set the mining schedule for the next week. I don't see the super peer as changing venue very often. Sure. But that's how I see it. At their stake, to prevent an attacker from genning up on AWS or whatever, lots of nodes.
Okay, great. So we're going to actually open up the floor. I'm going to bring the mic to you guys. So if you just put your hand up after each question, we'll get those figured out.
And in addition to questions on the cooperative, I'd be willing to talk about proof of stake And on my website is a long list of references that would that can help any altcoin developer. Hundreds of references on the theory and the useful techniques for how do you get a blockchain explorer and so forth. All those are links on my site.
All right, we're first going to go over here to Phil Mayher. I think he's got a question.
Thanks, Marshall. Really great speech. Some very innovative stuff there. Pretty basic question. I just wanted to understand, how do you go after the problem of people creating botnets and all sorts of malware like that to zombify a bunch of PCs all over the place if you don't really need the GPU and it's just one CPU, one vote kind of scenario?
That's a very good question. I've thought about it. And just today I was thinking, well, how can I warn the users of a botnet that, or the users of the legitimate owners of a computer, how can I warn them that some malware is running on the computer? Now let's make the assumption that there's two different cases. The first case is that they surreptitiously install my software on a computer that they should not do it. The second case is they make a modification to my software that behaves outwardly like my software. That's more of a Byzantine case. It's the harder one, because I can't just pop up a message window every few minutes saying, did you know that I'm running on your computer? Please press X to continue. And the stake-weighted voting is part of that. And the other part is that I'm using a sort of what's called a cognitive computer science approach to this, where the software is a different level of sophistication than the typical software. It consists of a so-called intelligent agents, and one of those agents will be trying to probe from a remote location. It'll be trying to probe the address of the system and its characteristics, and it will try to figure out if it's running on a system that it shouldn't be running on. Now, in most cases, that's not too easy, but the data center peers, the ones that claim to be super peers, they're going to have to demonstrate bandwidth. They're going to have to demonstrate CPU, and a verifying peer can send the same way you do a bandwidth test with. If you guys don't know about speedtest.net, that's a good site to measure bandwidth with, and you can contrive such tests for peers to verify their capabilities. And regarding botnets, this method does bring back the possibility of bad botnets, but the reward that the owner gets is in proportion. That is, all the rewards are shared, but they're shared in proportion to their contribution to the network. And a botnet's not going to make much contribution unless it's located in an office environment or something else with high bandwidth.
Right. Okay. Thanks, Steve. I actually have Lily here. She has a question also.
Hi, my name's Lily. I've done Linux engineering and internet service delivery for about 20 years. My question is, who owns and supports the super peers, and how do you account for a compromised super peer? What would happen in that case?
Right. So let's do the second part first. It's because it's more provocative. So the question is, what happens with a malicious super peer? As I've illustrated by this diagram, the super peers have more rights and they're more important. They're on the backbone. They handle the traffic. And this was a question that Andy Toshi, my friend in Austin, also talked about. He said, well, how do you handle that? And you do it by remote attestation. That is, the peers, the other super peers, and furthermore, all the peers in the network validate the logs, the tamper-evident logs of a peer. So if all your inputs are logged, now as a Linux system administrator, I don't have to tell you about the value of logs. If I took your logs away, your job would get difficult to find any bugs. Well, this is system logs writ large. Every activity in the system has a log that's specific to what it does. All the inputs are logged. The context is logged in case the inputs are ambiguous, and that should explain the outputs. And the same software or a similar version of the software is used to verify the work as is done to create it. All nodes have the same software, and that's part of the payout, because in this system we get to redo the payouts, and we can have the payouts to be dependent on them running the version or version n less 1. And then the first part of your question was, how do you get to be a super peer? Was that it? Yeah, it's done by capability. So you can claim to be a super peer. I would ask, for example, this is stuff that I'm thinking about. I would like developers to be paid, and one way to do that is to have them be paid through the Bitcoin Foundation, which, despite its fault, is a way that Bitcoin Core developers are getting paid. So I would require super peer operators to be members of the Bitcoin Foundation and provide a way anonymously that I can have a way of calling or verifying, or other members of the syndicate can validate that a super peer is a member of the Bitcoin Foundation in good standing. If it was compromised, then it's Byzantine in a sense that anything could go wrong, right? They can withhold transactions, they can insert transactions, they can pretend to be someone else if they can.
Sure, but how would you accommodate that? In other words,
By
let's say-
checking the logs.
No, understood. So let's say you now have a compromised super peer. What happens on the network?
They ban it.
Okay.
And that's the same thing that Bitcoin Core does. So if you know the code that's in Bitcoin Core, if a particular full node operator, and most of you are not running full nodes, some are, but for those of you who know how it works, a Bitcoin full node who's running the Bitcoin Core daemon, Bitcoin D, can ban a peer that is refused to accept connections from it if it misbehaves continuously. And I keep that.
This is Scott Fargo from CryptoCoins News. He has a question.
I was wondering why you would want to bring this all centralized like Visa that you compared it to. One of the biggest things is that differentiates Bitcoin and the blockchain is the fact that it is very decentralized. Even though you're considering this decentralized, it is very much not at all, not in the least bit. And especially depending on cost, there could be a race to see who could build the biggest super nodes, who could have the biggest, the baddest, the fastest, the most bandwidth. And then you're running into the same thing, only at a different scale, where people that don't have the stakes can't even be involved.
Right, and thanks for the question. It's a good one. Again, my colleague Andy Toshi back in Austin, we had several lunches together, and they were well worth the money I spent for them because these issues came up last spring, and I thought about them. And so the very first thing he said, well, this is not Bitcoin. It's centralized. It's obviously got one mint. And Satoshi mentions a single mint in his paper, and then he goes to demolish that idea because it's centralized. Well, I say, well, effectively, as long as you have, and this is a claim that I have to make and persuade people, as long as that mint is nomadic, as long as it can move around like what they used to call a floating crap, that is a game of illegal gambling, as long as it can't be stopped, as long as if an attempt to attack it fails because it can simply move someplace else, then I say that's sufficiently decentralized. In my paper, I make a claim that Bitcoin today has got about 12 effective miners, and those are the pools. And I think I can do better than that. I think if I've got 50 nodes that take turns mining coins, it's better than the 12 pools that dominate the currency production today in Bitcoin. Now, it's a tough road to hoe. And right now, my score with the Bitcoin Core developers is about 20 to 0. None of them agree with me. And I was hoping Greg Maxwell would be here because out of all of them, he was the most encouraging. And he said, well, I'm not sure, but I'd like to see the code. And that's about as encouraging as he was, except that he didn't say flat out, that's a stupid idea.
All right, Stephen, thanks a lot for talking. So that's all we've got for Stephen today. If you guys want to give him a round of applause, I think it's a pretty interesting idea. And I actually kind of like that. And I'm more kind of that way than minting, actually. So it's cool. All right. So coming up here, we got Charlie Lee. He's the Litecoin guy. I'm sure all you guys have heard of him. We're gonna probably kick that off here in like the next minute or two. So I think he's got. We're actually probably going to switch one.
All right, so we have Charlie Lee here. He's going to talk a little bit about Litecoin. I'm sure most of you guys, if not everybody, is at least heard of Charlie Lee, and he's going to talk a little bit about some new things here, and then we're going to open it up for questions again towards the end.
Cool. Thanks for having me. I'll just hold it. Cool. So, so I was asked to come here to talk about script. So I'm supposed to represent all of script mining or something like that. But I'm here to talk about Litecoin, and I guess a little bit about why I chose script and a little bit of history about Litecoin. So hopefully it'll be interesting to you guys. So I guess I want to see a show of hands. Who here mines Litecoin? Who here mines Bitcoin? So pretty even. Who here mines anything other than Litecoin or Bitcoin? Did you say Dogecoin sucks? Okay. So a little bit of history about Litecoin. So I guess you all know Litecoin is an open source fork of Bitcoin. It has 4 times more coins, 84 million instead of 21 million Bitcoins. Blocks are a quarter times faster. A quarter times the speed, so it's 2.5 minutes per block instead of 10 minutes for Bitcoin. And it uses a different proof of work. Bitcoin uses SHA-256, and Litecoin uses script. And it's commonly known as silver to Bitcoin's gold. It was launched actually almost 3 years ago now. So October 13th of 2011. And today, the market cap is about $125 million and about $3.80 per Litecoin. And at one point last year, it actually hit $1 billion market cap, which is quite incredible. So a lot of people don't know this, but there were quite a few coins before Litecoin came on the scene. Some people think that Litecoin is the second, like the first alternative coin that came out, but it's not. It's nowhere near that. Like before Litecoin, there was Namecoin, Xcoin, IOCoin, Solidcoin, Guyscale, Tenebricks, Fairbricks. Anyone heard of Tenebricks before? Cool. So Tenebricks is actually the first coin that used script proof of work, and Litecoin pretty much just copied it. Let's go continue. So why did Litecoin succeed and Tenebricks did not? Like Tenebricks is not used anywhere, but it's very similar to Litecoin. So why did Litecoin succeed? So I guess this is good for you. If you want to design and start a new coin, you can follow my advice. Maybe you can create the next Litecoin. So few things, right? You need a good name, right? Tenebricks is not a good name. Like you tell someone Tenebricks, they don't remember it. It's hard to pronounce, hard to spell, and it's just hard to succeed because people can't talk about it easily as Litecoin. You need like a good branding, kind of marketing, because in the end, these coins are like startups, right? They're you need to spread it through word of mouth. You need people to mine it and to understand what it is. And like I said, for third, you need to attract miners, right? The reason why I chose to use script is because I didn't want to compete with Bitcoin for miners. Right? Today, if you launch a coin with script or SHA-256 proof of work, it's really hard for you to succeed because you're competing with like Bitcoin or Litecoin for miners, and that's just really hard to do. Number 4 is you need a fair launch. So one thing about Tenebricks is it was pre-mined. There was like 7 million pre-mined Tenebricks coins. And I wanted to make sure that Litecoin launched really fairly. And I'll talk about a little bit more how I did that. And lastly, don't change what's not broken. And don't change what you don't understand. So a lot of developers launch coins and they feel like tweaking some things here and tweaking the code here and there. And they didn't really understand why it was there in the first place. Like Solidcoin released without with fixed fees, right? Every transaction costs the exact same fee. And when they did that, the network got spammed because it was really cheap to attack the network. With Bitcoin, if you want to attack the network, like the dust spam, if you send really small transactions, it will cost you more than if you send normal transactions. So yeah. So a little bit more about name. how I came up with the name Litecoin. Litecoin is basically a light version of Bitcoin, right? It's a little bit faster, has lower fees. And lastly, because Litecoin.org was not taken. So branding, I think so I came up with the branding silver to Bitcoin's gold. I think that really helped a lot, helped make Litecoin successful. The reason is because people are used to silver and gold, right? Bitcoin was known as Bitcoin is like a better version of gold, and Litecoin is like a better version of silver. So people are used to seeing like big gold and silver together, gold medal, silver medal. So it was very easy for people to understand when you talk about Litecoin being silver, they realize that it's like the number 2 coin. And it kind of was like a self-fulfilling prophecy. People were talking about Litecoin being silver, and afterwards it actually did become silver just because people were talking about it. People understood that gold and silver was used throughout history as currency, and kind of resonated that Litecoin and Bitcoin can be used together. And silver is obviously valuable, just like gold. People use it in jewelry. So when you think about Litecoin being silver, you automatically think that it's valuable. And one other thing is it's cheaper than gold. It's kind of silly, but it's cheaper than Bitcoin. It's kind of silly. People think that it's too expensive to buy Bitcoins because it's like $400, right? You can't afford one Bitcoin, but you can afford one Litecoin because it's only $4. So that kind of helps too. And lastly, I mentioned that it's paired with gold. Like whenever people talk about gold and silver, they talk about it together. And that's what I want to do, right? I want people to talk about Bitcoin and Litecoin together. I wanted like exchanges to support both coins. Like if an exchange support Bitcoin, the question is why not also Litecoin, right? Because you should actually support both. And that really helped, I think. And number 3, I mentioned this briefly. I chose script proof of work. So Tenderbrick came out with using script. I realized how good it was that people can mine a coin with their CPUs. At that time, it was a CPU mineable coin with their CPUs while mining Bitcoin with GPUs. So you can mine both at the same time, and you're not really competing with the other coin for miners. So before Litecoin, Namecoin was mining on SHA-256. So it was competing with Bitcoin for miners. And what happened was miners would jump to mine Namecoin only when it became profitable. And then when the difficulty jumped up, it became unprofitable. They would leave and go back to mining Bitcoin, and it will leave Namecoin in a really high difficulty position with very low hash rate. And it kind of like transactions will slow to a crawl. It was a really bad position for Namecoin to be in. And I realized early on that in order for a coin to succeed as an alternative to Bitcoin, it really had to use something different. And script was proven that it worked. So because of memory hard proof of work, at the time it was CPU only. And when Bitcoin moved to ASICs, all these GPUs were people with GPUs mining coin was looking for another coin to mine because otherwise they had to sell it or start playing games again. So they all jumped to mining Litecoin. And when that happened, the security network jumped up, and people realized how valuable it is when the network is really secure. So that helped a lot too. Number 4, fair launch. So I actually released the source and binary a week before. Sorry, I released the source and binary a week before the launch. So launch time was selected by a forum poll. So I tried to make this as fair as possible, letting people play around with the code, mine on a test net, making sure that all their miners work. And then all I did was I withheld a config value. So those two end time and end nonce were the config values that represent the Genesis block that I withheld. So at the launch time, I released those 2 values, and all the miners needed to do was change their config file, restart Litecoin D, and all of a sudden their Litecoin client would be mining on the mainnet. So that happened, and then basically thousands of people jumped in and mined at the same time. So I tried to make it as fair as possible, and that's how I did it. And sadly, these days, all these new altcoins that are coming out, they copied Litecoin, but they didn't copy one of the, what I think was one of the main reasons why it succeeded, was being fair, right? A lot of the coins were pre-mined, or they were like they were launched privately to friends, or they weren't publicly announced and no one knew about it for like a week or a month, and then all the early coins went to just friends or just to themselves. And then lastly, Litecoin is Bitcoin Lite, right? I want to keep it as close to Bitcoin as possible. So following his footsteps, Bitcoin kind of paves the way, and I think Litecoin complements Bitcoin really well. And that, I think that really helps too. So earlier I said Litecoin succeeded, right? So how do I measure success? So the way I look at it is you need network security, right? You need